Conventional, insured, and guaranteed loans on page 243. Boom. So, ready or not, here we go. Awesome. Okay, doke. Conventional loans are loans directly between the lender and the borrower with no third-party involvement or influence, okay? What is a conventional loan? It's a loan directly between the lender and the borrower. They're not reliant on the lender's the one that makes the decision whether they're going to lend you the money or not. They're not reliant on any third parties' lending guidelines like the FHA or VA or anybody else. Because a conventional lender lends their own money, and therefore they have more latitude, they have more flexibility as to who they lend it to. So it's a loan directly between the lender and the borrower with no third party involvement or influence in that transaction. Now, we're going to learn more about conventional loans, who you get them from, and some more details about them in a little while. But here's just the basic gist, the basic rundown of it. Government-backed loans include those that come from the FHA or the VA. Neither one of them lends money, the FHA or the VA. But both of those, if you're going to be getting a loan from the FHA or VA, they require that special amendatory clause that be added to the contract that states if the property does not appraise for the purchase price, the buyer can get out of the contract without penalty. Now, the FHA insures loans. The FHA stands for the Federal Housing Administration, and the FHA insures loans. The VA, the Department of Veterans Affairs, they guarantee the 25% of the loan will be paid. And because the VA guarantees 25% of the loan in the event the borrower defaults, it's as if the borrower put down 25%. So therefore, no down payment required. And loans directly from the government include those we have in New Jersey, the New Jersey Housing Mortgage Finance Agency. It's a little misleading. They're not directly from the government. NJHMFA does not lend money. They have a lot of approved lenders for their different loan programs. This New Jersey agency has a lot of different loan programs, such for teachers, for firemen and police, for people who live where they work, people who travel to work in off-peak hours to try to relieve some congestion on our busy roads, people who remote work. There's special mortgage loans that you could get for these people in these situations. For first-time home buyers, they have that New Jersey Smart Start program I explained to you a little bit yesterday. And then we have the REC-D, which is the Rural Economic Community Development. That's the former Farmer Home Loan Association. And they get the loans through the USDA. That's the United States Department of Agriculture. So, what to highlight? Highlights, the first bullet point, conventional loans are arranged directly between the borrower and lender with no third-party involvement or influence.
I know I was going to do that.
Huh?
What page is it?
243. First bullet point under conventional, insured, and guaranteed loans.
Okay.
And then highlight on the next bullet point, FHA insures loans, or it just says insured by the FHA or guaranteed by the VA. And then right at the end of that, neither lends money for the second bullet point. Neither lends money. Then go down to where it says conventional loans. And at the end of the paragraph for conventional loans, let's see if we get into, yeah, for conventional loans, at the end of the paragraph, I want you to write max seller concession. Remember how much concession was allowed for a conventional loan?
6%?
No, that's for FHA and VA. It's
Oh, 3%.
3%. So write down conventional loans, where it says conventional loans, write max seller concession, CONCESSION, max seller concession allowed 3%. Now the down payment would vary depending on the borrower and the situation and all, the lender, etc. But max seller concession 3%. Now typical down payment is 20%, but they could require a lesser down payment. Now, next section says private mortgage insurance, PMI. Anytime somebody, do I have a slide for this? I do, coming up. So let's go over a couple things, I guess, before we get into this then, because I do have slides for this to match up. I just needed to explain to you a couple of things. What is urban, suburban, and rural? Well, this pink area is urban. Urban is a densely populated area where you have a lot of people living close together in with a close proximity. It's a city. It's the city areas, you know. That's urban. Suburban is where you got people living a little bit farther away from each other. Okay, that's suburban, or they call it suburbia. You know, suburban or suburbia. It's just outside the cities. It's a little bit, homes are a little bit further away from each other. You got larger lot sizes. We're not having a lot of people living in the same area. Like in a city, you could have a high rise or what have you, and you have many people living in a small geographic area, right? But in suburbia, you could have single family homes. They're spread out a little bit. And then rural is like farmland, you know, where people live farther away from each other or out in the country, you know, not necessarily farmland, but out in the country. People who live pretty far away from each other. They're spread out, less densely populated. Got that? Urban, suburban, and rural. Yes? You guys were so talkative before a couple minutes ago.
Yeah, we got it.
Okay.
Yeah, we got it.
Yeah.
And then, so how does lending work in a nutshell? I explained this to you guys the other day, but here it is again. I actually wrote it down in case you forgot. Most lenders, they don't lend their own money. Those that do are called portfolio lenders. So a conventional lender lends their own money. So a conventional lender is called, where do you get the money from? They're called portfolio lenders. A conventional loan comes from portfolio lenders. Now, where do we get money from to borrow to buy homes? Well, here's some of the typical places where we get money. Banks and credit unions. Investors are common sources for obtaining funds for loans. They lend their depositors money according to some third-party investors' lending criteria that's willing to purchase those loans later. And then they sell those loans to them later on to get their depositors' money back and some interest paid up front as their profit. And then they re-lend the money again. They start it all over again, the cycle. Now, sometimes these investors will also pay a bank a servicing fee to continue sending out the bills and doing the monthly bill handling. So that's how your bank would make money. They lend their depositors money. They resell those loans after they've been originated to get the money back, plus some of the interest, the profit up front. And then in addition to that, they get paid a monthly fee for continuing to send out doing the bill collections for the investor who they sold the loan to. Now, when loans are originated to purchase real estate, to purchase real estate, this is called the primary mortgage market. Sorry about that. Just want to correct this. purchase real estate. This is called the primary mortgage market. And now when those loans are resold to investors, that is what is called
Secondary mortgage
the
market.
secondary mortgage market, correct. So it's pretty straightforward, okay? Where lenders loan you money to buy real estate, that's the primary market. And when those loans are resold to investors, that is called the secondary market. So when loans are originated to acquire real estate, that's the primary market. And where do you get loans from? Banks, credit unions, and investors. And when those loans are resold to banks, other large banks or other investment groups, that's deemed the secondary market. Pretty straightforward, pretty simple. Got it? Yeah. Anybody know what a credit union is?
Yeah.
It's like a
Yeah.
it's like a nonprofit bank.
Like where you want to like save your money and
It's basically a bank, but it's
Yeah.
not. It's a nonprofit bank. It's a non-for-profit bank. So you could get some better rates sometimes from them. Banking could be cheaper. All right, so how lending works in a nutshell. I have this, there's a great video here. I just got to add the link to it. Damn it, I didn't do that yet. So what slide number is this? I'll make a note of it. I'll do it later. But I think I have a link to this on our Facebook page, either way, or on our YouTube channel. Money as Debt, chapter 14, slide 37. All right, so here's a great video here, Money as Debt, Promises Unleashed 2. The guy made it into a cartoon. It's pretty entertaining the way he put it together, but it's actually it's pretty much a movie because it's broken down into like 6-minute segments, but it's about a 48-minute movie that's turned into a cartoon where the guy's an economist and he explains how lending, how money gets its value, how lending works in the United States in the past, as well as how it works today and throughout the world. And it's actually very accurate, but the guy puts it together in like an entertaining cartoon way. And then he takes past quotes from presidents and economists and those that are running the financial institutions, and shows how we went from the gold standard to the type of money that we have today. So it's an interesting video nonetheless. So it's just a little resource I put there. Money is Debt, Promises Unleashed. I think everybody should show this to their kids, this video, once they reach like that first year in high school or the last year in middle school. I think that they should, everybody should watch this video. All right, so conventional loans, let's get back to them now. Okay, so what is a conventional loan again? It's a loan directly between the borrower and the lender with no third-party involvement or influence. You get them from what we call portfolio lenders. Those are lenders who lend their own money with no intent to resell the loan. They usually don't resell the loan. They keep it in their own investment portfolio. That's why they call them that's why we call them portfolio lenders. They keep those loans in their own investment portfolios. But we know that sometimes even investors that have investments, they need to generate, they need to liquidate some of their assets, some of their investments, so that they could get the money to invest in a new project, right? So sometimes portfolio lenders do not hold on to the loans for the long term and sell them. But when they write up their loans, they don't plan on that. They plan on keeping them in their own investment portfolio. But sometimes they do resell those loans. Now, do not confuse a conventional loan with a conforming loan. Conforming loan is one that meets Fannie Mae's lending guidelines. We're going to be learning about that in the next chapter 15. Okay. So conventional loans, do not confuse with conforming loans, and just putting that because these are two often confused type of loans. All right. Conforming loan versus conventional. Conforming loan conforms to Fannie Mae's lending guidelines. Fannie Mae is the largest purchaser of loans in the secondary market. They're the largest investor that purchases loans from banks after they've been originated. Conventional loan is the primary market. This is where loans are originated by lenders who lend their own money, right? Now, the lender has the final say. A conventional lender has the final say who they lend their money to, because it's their money. They could decide who they lend it to, right? But that doesn't mean that, since they're more flexible, that doesn't mean that they're going to lend their money to risky, they're not going to be making risky loans, okay, to people with bad credit scores or high debt to income ratio, or high debt to income ratios. Now, the maximum seller concession allowed is 3%. We wrote that in the book. Typically, when you get a conventional loan, they typically require a larger down payment, like 20%, but I have seen it as low as 3%. But anything less than 20% down payment required, that means the LTV is higher than 80%, may require or requires the borrower to pay PMI. What is PMI? That's private mortgage insurance.
Can you explain just the seller concession again? I'm not really.
Sure. A seller concession is, well, the word concede, like we have a presidential election going on. If one, like for instance, today, if Joe Biden says, "Hey, I'm the president," okay, there's a lot of disputes still going on. You think Trump's going to concede to that?
No.
Concede means he gives up and says, "Yes, you are." It means to give up. You're giving up something. So a seller concession, the seller is giving up money back to the buyer. Now that sometimes is used for either helping them pay the closing cost or towards repairs. But either way, the maximum seller concession, the maximum amount of money that the seller is allowed to give up to the buyer is 3%. Right? Good?
I understand.
All right.
Thank you.
All right. So this is actually a good slide that explains a lot. I got a lot that's explained on this slide here. Conventional loan directly between a lender and borrower usually requires 20% down payment. If the borrower puts less than 20% down, if the LTV is higher than 80%, they also have to pay for our PMI, private mortgage insurance. Now, what's private mortgage insurance? Private mortgage insurance, anytime the borrower puts less than 20% down.
But that's not always.
Yeah, if they put less than 20% down.
Not always. I purchased a property where I put 10% down and I got no PMI.
Was it a conventional loan?
It was a conventional loan. It was a condo though.
You better check your paperwork, because I'm pretty sure your lender charged you PMI.
Nope.
Because conventional banking theory says that a conventional lender is risking their depositors' money. If they lend you more than 80% of the value of the property, they are risking their depositors' money. That's risky lending.
Yeah,
and the lenders are risking their banking license by giving you a loan without covering that money. So I don't know what's going on there.
It
PMI,
falls off though, right? Once you reach 20%?
Now, so once your equity reaches 20%, PMI coverage can be dropped by the borrower's requests, but it's not automatically dropped. The lender, however, has to drop that PMI insurance when the coverage reaches 22%.
Now, does that work with FHA too, or no?
No, it's a little bit different. FHA has something that's called MIP. Now, let me first finish explaining what PMI covers. What does
Gotcha.
PMI insurance insure? It insures any amount less than 20% that the borrower put down. For instance, if you, here, let me go to this slide here. For instance, if you put down, let's see. If you put down 10%, so PMI insures any amount less than 20% that's put down, right? Insures amount less than 20%. Here, let me just word it this way here. Forget about me typing it here or writing it here. If you put down 20%, okay, you don't have to carry PMI coverage. But if you put down 10%, well, PMI insures any amount less than 20% you put down. So if you put down only 10%, PMI coverage insures the other 10% that you didn't put down. Does that make it clear?
Yes.
So PMI only insures up to 20% of the loan. If you put down 5%, well, PMI insurance will insure the other 15. Okay, so this is what PMI insurance covers. It's not insurance for the entire loan. It only insures that 20%, or the amount less than 20% that the borrower did not put down. That's the whole purpose of PMI, because in the banking industry, if a lender loans you more than 80%, if the LTV is greater than 20%, the LTV is greater than 80%, that means that they're lending you, you don't have to put down 20%. That means that you got to carry PMI insurance to insure that amount less than 20% that the person put down.
Could it be that maybe I purchased a property that was worth a lot more? So say I purchased a property for $250.
It still works. It still works out the same. It still works out to the same thing, unless the loan that they gave you was not using their depositor's money. If you went to that conventional lender and they loaned you their own money, then they have more flexibility in what they do, because it's their own money anyway.
Mm-hmm.
This only applies when when conventional lenders are lending their depositors money. If they actually took the money out of their own pocket to lend you, well, then it don't matter. But when they're lending other people's money, which they usually do, they got to have this PMI, because otherwise they're risking. Well, what if you default on the loan? How's that money going to get paid back?
Foreclosure?
Really? What if the value's not there?
It is.
What if it isn't? You know,
Yeah.
It's not a risk that they could take with somebody else's money. If it's their own money they're lending, that's one thing. But if it's somebody else's, they got to carry that PMI coverage, because that 20% should be enough cushion for the difference in value. Okay. So when can PMI coverage be dropped?
And the equity is over 20%.
Yeah,
And when must it be dropped by law?
when the equity is greater than 22%.
Correct. And
Now, are we talking about equity or are we talking about loan?
No, we're talking about equity. Okay. Look, when you first buy a house, your equity is equal to your down payment.
Mm-hmm.
So equity can go up in several ways. Market values can go up. You could pay down the loan. You could do improvements that raise the equity. Okay. So when equity reaches 20%, it can be dropped at the borrower's request. However, the lenders may have a little different ways on how they go about determining the equity. And then when it reaches 22%, the law requires that they drop it.
Would you request that a homeowner that wanted to get rid of their PMI got an appraisal? Then bring that to their...
Yeah, but appraisal is not always required. They could get a BPO. They don't have to pay a couple $100 for an appraisal. BPO could also serve that process from a broker. You know, but it depends on the lender. It depends on the lender. A lot of times the lenders, though, they'll order a BPO. Basically, there's agencies that reach out to real estate companies and have agents that'll do BPOs in exchange for a fee, right? I've done plenty of them. I've done hundreds of them, you know, for the banks. Okay, so it does not. It's not like PMI is not life insurance, and it does not insure the entire loan either. It's only insures that amount less than 20% the borrower put down, as I just drew and explained. Okay. Now these things, though, these are things that you guys will be getting on exams. You got to understand conventional loan, portfolio, conforming loan. Well, conforming we're going to get in the next chapter, but I explained it already. The maximum seller concession allowed for a conventional loan, and when PMI is required to be carried, and when it can be dropped, and when it must be dropped. These are all on exams. All right, here's a few portfolio lenders that I added here. So for to start your, in old world speak, your Rolodex, contact manager, what have you. All right. Look, if you have a borrower, they're a solid borrower. They're not. It's not that they got a crap credit score because they can't get a loan because their credit is screwed up. But if you got a solid borrower, but they just don't meet most lenders' guidelines in order to qualify for a loan. For instance, I got one friend. I had a problem getting him a loan. The guy owns a bar. He's a fireman. He owns 15 properties. His credit score is 840. Never late on a mortgage payment, but he couldn't get a loan for a $200,000 house, 2-family house that he wanted to buy. Because a lot of lenders out there have certain lending guidelines. If you own more than 3 properties, then you don't qualify for this type of loan. You know, there's all kinds of different lending criteria by different loan programs. So he couldn't fit into most of them. And then a lot of them said that his debt to income ratio was too high.
That's what I was about to say.
Now, his debt to income ratio, I mean, the guy makes a lot of money. It's just that when you're an investor, you try to look for as many tax write-offs as you possibly can so that you pay less taxes, right? You guys are going to be self-employed now for tax purposes anyway. You're going to be getting that 1099 at the end of the year for any income that you make. So when you earn a commission, your broker doesn't take out taxes. They're going to be paying you your full gross commission. You know, you're going to have to remember to put some money to the side because you're going to have to pay the tax man at the end of the year. But how could you lessen the amount that you have to pay to the tax man at the end of the year?
Tax
Well,
write-off.
you could have write-offs. Exactly. You got to keep track of your business expenses. Like the fee that you paid for this class is this not a business venture for you?
Yes, it is.
It is. So you could write this off on your taxes next year. The state exam fee you pay, the school exam fee you pay, the licensing fee, the MLS, any marketing or advertising you do, any tools that you need for real estate. You need a new cell phone or laptop to do the real estate. Well, those are all going to be business tools, right?
Mhm.
Tax write-off, tax write-off, tax write-off. Hey, if you guys want to take a class, oh, but they're offering that class in Vegas. Now that's a business trip. The entire business trip is right off your hotel, airfare, food, meals, just not your liquor bill. All right, because it's a business trip, right? You can write things off like that. So anyway, he had too many write-offs because the guy was cheap. I understand he's an investor. Investors, you want to pay as little taxes as possible, but the guy is so cheap. Ask me, how cheap was he?
How
cheap
cheap was he?
There we go. He was so cheap that when he goes to Home Depot and he sees a receipt on the ground, he picks it up and writes it off on his taxes.
Oh, that's
Oh
trifling.
my goodness.
That's cheap. So, I mean, to that extent, I mean, it was looking like any lender that looks at his tax returns, they're like, it looks like you're spending all the money you're already making. Where are you going to have the money to pay us for the loan? So because of that debt to income ratio being so high like that, nobody would lend to him. So I took him to a portfolio lender. Now, a portfolio lender, sometimes we call it real world decision making, because they're lending their own money and they examine every loan on a case by case basis, not by some third party's lending guidelines, arbitrary lending guidelines.
So is that something like a?
Instead, they look at the individual situation. They're like, okay, let's look at this guy for a second. First of all, he's got a phenomenal credit score of 840. Always pays on time.
Yeah,
for everything.
So my bank's Santander, so maybe that's why also.
Okay, Santander is a portfolio lender, but typically they don't do the conventional loans to that use their own money. Typically, they don't use their own loans for small, like little investors like you or I. They do typical large projects, like if they're building an apartment complex or high rise or something, they would be a portfolio lender for those projects. But even though they may give conventional loans, they may, but typically I think I've seen them more with the larger types of loans. But still, yeah, that could be it could be possible that they lent their own money to you, and that's why they didn't charge you PMI. Because typically with conventional loans, PMI coverage, 20. If you don't put down 20%, you have to pay it. But take a look at your paperwork. They may have snuck it in there somewhere.
All right,
All right, so
I'm gonna send it to you.
so it says how to find a portfolio lender. Well, this is just some information that I threw in here. It's some common sense stuff. If you ever drive by a construction site for any large construction projects and such, and it said they got a banner up there that says, you know, this project was funded by, and then they have the name of the lending institution. Well, that's a portfolio loan. I guarantee it, because there is no standard lending guidelines that would fund a project like that. Okay, if it's a single family house, it's one thing, but you know, if it's like a large project, those are always portfolio lenders lending their own money for it. So here's a short list of portfolio lenders that are local here. RSI, that's Rawway Savings Institute, Amboy Savings Bank, PPAC Gladstone, a savings bank. By the way, anyone know PPAC Gladstone is actually the name of a town in New Jersey too. Provident Bank, but don't owe them money. You owe them money. They'll chase you to the end of the earth to get it. Unity Bank, Columbia, and Santander. All right. This is just a little list I put together for you guys to help my class out a little bit in advance. For people who are not risky, however, they just don't conform to most lending guidelines, so you're having a hard time getting them a loan. Don't take people with piss poor credit scores to these guys. They're not going to lend their own money for that. They're not going to risk their own money. They have more flexibility for those who they think are low risk that just don't qualify for loans elsewhere for different lending programs. Got it? All right, so FHA, what is the FHA? Okay, well, let's first finish highlighting on page 243. Go down to the third line and highlight with any down payment less than 20%, a conventional loan must be accompanied by PMI, private mortgage insurance. Then the next paragraph, at the end of the line, we're going to highlight lenders drop PMI coverage at the borrower's request when equity reaches 20%, and that the coverage be dropped automatically when it reaches 22. And then if you want a definition of equity, underline it so it doesn't look like one just constant run-on sentence here. Equity is the difference between the market value of the property and the amount still owed on it. And after that, let me just read it. It says a new appraisal may be required. In some cases, the lender may accept instead of BPO to determine what that equity is. Highlight BPO, broker's price opinion. It's kind of like a CMA, but it's got more math in it. It's got more information about the market conditions and such. You could highlight BPO, broker's price opinion. This is a written estimate of value that resembles a CMA, comparative market analysis. It's like an advanced CMA though. We usually only do that for banks. Turn the page. Make sure though that your CMAs and BPOs say on them, this is not an appraisal and should not be considered as such. Usually we have that at the bottom of every page to appease the appraising industry so that we don't get sued again. All right, FHA insured loans, page 244. That's what we're at now here. And we're gonna highlight the FHA, Federal Housing Administration. Neither builds homes nor lends money itself. Rather, it insures loans on real property made by approved lending institutions. Then go to the line just below that and highlight it does insure the lender against loss. And then the line below it, highlight a loan that is not made by the agency, but insured by it. So the FHA does not insure, the FHA does not make loans. It insures lenders against loss. So FHA has their own lending guidelines. They say, here are our lending criteria for the buyer, and here are the lending criteria for the properties that a buyer could purchase that we're willing to insure. If the buyer and the property meet these lending guidelines, local lender, lend them your money, and the FHA will insure you against loss. So if that buyer defaults on the loan, then we will insure the entire loan, That's different than PMI. PMI insures what? Just the amount less than 20% that they put down.
A bit less, yeah.
FHA insures the entire loan amount. So insures the lender against loss altogether. All right.
Don't FHA have like upfront upfront mortgage insurance premium?
Right here. Requires an upfront mortgage insurance premium called MIP. That's charged at closing. But check this out. You don't have to pay it at closing. You could actually finance it into the loan itself. Welcome to the efficient government. You have to pay upfront insurance to get this loan. But you don't have to pay it up front. You could actually add it into the loan itself. That don't make a lot of sense, does it? Well, welcome to the efficient, not too bright governments that we have. All right. Next paragraph, next to last sentence, we're going to highlight they require low down payment. So why does anybody get a FHA loan? Because it requires a low down payment. That's the main benefit of it. Low minimum down payment requirement of only 3.5%. It's a 96.5% LTV.
And subprime credit score.
Well, here's a little interesting factoid. Even though in the book it'll say in order to get qualify for an FHA loan, minimum 620 credit score is required. Not true. FHA does not have a credit score requirement. And it has none. FHA does not have a credit score requirement. The local lender does. And the local lender's credit score requirement is 620, because anything below 620 is what we call subprime. That means that's not a good credit score. That's going to be a very risky loan. For anybody less than 620 credit score, that's a risky loan to make. But look, I've had lenders give FHA loans to people who had a 580 credit score. That's risky. You think they're getting the but those lenders then, if they're going to give that loan, they do require a higher down payment.
And the stipulations to clear the loan, to get the clear to close, is crazy.
And they're not going to get the best interest rate.
No, they won't.
Not at all. So let's see, next paragraph, FHA 203B is the most common FHA loan. FHA has a lot of loans. They have fixed rate loans, adjustable rate loans. They've got home improvement loans. They got a lot of different loan programs. This next one, FHA 203B is the most common FHA loan they have. So let's highlight the most widely used FHA mortgage is the FHA 203B, which may be placed on 1 to 4 family residences. Okay, you see it's FHA-B, most popular loan. Loans for purchase of owner-occupied 1 to 4 family homes. You could only have one FHA loan. Is FHA for first-time home buyers only? No.
No.
This could be your 10th home that you ever owned in your life, and you could get an FHA loan. However, you could only have one outstanding FHA loan at a time, because it's meant for owner occupants. It's not for investors. FHA loan is strictly for owner occupied homes. So the next paragraph, let's highlight an upfront single mortgage insurance premium MIP is charged at closing. Next paragraph, highlight the FHA allows any or all of the down payment and closing costs to be a gift, not a loan, from the borrower's relatives. See, I got that here. See, all these points I'm having you highlight, I got here in this slide too. So any or all of the down payment and closing costs may be a gift, not a loan from the relatives. How come a gift and not a loan? Well, because if it was a loan, then they would have to factor that into your debt to income ratio as well. And it could affect your ability for how much you could borrow again. Okay?
It could kill the deal.
It can. So look, if your relatives are giving you money to help you out with the down payment or closing costs, or lending it to you even, well, the FHA is going to require that they sign a document stating that it is a gift and not a loan, and it does not need to be paid back. So if it is a loan, those relatives better be trusting. Right? All right. In that same paragraph, at the end of the line, highlight seller's concession may not exceed 6% of the loan. And I got that up here. Maximum seller concession of up to 6% of the loan amounts permitted. It's not 6% of the purchase price, it's 6% of the loan. Now, in addition to that one-time upfront MIP mortgage insurance premium the borrower pays, they are also going to pay a monthly insurance premium of 1.55% of the mortgage amount. So every month, they're going to be paying a mortgage insurance premium. Now, 1.55%, well, it depends on how much money they put down when they bought the house, etc. But why do most people get an FHA loan? Low down payment requirement. So most people will just put down the 3.5%. However, you can put down a lot more. But if you do, why not just get a conventional loan? Conventional loan doesn't have all the stipulations an FHA loan has. You know, you can't get an FHA loan if the paint on the interior or the exterior of the house is cracking or peeling, if the steps are loose or if the railing is loose. The appraiser that does the appraisal for an FHA loan has to check to see, like, if you have a dishwasher in your kitchen, they actually got to run it through its cycles. I mean, they're not a home inspector, but they got to run it through its cycles and make sure that it works and it doesn't leak. The house has to have a stove in it. If you don't have a stove, you're not getting an FHA loan. Why does FHA have all these requirements or these repair requirements? They want to make sure that the house is in livable condition, that you could move into it and actually use it. Look, they figure they're looking out for the borrower. Even though we get a lot of borrowers that don't have a lot of money, and a lot of them, you know, they could do work themselves. They're willing to fix up the house themselves and buy fixer-uppers and stuff. However, the FHA won't allow it. You can't buy a home with a typical FHA loan that needs work. If it needs work, the reason why you're getting an FHA loan is because you don't have a lot of money to do repairs. So where are you going to get the money to do all the work? The FHA figures that they're looking out for the homeowner by having this repair requirement in place. Now, the FHA does have another type of loan for homes that need repair, okay? But that's a different type of loan altogether, where it's a home, we'll get into it. It's a home improvement loan. That's called the 203K. 203K, K for construction. I know it's not spelled that way. But it's not a construction loan, it's an improvement loan. But let's first finish going through this, your typical FHA loans, okay? The next paragraph says the FHA requires that most borrowers who make less than a 10% down payment continue to pay annual premiums for the, oh, they finally upgrade, finally, they fixed it. I was always harping that they put the wrong information in the book. Actually, no. Okay, so the FHA requires that most borrowers who make less than 10% down payment continue to pay the premium for the life of the loan of up to 30 years. The only way to cancel the MIP is to pay off the loan or to refinance. Okay, well, check this out. If the borrower did put down at least 10% at the time they got the loan, can the insurance be dropped on an FHA loan? Yes, if equity reaches 78%, but only after 11 years. They didn't put that detail in there. So the insurance that on an FHA loan can be dropped. Let me see, do I have a note about that here? Yeah. MIP, mortgage insurance premium, can be dropped when equity reaches 78%, but only after 11 years. So you have to have the loan for at least 11 years. And if you manage to pay off most of the loan, 78% of it, it's kind of the reverse of a conventional loan, right? With a conventional loan, for their PMI coverage, it can be dropped when equity reaches, or it must be dropped when equity reaches 22%, right? Over here, the insurance for the entire loan can be dropped when equity reaches 78%. But only if after you had the loan for at least 11 years, and only if you put down at least 10% at the time that you got the loan. Okay. Just making notes for the book manufacturer here to do some tweaking to the wording. All right, so everybody with me?
Yep, we're here.
Yeah.
Okay, because I was about to go take a nap if you didn't answer. All right, so let's see the so estimate of value. Not every appraiser can appraise an FHA loan. That appraiser that appraises an FHA loan had to take a class, a designation class, to be able to give the FHA loans as well, because they have to look out for special things. They have to make notes of special things, like looking out for chipped paint or cracked paint, or peeling paint rather, for loose banisters and cracked stairs and stoves and tested dishwasher. They got to look out for stupid stuff like that that normal appraiser doesn't care about. But these are things that they have to put in the appraisal statement for an FHA loan. All right. Under estimate of value, second paragraph, highlight FHA allows down payments as low as 3.5%. Minimum down. This is the highlight of an FHA loan. Only requires 3.5% minimum down payment requirement. Right? It goes on to say, and will consider applicants with credit scores as low as 620 in some circumstances. FHA does not have a minimum credit score requirement. The lender does. So that's wrong. I'm going to submit that to the book manufacturer. Highlight FHA borrowers are allowed to finance a portion of their closing costs. So look, even the closing costs, not just the mortgage insurance, but even their closing costs can be financed into the loan itself. Wait a minute, what? Typical closing costs are 2 to 3% of the purchase price, but it could be more with an FHA loan. So is it possible that if you're financing in your MIP and the closing costs, that the lender is loaning more than 100% of the value of the home? Yes, it is. Even when you're putting down 3.5%, if you're financing in the closing cost and the mortgage insurance, that if it equals more than 3.5% for that down payment, it's making up now. They could be ending up lending you more than 100% of the home's value now. All right. Go to the last sentence in that section and highlight the FHA sets top limits on its loans, depending on price levels in different areas of the country. And I want you to write at the end of that line at the bottom of the page, by county. By county. See HUD website, HUD. So the FHA has lending limits on how much they'll loan you, depending if it's a 1, 2, 3, or 4 family house, and depending in what county that house is in. Here, I have links here directly to the HUD website. Here is one for their lending limits. And by the way, if you're buying a condominium with an FHA loan, the condo complex has to be approved as well. Making sure FHA has minimum construction standards. Otherwise, they won't lend money if the builder didn't use their minimum construction standards. But they also have other requirements for condos, like the majority of the units there had to have been sold already, and the majority of the units have to be owner occupied. If they're not, majority of units are not owner occupied, you're not going to get an FHA loan to buy in there. Once again, the FHA is looking out for you, because if most of the units in the complex are not owner occupied, let me ask you a question: who takes better care of the home, the renter or the owner?
Owner.
That's a no-brainer, right? So the FHA thinks that way too. They're like, well, if the majority of the units here are not owner occupied, what do you think is going to happen to the values in that complex over the years? They're not, because the renters don't take as good a care of it. All right, let me click on this and open up. Got to minimize it in order to open it. Hold on one sec. All right, let's copy and paste it. Here's the HUD website, by the way. Here's the HUD website, HUD.gov. Any other, look, there's a lot of fake websites going on out there that's like, it says FHAVA.com, HUDloans.com and stuff like that. That's all fake. Has nothing to do with HUD, has nothing to do with the FHA, okay? This is the FHA's website. It's actually at HUD, the Department of Housing and Urban Development. Okay, here's the link up here. So here is the FHA mortgage lending limits. Here's where you could find out what the maximum in any state, in any county. It goes by county. So let's look up New Jersey. And you know what? That's the only information we're going to put in there, sorted by county. We're not even going to put any other info. You could put the info in there and just get the info back for that county. I'm going to just put that in. We're going to get the list of everything in New Jersey. Okay, here is the list of all the counties in New Jersey. You guys see here 1 family, 2 family, 3 family, and 4 family. They tell you what the median sales price is in the county there, when it was last revised. And here is, so these are the maximum that they will loan you in Atlantic County. Okay, this is one of the lower cost counties, whereas Bergen is one of the more expensive counties. For a single family home, they'll lend up to $765,000 versus the $331,000. See, different counties have different price ranges, right? So the FHA will lend different amounts. They have maximums that are set by county. So it depends where the property is located. Yeah, here's Middlesex County. For a single family home, $765,600. For a 2 family, for a 3 family, for a 4 family. That's the maximum that they'll lend. Of course, the borrower got to qualify for it too. Union County, $765,600. It's pretty much the same. So I think the more expensive counties all fall in that $765,600 range, right? But as you can see, there are lower cost counties. I think the lowest cost counties are in this range right here, the $331,760. That would be Atlantic. You have ones here in 408. That's lower still. But still, I mean, these are expensive homes. They're still kind of generous still, though. Cape May, I figured would be more expensive than that, but I guess they go by the median. All right, there's your guide. So the FHA has maximum lending limits for 1, 2, 3, and 4 family, depending where the county, where the property is located. You guys just eating this up and observing it, and that's why you're so quiet?
It's interesting.
They also have, FHA has approved condos. I have a list here where you can look it up. But look, if the condo complex is not listed here, you could still get an FHA loan, even though the condo may not be listed here, as long as they use the appropriate, as long as they use the right construction materials, their minimum standards, that complex could get approved if it's not approved. And those approvals have to be renewed every 20 years, I believe. Here's a little factoid. You want to see something interesting? Here's the FHA website again on HUD. Let's look up New Jersey for condominiums, approved condominium complexes. Let's do this. We're going to look up Middlesex County. Okay, here's all the towns in Middlesex County, okay? Well, not necessarily all the towns, but all the ones, I guess, that had condos that were sent in for approval. See how this one was approved, but then it expired? This is in Fords. They had an approval that expired. They just need to renew it. So 20 years must have gone by, and since their last FHA sale there. So they just need to renew it. This one looks like they in phase 3 of construction. So this one, market rate units, low and moderate income units. Okay, so this complex here in Piscataway, the last time that they applied for it was in 2012 when they were building it, and then they withdrew. They didn't go through with it. This one is rejected because of insufficient cash flow, you know, to maintain the complex, missing or incomplete document submissions, you know. Look, I've sold a lot of condos in my time, and a lot of them were in Middlesex County. Hell, a lot of them were in Edison. Check this one out. Edison has a lot of condos. Currently, there are no approved complexes in Edison for FHA loans. Not a one. Because a lot of them expired and they never renewed it. But what you could do is, if I got a buyer now that wants to buy a condo and an FHA loan, we could get it reapproved again, the whole complex, and then it'll reflect in this database as approved. All we got to do is get the management of the complex, the HOA, has to submit their financials and fill out an application, which then we submit to HUD, and then it goes to them for approval. Or actually, we submit to the lender submits it to HUD, and they can get the reapproval. So it can get approved still. But interesting. So I'm giving you these databases and these resources, which, by the way, are not part of the normal class. You're welcome.
Thank you, Victor.
You're welcome. All right. So, but it is important because, you know, they teach you this FHA. They pound this stuff down your, they shove this stuff down your throat, and then they don't tell you, you know, well, you can't get an FHA loan unless the county is approved. It depends on different areas in the country, different loan amounts. I'm showing you it's based on county and where to go to check it. Okay. So you don't waste your time showing people properties when you know that they're not going to get a loan in certain counties for certain amounts. It's not that even though they got an FHA approval, it's not for everywhere. It depends. It's those amounts vary depending on the county where you're shopping. Okay. So I'm saving you time. So anyway, those were all the rules for FHA. And before we move on to the VA, that's not all the rules. Okay, so we have the repair requirement, which I told you about. And on page 245, the repair requirement, they do have a minimum repairs requirement that's allowed. So do home sellers have to accept FHA loans?
No, they don't.
No, they don't. They can dictate what kind of financing they could say cash buyers only. Or they could say cash and conventional. They don't want FHA because FHA has a repair requirement that they're always going to be ball busting the homeowner to fix up the house in order to get the loan.
Yeah, I've heard a lot of sellers try to shy away from people with FHA loans.
Yeah, I mean, but look, I mean, FHA loans, if your house is not in bad condition, then I wouldn't worry about it. I mean, or not necessarily in bad condition, but you know, there's certain kinds of repairs that the FHA is looking for, and the homeowner's realtor can guide them as to whether they think it's going to apply to the FHA, if the FHA is going to have a problem with their home or not. And if you don't think that it will, then just put it down there that for the listing, you know, that the homeowner is willing to accept the FHA, conventional, cash, you know, VA, you know.
If I was a buyer and I saw that a seller didn't want an FHA loan, I would think there's something wrong with the house anyway.
Well, you know what? I'm going to tell you right off the bat, there's something wrong with every house.
Yeah.
I don't care if it's new construction.
You're right.
You know, just here, you want to make sure, get a state inspector to go in and look at new construction. Bet you they'll find you 10 things that are wrong with it. Yeah, I've been into houses that are new construction that didn't have a right angle in them.
Gotta hire Kurt.
Yeah, well, no, he works for the state, but he doesn't do side work. They're not allowed to do that. But yeah, you get inspectors like that they'll find something wrong with everything. All right. Occupancy requirement. I already spoke about that. Under occupancy requirement on page 245, we're going to highlight borrower must intend to occupy the property. Okay. Once again, no prepayment penalties are charged for FHA loans. Oh, excuse me. No prepayment penalties allowed in New Jersey, period, anyway, right? Assumability. Older FHA loans can be assumed by the next buyer. That means that the loan can be taken over. Somebody can just take over the payments. However, new rules in place, newer FHA loans, they still may be assumable. However, the buyer, the person who's assuming the loan, taking it over, has to qualify for the loan. See, older FHA loans, the buyer did not have to qualify for the loan. They could just take over the payments. So it was actually kind of easy to sell a home that way. You don't think that's easy to sell a home? What do you guys think? Would it be easy to sell a home? Let's say that I'm selling my house and I have, let's see, I got $50,000 of equity in the house paid down on the value of it so far. So I'm going to want you to take over the payments on the loan and give me 45 grand. I'm basically giving you the house with an extra 5,000 equity built into it. Would that be easy to find a buyer to take that over?
Yeah.
Oh, yes.
Yeah. If it's assumable, right? Even though a lot of people these days, they don't try to assume loans. They want to get their own. Well, the loan is assumable. All right. Under other FHA programs, go to the third paragraph and highlight FHA section 203K, K for construction. Mortgages allow one loan to cover both the purchase price and extensive rehabilitation work. These are rehab loans. Now, section 203K mortgages may also be used for refinancing. So if you already have a loan on your house, you can get a FHA 203K loan. You could refinance it into an FHA 203K loan. Basically, it'll pay off your current loan, and then they'll give you additional money to do improvements on your house. So you don't have to initially buy a house with a FHA 203K. You could, if you already own a house, you could refinance using an FHA 203K loan as well. What is refinancing? I don't think I ever spoke to you guys about that. I'm not sure. When you refinance, yeah, I think I did actually. When you refinance, you're getting a new loan that's going to pay off your old loan. Why would you do that?
For a lower rate or to take money out the house?
For a lower rate or to take money out, to drain the equity, right? Which hopefully is also at a lower rate. Well, or what about for construction?
That too.
That we just learned, right? Now 203K, that's interesting. So it says they give you one loan to cover both the purchase price and extensive rehabilitation work. What is considered extensive rehabilitation work?
Construction.
All right, so basically they'll give you one loan to buy the house and another one, like if you need to remodel the kitchen or you want to put an addition on the house, right? They'll give you a loan for that. I'm gonna show you something. Hold on. You guys will get a kick out of this. Maybe. I gotta go take another picture of this. This is right around the corner from my house, actually. Got it somewhere. Where are my damn pictures? That picture. This is 3. I cannot find these things. Okay, here we go. There's a home around the corner from my house. They use an FHA loan, an FHA 203K to buy it. I'm opening up some pictures to show you. Give me 1 second while they open. This is what they did to it. The only thing remaining, they tore down the entire house except for the chimney and the garage. You guys see that?
Yeah.
Wow.
I got it a couple different angles. Look at that. There's no house here. This is one side wall, which they eventually tore down. They just left the chimney and this.
Did they do that just to keep it from being like a new construction?
It's exactly what they did. Okay. It's an old builder's trick. Here, I zoomed in on this a little bit. See the wall and the chimney and that. What is considered extensive rehabilitation work?
That.
Yeah, apparently there's no limit on that, right? As long as you leave one original wall standing on that house, you could build a whole brand new house around it. And that's what they did. And not only did they build a whole brand new house, they actually had a backhoe in there and they doubled the depth of the house. So they actually dug out a basement that started to fill the yard now too. That house is twice as deep as it previously was.
Damn.
So they doubled the footprint of the house too.
That was smart.
And they used an FHA loan for that. Hold on, I got some newer pictures as they started building the house. It's a little bit, it's almost done now, but I got to get some newer pictures. But here's some pictures
my
of
God.
it as they're working on it. They're still working on it.
They were able to do that with an FHA loan, being that FHA don't do new construction. So they,
It's not new construction.
it's not.
It's
'Cause
a rehab.
Wall, yeah, extensive rehab.
Oh my gosh.
Here, look at this. I mean, here, look at this house next door and look at this one now. This used to be the same exact house. It was the same exact house.
It's a upstairs, downstairs, like it's like a whole.
It's got a full level upstairs with an attic there. See this second floor here, there's no attic above this. It's just the second floor. So this is full usable space. So this is double the space here right away. Not counting that the depth of the house. Look at this. Look how deep this house is. They doubled the width of the house.
Right.
Oh, actually, they ended up knocking down that chimney there too. They must have put up a chimney somewhere else. I got to take a look where they put it. The only original wall that they left. Oh, the reason why they didn't knock down that wall with the chimney originally is because that's where the electrical wire was going. You see where they got it here now?
Yeah.
Okay. That's the main electric wire to the house. But the only thing that's original is this garage.
Look at it. It's so small compared to the house.
Well, it looks like that, but yeah, you could fit a car in there. You could fit a full-size car. It's a regular size garage. It just looks tiny compared to the house because they put this giant monstrosity there.
Now that's a hell of a loophole.
It is. It is. It's an old builder's trick. Because guess what? You could do this even if it's not an FHA loan. Any kind of construction you could do this for. Look, obviously they weren't done with this house yet because look where the old steps were for the front doors of the house. It's not where the new front door is.
Lined up.
It's not lined up yet. Well, I think they fixed that already. But
Did they finish it? Do you have a current picture?
I got to take a current picture. Maybe I'll run out during lunch and snap a picture of it to show it to you guys.
What street is that on? I want to drive by it.
It's on Thelma Terrace.
I know where that is.
Okay. Interesting. But I'll snap a picture of it. They're still not done with it, but I'll snap a pic. I'll go snap another picture of it. I've been meaning to.
3K.
But check this out. On tax records, this house, if this original house was built in 1950, guess what? It's still showing that this house was built in 1950.
Because that one original wall.
Because of the one original wall here, the garage, right?
Yeah.
Because the house and the foundation, part of the foundation anyway. So this house is still showing in tax records as 1950, renovated in 2020.
Hell of a renovation.
Because the building department and the tax department down at City Hall, they don't communicate with each other. So they may not even catch on that this house had all these improvements for a couple of years at least.
The taxes go up though, right?
Why would the taxes go up? As far as the
I'm just
taxman
saying.
is concerned, this house is still sitting there.
Oh, that's true, yeah.
They just did some improvements. What kind of improvements? What, they remodeled the kitchen? Right?
They built a whole new house.
They built a whole new house. It's a builder's trick. They've been doing this stuff for ages because they know that City Hall's stupid.
Oh, that shit is cool. I like that one.
That's funny, ain't it?
Yeah, but when they get caught, I mean, they're eventually gonna look, I guess, right? Or the neighbors gonna say something.
But they
No.
can't catch them with anything because it's still they have that original standing wall.
It's the
No, and I get it, but I'm saying it's like,
well, the
I
building
mean,
department's
it's a whole
aware.
new house.
That's
You
okay.
know
The
what I
building
mean?
department's aware of it because the building department's giving the permits for it. They're doing the inspections on it.
Oh,
And the
got it.
building department and the tax man, who are usually across the hall from each other or next door their offices, they don't talk to each other.
Oh, that's true.
So if the home doesn't get reassessed as new construction, well, it's not new construction. It's still shown as 1950. It's just renovated. And to what extent? Well, if they don't get an appraiser, if the city doesn't send an appraiser there, and why would they? Then it never gets reassessed. It never gets revalued.
That guy got all.
Yeah,
What town is this in?
that's Linden. But it happens everywhere. It happens everywhere.
One.
So you own a house and you want to do some improvements on it? You want to get an FHA 203K?
Maybe.
All right. Oh, wait, actually, one more thing with FHA loans. The last paragraph under other FHA programs, let's highlight for either an FHA or VA loan, an extra amendatory clause must be included in the contract that states if the property appraises for less than the agreed upon sale price, the buyer is not obligated to complete the purchase. I like that. And what are they basically saying? They could get out of the contract without penalty. Right? Actually, you know what? I wrote those words on my book right after there. You don't necessarily have to, as long as you understand that's what they're saying. But I wrote it in mine. Can get out of the contract without penalty. That's what that means.
Wow.
And there's everything you need to know for FHA. I have it here on one slide, one convenient slide to study from.
Good.
Okay. Good note. All right, VA loans. VA is the Department of Veterans Affairs. VA loans are only for veterans. And they are only for owner-occupied homes. So it's intended for veteran owner or co-owner occupied. So at least one of the owners has to be a veteran. Or the relative. If you are the unmarried spouse of a deceased veteran, you could also qualify for a VA loan. If you did not get remarried, you still qualify for your spouses, your deceased spouses who was the veteran, you qualify for their veteran benefits. So it's intended for veteran owned or co-owner occupied 1 to 4 family dwellings. The VA guarantees the top 25% of the loan to the lender. In the event the borrower defaults, they're going to pay that lender 25% of the loan. And because of that, it's as if the borrower put down 25%, so the lender doesn't require any down payment for a VA loan. Now, the VA, just like the FHA, does have their lending limits that vary by county. However, these are New Jersey's lending limits. Lower cost counties up to 424, higher cost counties up to 726 for a single family home. And then, 2, 3, and 4 family are higher, just like with the FHA program there. I have links down here where you could find out what those loan limits are. However, you have to actually put an address of the property in there to get those loan limits. I can't just like pull up the whole list for everybody. So I'm not going to go to the website again. But here are some websites where you can get more information about VA loans and VA benefits for veterans. And then I have a little note here too about a movie about veterans or for military personnel. I'm shocked. Maybe I'm just old now. I don't know. But there's a lot of people we get that are younger to take this class that never seen the movie Stripes before. If you never watched it, it's a funny as hell movie. It's called Stripes. It's an old comedy. It's not like black and white old. It's a funny movie. It had Bill Murray in it. So it's called Stripes. If you never watched it, put it on your list there to watch. It's a funny ass movie. All right, moving along. The appraisal for VA loan has it's not called just an appraisal, it's called a CRV, Certificate of Reasonable Value. The way a lot of people, I get them to remember it is I just say, remember the car, Honda CRV. And for some reason they remember it because of that. I don't know, it's just the way our minds work, I guess. But this is an exam question often. what do you call the appraisal statement for a veteran's loan, a VA loan? CRV, or Certificate of Reasonable Value. All right. Now, discount points may be paid by the seller, the buyer, or shared by them, just like with an FHA loan. Funding application fee. Okay, so the veteran has to pay an application fee, which they refer to as a funding fee. However, that funding fee can be paid by the borrower or the seller, and that amount would vary depending on what kind of veteran they are. So basically, the eligibility requirements, which, by the way, when we just had our voting in New Jersey, you saw something on the ballot for this on the separate for veterans who did not serve during wartime, trying to give them the full benefits to the veterans. Well, you know, those people, veterans who did not serve during wartime, they still get the full benefits if they served long enough. They're trying to do away with the time requirement for being a veteran to qualify for all the veteran benefits, which I'm not sure why they're doing that. If you didn't serve during wartime, you should serve a longer period of time to qualify for the same veterans benefits as a veteran who's actually served during wartime, you know, but I don't know why they put that up on the ballot. So anyway, here are the eligibility requirements. It says you had to serve 90 consecutive days of active duty during wartime, or 181 days of active service during peacetime. So what you just voted for on the ballot for this last presidential election in New Jersey, they put on one of those side questions on the ballot. They want to do away with the 181 days of service during peacetime to be able to qualify for these same benefits. Is 181 days a lot of time? It's like a little bit more than 6 months. So they want to give you those benefits if you didn't even serve 6 months in the military? Shit, sign me up. All right, 6 years in the reserves or National Guard. But we see that we actually have a shortage of people in the military right now. So a lot of our reservists and National Guard members, we're serving overseas in Iraq and such. So even though that they are in the reserves or National Guard, they did serve active duty, so they would get, you go by this lower time here. And then loans can be assumed. Veterans loans are assumable, and the person who takes them over does not have to be a veteran. This is often a state exam question. Do you need to be a veteran in order to assume a VA loan? You do not. Do you need to be a veteran to get a VA loan? Yes, but you do not need to be a veteran to assume a VA loan. All right, guys. New Jersey Home Buyers Program. We have the NJHMFA. Okay, so let's highlight second line under VA loans. The VA guarantees the top 25% of the loan and no down payments required. Next paragraph, highlight only for owner-occupied property owned or co-owned by the veteran. Then turn the page. Y'all with me?
Yeah.
On page 246, 3 lines down, we're going to highlight a VA appraisal called a Certificate of Reasonable Value, CRV. Now that funding fee the veteran has to pay will be waived for wounded veterans. And guardsmen and reservists would pay a higher funding fee, unless they serve full-time during active duty. All right. So all those eligibility requirements are broken down in more detail here on this page. All right, go down to the bottom of the page where it says assumability and highlight any VA mortgage loan. Skip the date over there because it says made before March 1st, 1988. Just skip the date. Highlight any VA mortgage loan may be assumed by the next owner of the property who need not be a veteran. All right, I want you to skip the date because the date is only talking about basically any VA loan can be assumed by somebody who's not a veteran. It's just the dates that they're giving and date ranges here have to deal with, does the new veteran need to qualify for a loan or does the person who's taken over a VA loan have to qualify for the loan or not? Depending on the date of when the loan was and blah, 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 okay? So that's what that's getting into and we don't need to know that for exam. So we're just kind of skipping that. I just want you to highlight the pertinent information, which is a VA mortgage loan may be assumed by the next owner who need not be a veteran. And we got that here.
That just means like if you're selling the house, right?
Yeah, if I'm selling the house to you, you don't need to go get your own loan. You could just take over my loan.
Okay.
So, but I'm not going to have, you know, I got equity in the house. So you're going to pay me a portion of that equity or all of my equity and just take over my loan. Okay. So New Jersey Home Buyers Program, that's the NJHMFA on page 247. Highlight the New Jersey Housing Mortgage Finance Agency, NJHMFA, offers below market interest loans with low or no down payment to qualified buyers who purchase homes in urban target areas. In what areas?
Urban.
Urban areas. All right, so I got that here in a key point. What's an urban area?
Highly populated.
Densely populated area. Correct. See, I had to put that slideshow in there because sometimes when I ask classes just outright, you guys know what an urban area is? You should have heard some of the answers I get from people. All right. So, you know, putting in an explanation, you need to know what an well, you don't need, well, you should know, being in the property business, urban, suburban, and rural. All right. Let's see. So NJHMFA is the New Jersey Housing Mortgage and Finance Agency. They offer below market interest loans, that's low rates, with little or no down payment requirement to qualified buyers, not investors, only owner occupants who live in urban target areas. Now you could apply through these loans through a local approved lender. So you could go to the NJHMFA website and see the different types of loan programs they have. For the different loan programs, different lenders are approved to offer the different loans. So you have to go to specific lenders in order to get these loans. You can't just go to any lender to get a loan under these programs. They do have a first-time home buyers program, which I told you about yesterday, called the NJ Smart Start program. They'll give you one loan to buy the house and another loan for the down payment and or closing costs. That second loan's at a higher interest rate, but if you live in that house for at least 5 years, you don't have to pay any of it back. If you sell it in less than 5 years, you sell it in 4 years, you got to pay 25% of the loan back. Sell it in 3 years, you got to pay back 50%. Sell it in 2 years, you got to pay back 75%. Sell it in 1 year or less, you got to pay the entire loan back, which is at a higher interest rate. That's only for that second loan I'm talking about. That second loan is the one that's self-liquidating. Now, they got many different types of loan types. That Smart Start program for first-time home buyers, live where you work, off-peak hour workers to relieve congestion on the road. They got special loans for police, fires, and firemen and teachers. All right, and you can find out more about it. I gave you 2 links to resources here for the. Here's one link for them that's more consumer friendly. It's njhousing.gov or nj.gov/DCA-HMFA. Or nj.gov. Okay, so I got 3 links here for them, for you to get information about their programs. Okay. And in the book, they have just this link right here, I believe. And they have a phone number, 800 NJ House. Okay, we could even put that in here in this slide. Oops, sorry. We could even put that right here in the slide. 1-800 NJ House. All right, and now we have the Rec D. That's the former Farmer Home Loan Association. Let's highlight on the at the end of the first line, Farmers Home Loan Administration, FMHA, now called the Rural Economic Community Development, or REC-D. Okay, these are loans for people in low income and first-time home buyers. You could get interest rates as low as 1% on the loan. They're subsidized government loans. You could get an interest rate for as little as 1%. Now, these are for modest home prices. I'm not sure what that home price range is. I have some links here for you. They made it a little bit harder to find it. It used to be a guide there that you could look it up, but they redid the websites a bit, and I haven't spent a lot of time going through them, but here are the links for the REC-D. Okay, you get those loans through the USDA. It's for people who live in rural areas. So if you want to buy a house in a rural area, you could get a loan through the REC-D for as little as 1% interest rate. And 100% financing is available too. 100% financing with 1% interest rate. You guys listening to me? 100% financing with as little as 1% interest rate.
I'm gonna go live in the boonies.
So I'd rather live out in the middle of nowhere where my neighbor's not all in my business. I could have a bonfire in my backyard or ride an ATV. Right? I like to have a little more room living out in the country. But, you know, you got to take a little ride to go to the store.
That's only first-time homeowners, right?
No, low income and first time home buyers. But look, it's not necessarily just low income. It's not for rich people, but you can have moderate income as well. And you'll qualify for these loans if you're buying in rural areas. It's mainly loans for rural areas is the key part of it. I've had people get these before that were not poor. They weren't rich either, but they were not poor. They're moderate income. They do qualify for these loans if you're in a rural area. Now you could go, I think this link right here will show you a map. Once again, this one, what used to be a map that you could just pull up and just move around like a Google map. Now they require you to put an address in, and then it'll pull up the map and it'll show you what areas are considered rural or not. You know that the majority of Somerset County is considered rural? You know, Franklin, just on the other side of New Brunswick, you know, Franklin Township, just on the other side of New Brunswick.
Yep.
That's like city right there, isn't it? That's still considered, that's considered rural. You could get a loan there, 100% financing through the USDA. You don't actually have to be far away from there before they start considering it rural. The whole town over there, boop, rural. See, have mortgage reps who know the different loan programs, because you're going to have mortgage reps that are always just going to be pushing what they know. FHA, FHA, FHA. Get lenders, mortgage reps who study the different loan programs, who have connections at different places, that know about the VA and the FHA. I mean, you get some of these mortgage reps that they only know one loan program, so they always push it and they say, "Oh, that program's always better," you know, really. So I've had some of these lenders that said, "Oh no, you're better off with the FHA instead of getting a VA loan." I'm like, how's that? VA doesn't require any money down. How is requiring 3.5% better than no money down, right? they don't know what the hell they're talking about, or they try to give you some kind of BS story just to sell you the loan because they don't know anything about the other loan program, or it's too much work for them. They have to file some additional paperwork and they don't want to deal with it. Okay. Get a couple of lenders under your belt that you trust and do business with them. And then have them do some co-marketing with each other, right? Okay, that's it. Here's the NJHMFA. Here's that slide I made for you, which I explained to you, that program for the first time home buyers program called the Smart Start. Just got a breakdown for you. Live in the home for 5 years. You pay back 0 of that second loan. 4 years, 25%, 3, 50, 2 years, 75, 1 year, 100. Okay. There's a lot of people, a lot of times ask me about, are there any programs for first time home buyer programs? Well, some municipalities like Newark often have programs like that, where they're trying to sell property and push the ownership. Hell, I think there's some times during the year, every year, that Newark has certain programs where they give people land, but you have a requirement that you got to build a house on it within a year or 3 years or something. But here's the NJ Smart Start program where you get these loans, but you got to take a class that teaches you how to balance a checkbook and do some basic home repairs, and then you'd qualify for it. We have the Rec D once again. Here's a breakdown with some of those links. And that's the end of that chapter.
Are there any rural areas down the shore?
I don't, well, Ocean County does have rural areas, but it's not going to be by the beach. It's going to be inland a bit. Yeah, no, that shore property is expensive. So nah, I know what you're getting at.
Retirement.
I'll be there with you. All right, page 248. Let's do the key terms to review. There are 2 of them here. Let's do key terms to review for this chapter, and then we'll move on to oh, damn it, I closed the other one. And then we'll do the chapter 15, which we already did a lot of the stuff in it, but there's still things in there we need to do to learn. So key terms to review: low down payment insured mortgage loan. Low down payment insured mortgage loan. What kind of loans are insured?
FHA.
FHA 203B being the most common, 14 is A. Insured loan with monthly payments, including property taxes and insurance.
It's a regular loan.
What?
I'm calling it a regular loan.
Yeah.
That would be, what is it?
You got to know the other name. That
Oh, shit. Is it a
what's the
budget
type? What's a type of loan that includes the principal and interest, taxes,
Amortized
and insurance?
Amortized loan.
Amortized loan is just how the payments how the payment is done.
Would it be a budget loan?
It would be a budget loan. You could budget because all of your expenses, the property taxes and homeowners insurance are included. A pity loan is often referred to as a budget loan. So 8 is B. Right next to that where it says budget loan, write pity, P-I-T-I. A budget loan or pity loan are one and the same. Mortgage that can be taken over by the next buyer.
Assumable?
5 is C. VA appraisal statement.
Yeah.
Honda,
CRV.
12 is D. There you go. See, it works. Highest interest rate ever allowed on a specific adjustable loan.
The ceiling.
Ceiling, 11 is E. Payment of extra points in return for lower interest rate.
Wait, you skipped F.
I know. I'm going to back up. Well,
Okay.
let's just do this one. Payment of extra points in return for lower interest rate.
I down.
9 is
Oh,
G, correct. Listing of each payment, interest, principal paid, and the remaining debt.
That's the schedule?
Yeah, amortization schedule, 3 is F. States that the buyer getting an FHA loan can rescind the contract if the appraisal is lower than the purchase price.
13.
No, amendatory clause.
The amendatory clause, 2 is H. Percentage beyond which interest rate cannot be raised at adjustment.
Oh, that-
1, adjustable rate
Yeah.
mortgage.
Yeah. Well,
Cap?
Cap, 10 is I, 10 is I, the cap. A plan with interest rate changed either up or down periodically.
That's the M.
Adjustable rate.
That's adjustable.
Yeah, that's the ARM,
Mhm.
adjustable rate mortgage. 1 is J. A repayment plan including principal payments, gradually reducing the debt.
Amortized loan when it goes.
Advertised law.
4 is K, amortized loan, correct. A repayment plan, the equivalent of 13 monthly payments per year.
Bi-weekly. mortgage.
Bi-weekly mortgage.
Is L, the biweekly, 6 is L. A U.S. agency that insures mortgages to protect lending institutions.
Federal housing.
Federal
Fair housing.
Yep, the FHA, 13 is M. Written estimate of value by a real estate licensee.
A BPO.
A BPO, a broker's price opinion or BPO, 7 is N. Very good. Okay, key terms to review part 2. Charge for the use of other people's money.
Oh, that's the,
Interest.
Interest, 2 is A. A guide to national mortgage trends used for adjustable mortgage rates.
And, oh, no, that's.
Yes, that's tied to some sort of an index. 1 is B. The lender of low interest money in certain areas.
the New Jersey housing.
The NJHMFA, correct. 5 is C. Mortgage payments, including interest, amortization, and certain other expenses.
A straight loan.
Mortgage payment that includes the interest,
Kitty.
amortization, and certain expenses.
Kitty.
Pity.
Mhm.
6 is D.
D.
The straight loan is interest only.
Okay.
So 6 is D. A mortgage with payments of interest only.
There you go.
9 is E, the straight loan. A loan guaranteed by the federal government.
It's a VA
A
mortgage.
VA
It is.
mortgage.
11 is F. The VA guarantees 25% of the loan. So 11 is F. The FHA insures loans, the VA guarantees them. Neighborhood in which the state wishes to strengthen housing stock. It's a weird way to word it.
Target area.
Target area.
10 is G, target area. 1% of the loan amount charged as an extra upfront interest when the loan is made.
Points.
A point.
7 is H, the point. Percentage charged by the lender above the index.
A margin.
4 is I, margin. Percentage of property's market value that may be borrowed.
Loan to value.
The
Equity.
LTV, 3 is J. Protection for a lender on a low down payment mortgage loan.
The PMI.
8 is K, private mortgage insurance. Lender agrees to hold the interest rate for a certain period of time.
Rate lock.
Lock.
14 is L, the rate lock. Difference between current value and money owed.
Equity.
Equity,
Equity.
12 is M. Explanation of financing terms.
Your home.
Long kit.
The toolkit, the 13 is N, the Your Home Loan Toolkit. All right. Bum, bum, bum. All right, I got chapter 15 queued up for us. Just got to make it visible. There we go. So at the end of this chapter, you can be able to describe various financing techniques, identify sources of financing, government influences on mortgage and lending, etc. So we already went over this a bunch of times, how lending works in a nutshell, right? Your local lender usually lends their depositors money with the intent, and they lend it according to some third-party investors' lending guidelines, who's willing to buy that loan after it's been originated, right? So who makes up the local lender's lending guidelines? An investor who's willing to buy that loan. So your local bank usually matches those guidelines. If they change the guidelines on the types of loans they're willing to buy, what do you think the local lender does?
Changes.
They change it to match, right? So it's just the basics understanding how lending works. Now, loans are originated in what we call the primary market, and those loans are then resold in what's deemed the secondary mortgage market. You get those loans from mortgage bankers, mortgage brokers, and credit unions. Yes, I know, stuff sounds a little familiar, doesn't it? We just went over it. Now, Fannie Mae is the largest purchaser of loans in the secondary mortgage market because they buy about 1 out of every 10 loans that's out there. That's a lot for one company to own about 1 out of every 10 loans. That's huge. So when Fannie Mae talks, lenders listen, right? If Fannie Mae announces they're going to change their lending guidelines, what do you think the local lender does?
Changes his
They
guideline.
change it to match because they know that if Fannie Mae will buy those loans, you know, they're a huge purchaser of them, then we can be pretty sure that even if they don't buy ours, somebody else will. Now, Ginnie Mae is Fannie Mae's ugly stepsister. Now, what do I mean by that? Well, Fannie Mae is related to Ginnie, okay? That's why I have that saying that's like that, because sometimes on state exam, there's some kind of stupid question that they give that's, which one of these loans are related to each other, you know? I don't understand the premise of the question, but whatever. I could explain it like this. Ginnie is Fannie's ugly stepsister. So now you know they're related, if you remember that. Now, what do I mean by she's ugly? Well, because she's willing to buy those risky loans. So if in a primary market, loans were made to people with, let's say, less than perfect credit, or didn't put a lot of money down, or they're non-performing, perhaps. Ginnie Mae will buy those loans, okay? They're risky, but with greater risk comes possibility of greater reward. That means that those loans are usually at higher interest rates too. So as people pay them back, you have the opportunity for making more money. Now, Freddie Mac will purchase conventional loans. Wait a minute, didn't I tell you conventional loans are made by portfolio lenders who don't resell their loans? Well, they usually don't intend to. They plan on keeping those loans in their investment portfolio. But sometimes even an investor needs money for a new project, so they'll sell off some of their loans. But who will buy them? Because they didn't write those loans according to any third party's lending guidelines. Freddie Mac will. They evaluate each loan on a case-by-case basis, though. Okay. Financing techniques. Well, let's highlight some stuff in the book. Page 253. Highlight a purchase money mortgage is any mortgage placed when property is bought. And the way to remember that is just read it backwards. Purchase money mortgage, mortgage money to purchase. Now, a reverse mortgage, what's a reverse mortgage? Well, let's highlight the first line A reverse mortgage is one which regular monthly payments are made to the borrower. And you could write either above it or below it. Loans to seniors who have a minimum or who have a lot of equity, or you could write loans to seniors who have a minimum 60 to 70% equity. It's a first loan, not a second. So in your book, you highlighted the first line under reverse mortgage, and right above it or below it, loans to seniors who have a lot of equity, or you could write loans to seniors with 60 to 70% plus equity. It's a first loan and not a second. It's not a second loan. They pay off the existing loan. A reverse mortgage is this. If you're a senior, you're at least 62 years of age or older, and you have a lot of equity, at least 60 to 70% equity built in that property, you go to get a reverse mortgage. The lender will pay off your existing balance if you have any mortgage on your house. And then the lender makes small monthly payments to the borrower for the equity that they have built in the house. Why would somebody go and get a loan like this? Well, this loan was created so that the seniors who don't have a large savings, or who aren't living off of a pension or getting regular paychecks still. You can't live off Social Security, right? Social Security ain't enough money to live off of, right? Well, if you weren't aware of that, well, guess what? You can't. There's not enough money to live off of. That's really scraping by, trying to live off of just Social Security. If you don't have any savings by the time you're ready to retire, don't believe all the hype, because all the times in politics, you hear people yelling, oh, this one's trying to take away your retirement benefits and blah, blah, blah. You know what? It's extra money for the senior, but you ain't living. If the only money you got is Social Security, you ain't living off of that. You better have some kind of savings somewhere. Back in, when was it? In the 80s, when Ronald Reagan was president, he created this program that allowed lenders to, because it was to loan the equity that seniors have in the homes that they own back to them. Now, this program was created because back then I was a kid, and I remember seeing the news because we were seeing this on the news a lot. Back then, Geraldo Rivera was the breaking news guy, and you've seen a lot of these news programs where they're interviewing senior citizens, and they're deciding on, let me see, Social Security isn't enough for me to live off of, and I don't have much in savings. So the money that I get monthly, I have to budget. Do I use it to pay for food or the medication I need to survive? See, back then you didn't have a lot of these medical programs where if you don't, with the pharmaceutical companies, where if you can't afford the medicine, that they'll give it to you for free or at a discount. Those programs never existed. So the senior had to decide, do I pay for my food or my medicine that I need to live, that's keeping me alive? And so they can't live without their medicine. So they were using their money to pay for the medicine. And then they figured, hey, if my cat, they're over there petting a cat, and they're like, if my cat can live off of this food, it's nutritious enough for them. The seniors were eating cat food. That's not a dignified way to live out your golden years. So this was actually rashes of this on the news. I don't know if anybody remembers that back then on the news a lot. So back then, Ronald Reagan created President Reagan created a program that allowed lenders for seniors who already are living in a home. He said, wait a minute, they're already living in a home. That's their retirement plan. They've been paying into it all their lives. They're sitting on a boatload of equity. Why shouldn't they be able to tap into it so that they don't have to eat cat food? So seniors who own homes that had a lot of equity, he allowed lenders to loan to them and basically pay off any existing loan if they had any balance left. And then they pay out the equity and monthly mortgage payments back to the senior. So now the senior, this is actually working in reverse of the normal loan where people make payments to the lender. The lender is making payments to the borrower until all the equity is tapped out. But I mean, you can't get it until you're 62 or older. So by that age, I mean, you paid what, 30 years into a mortgage? How long will they be paying it back out to you? You know, I mean, life expectancies are building up, but you know, is everybody going to live out to get all their equity back paid out to them? I don't know, but at least it gives them a chance to live out those golden years in dignity, that they don't got to eat cat food. Now, when you get a reverse mortgage, the senior never has to pay back that loan until they sell the home or die. And when they sell the home or die, that's when they pay the lender back the money that that they paid out, plus a little bit of interest. Okay, if you want more information on it, here's a loan called, go to reversemortgage.org. You also see commercials constantly on TV about this too. Reverse mortgages, they got some celebrity up there as a spokesperson for reverse mortgages telling you about these programs and how they work. All right, so how would they word it on exam? Possibly, I don't know, maybe they could word it like, let's see a tricky way they could word it. A type of mortgage loan, a type of loan where the mortgagee makes small monthly payments to the mortgagor. Reverse mortgage, right? Because the mortgagee is the lender and the mortgagor is the borrower. So it's actually the reverse of what the normal is. But that could be like a tricky way that they word it, right? The mortgage, type of loan where the mortgagee makes small monthly payments to the mortgagor. Reverse mortgage.
Hey, I got a question about this reverse mortgage.
Sure.
When it's a reverse mortgage, they can't pass it down, right? Can they pass that property down to?
When they die or sell, it needs to be paid back.
Okay, yeah, all right.
Okay. Now, I've had questions before by people that were like, wait a minute, that's messed up. You mean that when my parents die, I'm not going to be able to keep the house? No, you can keep the house. You just got to pay back the lender what they paid out. And they're like, oh, that's messed up. That's messed up. Where the hell were you when your parents were eating cat food?
Yeah.
Right? You know, I mean, how greedy can you be, you know?
Yeah.
I mean,
They put all that equity into the house. They deserve to get some type of payout.
you know, they took care of you when you were a kid. You didn't take care of them. They had to do a reverse mortgage so that they could get by and live. You know, I mean, you get a lot of cultures where you got to look out for your parents. You got to look out for your seniors when they get older. Over here these days, we get a lot of kids. They're like, screw that, man. It's all about me. What I get. You know, come on, you got to take care of your parents. You know, I got my mom living with me here. I mean, this is actually her house. I sold my house to move in here when my dad died so that I could take care of my mom. I could look out for the house. I could do improvements around the house to help her out, you know? You know, I mean, this is a sacrifice for a single guy, you know? How many girls are interested in a guy that's living with his mother, you know?
And I guess you can't really say my mom lives with me.
You are a good son.
Well, yeah, I mean, I know why I'm doing it, but you know, people from the outside, they look at it a little bit different sometimes, you know. But you know, I'm doing what I got to do. You know, my brother lives a mile away. He never comes by. My sister, she moved out of state. Someone's got to look out for her, right? So that's a reverse mortgage. Turn the page. Home equity loan. What is a home equity loan? Well, you don't need to be a senior to get the equity out of the house if you have a lot of equity in the house. You could take a either what's referred to as a HELOC, a home equity line of credit, which is kind of like a credit card. You only take out the money as you need it against the equity, or you could take out a home equity loan, which is a lump sum of the equity, however much money you want to take out of the equity that you have built into the house. Equity is that built-in value, any money that you may have already paid off on the house. If the property value has gone up, it's the difference between what's owed on the property and what the current market value is. So you could take a loan out against all that money in between. Okay, but when you get a home equity loan, you got to start paying that money back right away. Unlike the reverse mortgage, where it does not need to be paid back until the senior dies or sells the property. All right, then we have highlight the home equity loan is a form of second mortgage. Then the next paragraph, we're going to highlight a homeowner who's selling one residence and buying another may find it necessary to purchase the new home before the closing on the present one. Then go beneath it and highlight, this is called a bridge loan, swing loan, or interim financing. And then go to the line beneath that and highlight, such loans are usually provided for interest-only payments and are intended for no more than 6 months. So a bridge loan, let me see, I got it on the next slide, the full definition. I created a slide just for that bridge loan. Let me go there temporarily and then I'll go back. So here's the slide for a bridge loan. It's an interest-only loan for short-term. It's when, look, when we sell a home, when we got a buyer who has another home that they have to sell, usually we try to coincide their closings so that they don't have to pay for 2 mortgages on 2 separate houses for a period of time there. We try to get those closings to coincide with each other within days of each other at least, right? So that they don't have to make 2 mortgage payments in a month, because most people can't afford to make payments on 2 houses. So we try to coincide them closings that way. But that's not always possible. And if it's not possible, they can apply for an interest-only loan where it's a temporary loan that will allow them to swing the payment. See, it's known as a bridge loan, swing loan, or interim financing, so that they could swing the payment in the interim until they're able to sell their current home. They could at least purchase the next home so that they could bridge that gap of time. See, I used all those words right there. It's so that they could swing the loan into interim so they could bridge that gap of time between the time that they purchased the new home and they have to sell their old one. That's basically what a bridge loan is. And you should be able to take care of that and handle it within 6 months, right? So it's a loan to make the payment on the 2 homes, short term. And you should be able to pay it back once you sell your existing home.
Would people that flip, would they use a loan like that?
No, bridge
Okay.
loan is for when you got the home that you're living in,
Yeah.
you're selling it, you're buying a next home. Okay.
Okay.
It's not for juggling ownership of multiple investment properties. Okay. This is for people who can't afford the payment on 2 homes. If you're fixing and flipping homes, you should have the money to be able to pay for those investments. Otherwise, you're not doing good investments if you don't have the money to do that, to balance them. Okay, back it up. All right, shared equity mortgage. Actually, before we even get to that, shared equity. Oh yeah, I have it here. There's nothing to highlight under shared equity mortgage, but in the last line of it, you could underline the partner receives a share of the profit when the property is sold. So what is a shared equity mortgage? Basically, a purchaser needs financial assistance. They buy a house together with an investor. And the reason for that, so if you want to buy a home, an investor will buy that home with you to help share those costs, with an agreement that when you sell the property, the profit is shared with the investor. It's kind of a way to invest in real estate without having to have all the money to invest in real estate. That's shared equity loan. I've never seen these, but I'm sure they're out there. A package mortgage, it's a package deal. It's when you get one loan that finances the purchase of the real estate and chattel. What is chattel? Tangible personal property, like fixtures and appliances. This is often used when buying new construction, like furnished condominiums. Like you're going to buy a condominium or a house that includes a washer and dryer and refrigerator. These items are considered personal property normally, not part of the real estate. So you're getting new construction that also comes with all the appliances. Okay, it's a package deal. So highlight, a package mortgage covers not only the real estate, but also fixtures and appliances on the premises. And then we got a blankie. A blanket mortgage, this is often used by builders. A blanket mortgage has what's called a partial release clause in it. It allows you to buy a large lot. It's used to help finance subdivision developments. It has what's called a partial release clause in it, because we know that mortgages are normally, when you sell a property, that loan needs to be paid off in full. With a blanket mortgage, it's a way that you could sell off a smaller lot off of a larger one, and instead of having to pay back the whole entire loan, you only have to pay back a portion of it. What is the clause in a mortgage? Here's a question for you guys. Ready? Everybody listening? What is the clause in a mortgage that prevents the loan from being assumable? That says that when you sell the property, the loan has to be paid off in full.
Starts with an S.
Nope.
Is that acceleration clause?
It's not the acceleration clause. That assists the lender in foreclosure, but it does begin with an A.
Alienation clause.
Alienation. Yes.
It's the alienation clause, also known as, am I asking for too much? The due on sale clause.
Oh.
That says when you sell the property or transfer ownership, it's due. You got to pay it back. So the blanket mortgage, here's a picture of a blanket mortgage. If you have a loan that you get to buy a large lot to finance this subdivision, and you sell off a smaller lot off of the larger overall lot, you only have to pay back 1/6 of the loan. In this case, it's subdivided into 6 lots. So if you sell off one property off of the larger lot, you only got to pay back 1/6 of the loan. So you sell off another lot, you would have to pay off 2/6 of that loan, and so on and so forth. That's how the partial release clause works in a blanket mortgage. So a type of mortgage loan used to finance subdivisions. Blanket mortgage. Then we have a wraparound. Okay, so you highlighted the blanket mortgage, the first 2 lines. And then a wraparound mortgage, you're not going to get this on exams, but I don't think anyway. But a wraparound mortgage is this. Say this is my loan on my house, okay? This marker or this highlighter is a loan on my house. I have a loan. This is my loan. If I do not have an alienation clause in it, what does the alienation clause say? Or what is it also known as? We just went over it a little while ago.
Do it yourself. Did you say do it yourself?
Due
clause?
on sale.
Due on sale.
Due on sale, meaning that the loan is due. You have to pay it back in full when you sell or transfer the ownership. But if it does not, if you have a mortgage loan that's assumable, it does not have an alienation clause in it. So does that loan need to be paid off when you sell the property? It don't. So I could sell you my property and keep my loan as long as I keep continuing making payments on it. And I can give you seller financing now. This pen would be my loan to you. Your loan would wrap around mine. It never touches my loan. It wraps around it without disturbing that underlying financing. This is my loan. This is your loan. The two loans have nothing to do with each other. It wraps around without disturbing the underlying financing. Okay, so that would be the wraparound mortgage. Highlight the title wraparound mortgage and then go down 3 lines. And in the middle of that line, you're going to highlight the seller who collects payments on the new loan, usually at a higher interest rate, and continues to make payments on their old loan. And I'm going to have you write in the margin to the left of that a little more of an explanation. I wrote, existing loan has no alienation clause, and then write seller financing. This is usually when you do a wraparound mortgage is usually when seller financing is involved. The existing loan has no alienation clause, so then the owner can offer seller financing if they didn't pay off their existing loan yet. That loan had to not have an alienation clause because most loans have alienation clauses in them. They're not assumable. And if you sell or transfer the ownership, you got to pay off the loan in full. Okay. Construction loan. I want you to write above construction loan. It's a first loan, not a second. I know I skipped open-end mortgage. We're not going to highlight anything there, but an open-end mortgage, the borrower never closes the loan, so they could draw on it as they build equity and pay it back on a regular basis. Okay, but the lender has to agree to it, and they don't have to allow the lending and drawing to continue. So a construction loan, I want you to write above, I want you to highlight the title construction loan and write first loan, not a second. To construct means to make new. It's not an improvement loan, even though if you start reading through this whole section, it'll start telling you about that. I'm trying to get you to study for exams. When you get an exam question that asks about construction loans, it's a first loan and not a second. Because out of all these loans that I just read to you, which one is the second type of loan? A second loan.
Wraparound.
It's the home equity. A home equity loan. A wraparound mortgage is not a second loan for you, the buyer.
Somebody else.
For the seller, it is.
Okay.
Yeah. So I can see how you got confused with that one a little bit because that's possible depending on the way you're looking at it. But as far as questions go, when they give you answer options there for questions, which one of these is or is not a second loan? The only one we've read so far that's the second loan is the home equity loan.
Okay.
A construction loan is not a second loan. It is a loan to when you initially construct and you initially building a home. So it'll be a first loan. It's not like the 203K, which is it's not really, 203K is not really a construction loan. It is an improvement loan, right? A rehabilitation loan. All right, so construction loans work just like 203Ks do. You know, when you get the loan, the lender does not just give you extra money and hope that you do the work. they actually pay out the work to contractors in phases as the construction gets done. So basically, you got to show all your plans and who the contractors are. Those contractors need to provide the materials and the labor up front. And then the lender will pay them and phases of the construction as they're completed. Now, how do they know when the phases of the construction are completed? At the end of each phase, when the contractor says they're done with phase one, the lender will send out an appraiser who will go to inspect it to make sure that all the work from phase one has been completed. And then they'll tell the lender, and then the lender will release all the funds to the contractor to reimburse them for the materials and the labor for that stage one of the construction. And then they start stage two, and so on and so forth. And the 203K mortgage works the same way.
So they're not actually giving you the loan. It's being funneled right to the contractor.
Well, they're giving you the loan. They're just not paying. They're not giving you the money and hoping that you do the work. They're paying it directly to the contractor. That's correct.
Okay.
They're not going to give you a loan to buy the house and another loan. Here's a wad of cash. We hope that you spend it on the house and don't try to go to AC or Parks Casino and try to double it. Okay, so a sale leaseback. All right, stop right there for a moment. Sale leaseback. What does it sound like? Sale.
You sell and then you lease back. Yeah.
You sell the property and then you lease it back from the new owner. Exactly. How could this be worded on exam? A type of buyer-seller arrangement where the mortgagor becomes the lessee. Sale leaseback. You were previously the mortgagor, the borrower, the owner, and now you're the lessee. You sold the property, now you're leasing it. Right? Tricky. All you got to do, it's actually not hard. All you got to do is translate these words in your head as you're reading the question. A type of buyer-seller arrangement where the mortgagor, who's the mortgagor? The borrower, the owner, becomes the lessee. Well, how do you become a lessee? Well, you sell the property and then you rent it back. Oh, there's the answer. Okay, so that's how you do the translation in your head as you're reading the questions. All right. Now, why would somebody do this? This is for commercial real estate. You're not going to see this usually with residential. This is for commercial real estate where a business owner needs to raise capital for whatever reason for their business. They need to infuse capital into their business, maybe for to get more workers, to upgrade machinery or advertising, or whatever reason they need additional money. They're sitting on the money. They could sell the building and negotiate a long-term favorable lease with the potential buyer. If they don't agree to that long-term favorable lease, then they don't sell them the property. So the seller has all the cards in their hand, right? They don't have to sell to somebody who's not going to agree to give them a long-term lease that's not going to rip them off. Basically, it's affordable, but it has to be equitable to both parties, though. You know, there has to be something in it for the buyer as well, who's going to be an investor at this point. All right, so that'd be a sale leaseback. So highlight sale leaseback, sometimes used as a means of financing. And then go down 3 lines, and at the end of that line, you're going to highlight the buyer becomes the lessor and the original owner becomes the lessee. Then go down 2 more lines, or 2 more paragraphs. So the last paragraph in this section on page 255. And on the first line, we're going to highlight a land contract is also known as an installment contract. It's a type of seller financing. You could write that beneath that. It's a type of seller financing. See chapter 11, page 190. Remember that? An installment sales contract. A land contract, also known as an installment sales contract. It's a type of seller financing where you make monthly mortgage payments to the seller, but they do not give you the deed until the full amount is paid off. Vaguely, kind of, sort of. But don't confuse it with a ground lease, because what's a ground lease?
Ground lease is when the buyer purchases, leases the ground and builds his own construction building, whatever
Correct.
they're building.
Correct. So it's a long-term lease where the tenant erects a building on the property.
Mm.
Yep. Whereas a land contract is also known as an installment sales contract. It's kind of like a rent to own, where the buyer is making payments in installments and they wait for the deed. And the buyer's not the owner of the property yet, but they do have a financial interest in that property, and they call that financial interest equitable title. Equitable.
So land contract is also seller financing?
A land contract is a type of seller financing, but it's a type of seller financing, because if I just say seller financing works like any other loan. You go to the bank, you get a loan, you buy the property, the seller gives you the deed.
Okay. Yeah.
Only in this case, you're not going to a bank to get the loan. You're going to be making the mortgage payments to the seller, and they immediately give you the deed. But with a land contract, they don't give you the deed until you pay off the full amount you owe them.
Okay.
That's the difference. But you do have a financial interest in that property as you make payments. That's called equitable title. Okay. And then we have some other buyer-seller arrangements here. We have lease options. Okay, what does that sound like? A lease option. You're leasing the property and you have an option to buy it at a predetermined price by some predetermined deadline. Only attorneys can prepare those contracts. You recall, any contract with an option has to be prepared by attorneys. Now, that's a unilateral contract, whereas a lease purchase is a bilateral contract. You're leasing the property and you're definitely going to buy it by a predetermined deadline at a predetermined purchase price. Okay, so those are just the different types of seller-buyer arrangements there. Primary mortgage market, who do we get borrow money from usually? Once again, this is like the fourth time we went over this. You go to your local bank, right? These are places where you get money from in the primary mortgage market to buy real estate. Banks, commercial lenders, they're private investors. Insurance companies, who would have thought of that one? You know, you could go to an insurance company to get a loan to buy a house. Well, let me ask you a question. Insurance companies would be investors. They lend money all the time. But they probably give out larger loans. They don't deal with directly to consumers to buy a house. Insurance companies, though, they do lend money. You think insurance companies have a lot of money on hand? A lot of profit just sitting around, cash laying around?
Definitely.
Definitely. I mean,
so,
you pay for insurance and most of the time you never even file a claim on it. There's some people like, look, I mean, I never made a claim on my car insurance in my life, but I've been paying it for years. That's profit for the bank, right? What do? They just got all that cash laying around? No, they reinvest it to make more money instead of just sitting on it. And they lend it. because we know there's a lot of money in lending, right?
Mhm.
Mortgage brokers, they deal with private investors. A mortgage broker, you have mortgage bankers and mortgage brokers. A mortgage broker deals as a mortgage rep that works for a bank. A mortgage banker works for a bank. A mortgage broker is independent. They work with a lot of different banks and a lot of different private lenders to get money. They're a broker. And then we got credit unions, which are nonprofit banks. This is all the primary sources of mortgage market money or mortgage money in the primary market. And what's the primary market again? It's where people get loans to buy real estate. And what do we call it when they resell those loans to investors?
Secondary mortgage?
The secondary market. There you go. Don't overthink it. It's pretty simple, isn't it? Okay, so how does getting loans and credit work? Well, let's first highlight in the book here under sources of real estate financing in the primary market. Let's highlight primary mortgage market. Lenders who supply funds to borrowers as an investment. Lenders may originate loans for the purpose of selling them to other investors as part of what is termed the secondary mortgage market. And then they just go over all the different types of sources of money as I did on this slide, but nothing to highlight. You don't have to highlight them. So credit, application for credit. So how do you get a credit? How do you get the money for a loan? Well, you have to apply for a loan, right? What's the first step? Get that pre-qualification letter, right? You call up a mortgage rep, you tell them what your social security number is so they can check your credit. And then you tell them how much money that you make and what your approximate long-term debts are. None of it's been verified at this point. But based off of that, they give you a pre-qualification letter. That's the minimum requirement before you start running people around showing them homes. The next step would be to get a loan pre-approval, where now they start supplying all the documentation so the lender can verify all that information to make sure that they can actually get the loan. And once they verified everything, you've now been pre-approved for the loan. Now, who does all of that checking at the bank? Somebody called an underwriter. They're the ones that verify all the paperwork, all the history. They are people who examine the risk to lenders and go over all that paperwork. They're locked in a room somewhere. Most people never speak to them. It's true. It's true.
I really do.
What's that?
I believe it.
Well, it is true. I mean, I have spoken to an underwriter before when they called me because their own mortgage rep was an idiot and they needed to get the message across and they were sick and tired of the back and forth. Usually there's a gap. You don't ever communicate directly with the underwriter, but they actually called me. I've had a couple instances of that. I actually, on one of my pool teams, I got a girl who's an underwriter for one of the banks, I think Wells Fargo or something like that. Oh my God, you want to talk about a dry personality? They locked her away too long. That girl, she don't know how to smile. I mean, you could tell a joke and it's just like, you'd be lucky if you get a little, like the corner of the lip goes up a little bit. That girl don't know how to smile.
I used to do loans for Countrywide.
Yeah.
For Countrywide before they went under.
Yep.
And yeah, the underwriter there, oh my gosh, he's like a fucking computer.
They got the permanent stick up their butt, right?
Yeah.
kind of like Kurt, right? The state inspectors. All right. Be very rigid with the rules, you know. Hey, their job is to analyze risk and to verify it and look for anomalies, and you know, so everything is like very detailed and oriented. Don't mess with my vibe because I'm trying to track down things, you know, like an investigator. Okay.
Stipulations Clear the
Call
loan.
them an underwriter. And through the process of underwriting is where they're examining the documentation to give you the approval. So the person is called the underwriter and the process is called underwriting. Make sense?
They even have desktop underwriting.
Well, that's the software that they use.
Yeah.
All right, so the process of underwriting, okay, it's processes through which the lender carefully investigates the applicant's financial information and info about the property to determine if they're going to grant a loan. What info about the property? The appraisal, and at minimum, the lender can't require you to get a home inspection, but at minimum, they can require a wood destroying insect report to make sure that the property is not getting eaten, that the improvement's not getting eaten by insects or other wood destroying insects, right? Like termites or other wood destroying insects. So then the lender examines all the buyer's information, their finances and credit history. They determine the risk to the lender. They examine the property's information and appraisal, the wood destroying insect reports, and city inspections if the municipality requires them for a certificate of occupancy and a fire inspection. And once they get all that information all gathered up, they examine it all, and then they determine whether they're going to grant the loan. That whole process is known as underwriting. And when the lender is going to give you the loan and they're going to commit to that, they issue what's called a commitment letter or a loan commitment. So a commitment letter is issued after the borrower completes a loan application, submits their financial info, which is then verified, and property appraisal and inspection reports, all this stuff that I explained up here. If underwriter decides to grant the loan, a mortgage commitment letter is given. This is a good slide to study, by the way. This kind of lays all out pre-qual, then it's the approval, then it goes through the underwriting process, and then they issue a commitment letter. There's actually an exam question on the commitment letter. I mean, what do we call the approval of a borrower's loan application in writing? It's called a commitment letter. Yep. So, under application for credit, in the second paragraph, 5th line from the bottom, where you see the word underwriting in bold in the paragraph, highlight through the process known as underwriting, and highlight to the end of the paragraph there. Or to the, except for the last line, all the way up to loan commitment. Now they say in the form of a loan commitment, and I wrote in my book just below that, that loan commitment is called a commitment letter. So you highlighted 4 lines there, and then under where it says loan commitment, you wrote commitment letter. And once you're done with that, highlight the 4 lines underneath pre-approval loans, where they talk about the difference between a pre-qualification letter and a pre-approval letter. Which one's better?
Pre-approval.
There you go. And what's the minimum credit score that most lenders require to lend you money?
620.
620. Why? Because anything below 620 is considered subprime, which means it's risky for them to lend. The lending is called risk-based lending. Now, usually when you go to get a mortgage loan, the lenders will always run your credit report from all 3 credit reporting agencies. Now, how do they determine what your credit score is? Because each one of those agencies has a different credit score. They do not average them out. I'm going to tell you that right now. They just pick the one in the middle.
That's when you get the term mid-FICO.
Well, I don't know. Maybe that's what they talk about there in the background. But yeah, they just pick the number in the middle, and that's it. A lot of people think, oh, it's got to be more complicated than that. They take all the credit scores and they average it. No, they don't. I was a mortgage solicitor for a brief period.
Yeah, me too.
Yeah, I don't like it, you know. That's when you're allowed to be a real estate agent and a mortgage rep at the same time. So they changed the laws on that, and I was like, no, I'm not staying with the mortgage. Screw that. So you take the 3 credit scores, you just select the one in the middle. All right, qualifying ratios. You get a question on exam about this. We're going to do this and then we'll break for lunch. What is a qualifying ratio? Highlight the title qualifying ratio on page 257. And I have all of this written next to that blank spot where for qualifying ratios. I usually dictate this note to you to write in there. An example of a qualifying ratio is a DTI, debt to income ratio. So you guys should write this in your book too. If you're not studying it from the slideshow here, you should write this as a definition next to qualifying ratio. An example of a qualifying ratio is a DTI, debt to income ratio.
If you have DTI, you will not get a loan.
It's used by lenders to determine the maximum expense for housing a borrower could afford to pay. Pity. So that's the whole definition. I'm going to have you right there. An example of a qualifying ratio is a DTI, debt to income ratio, used by lenders to determine the maximum monthly expense for housing a borrower could afford to pay. Pity. Pity is the maximum monthly expense for housing, right? I'll read it again. You guys are writing it, or am I just reading this for nothing? I just want to get an idea. Should I keep repeating this? Because usually people want me to keep repeating it because they didn't get the whole thing.
Well, I
Okay.
kind of got this part down. I was a mortgage consultant for 5 years. So
Okay.
this part,
So, well, then this should help you then. An example of a qualifying ratio is a DTI, debt to income ratio, used by lenders to determine the maximum monthly expense for housing a borrower could afford to pay. So what are qualifying ratios used by lenders for? If you say to determine how much they could borrow, that's wrong. Because we have to get into semantics here. The qualifying ratio is used to determine how much the borrower can afford to pay monthly. And then based on how much they could afford to pay monthly, they reverse engineer it to figure out how much you could borrow. And how do they figure out how much you could borrow based on how much you could afford to pay? Well, remember where we did the chart to figure out what the monthly mortgage payment would be based on the interest rate and the term? The mortgage factor chart, remember that? And then it would tell you what your monthly mortgage payment is. So if you use the qualifying ratio to determine what the maximum monthly payment you could afford to pay, now you could take that to that chart that has all the maximum monthly payments. And now we could figure out what's the maximum monthly you could, what's the maximum you could afford to borrow. So they do some reverse engineering of the math there. They walk the steps back in a different way. We as a borrower, we would want to know what our monthly payment is. The lender wants to know how much you could afford to pay monthly. And then based on that, they're going to reverse engineer it to figure out how much they're going to lend you. They just take the reverse approach. Don't worry, we're not going to get a math problem that we're going to have to figure it out. You just need to know what are qualifying ratios used by lenders for. And what is it used for?
To figure out how much house you can you can buy. The
Afford.
debt to income ratio is figure out how much you can afford a month, how much you can pay. And
That's
then
that's the qualifying ratio. The
yeah,
qualifying ratio is the DTI, the debt to income ratio,
uh-huh.
which is used to determine the maximum monthly payment you could afford.
Yeah.
Not how much you could borrow, but how much you could afford to repay monthly. That's the question you need to know for exam. That's the answer.
Okay.
Now, an example of a qualifying ratio, this is just an example. Different lenders have different ratios and different programs have different ratios. Here's just an example. Okay. This isn't what all lenders use. An example of a qualifying ratio would be 2836. Well, what does that mean? It means 28% would be the monthly income for housing expense that you could apply to, or 36% would calculate income on all long-term debts. Sometimes I've seen this up to 48 or 49, actually, depending on the lender, which that's a lot.
That's a risky loan.
It is. And that is that. And I'm recording. Okay, the government influence in the mortgage lending process. So we have the Federal Reserve. Actually, contrary to the way that it sounds, the Fed or the Federal Reserve, it's actually not part of the federal government. What is the Fed? Well, the Fed is actually all the banks that do business in the United States. They came together and as a group. And when they're together as a group to determine how they're going to do their banking and what their rules are, they refer to that as the Fed. It's not a part of the federal government at all. So to try to counter inflationary and deflationary trends, to establish economic stability and maintain sound credit conditions by altering what we know as the AFR, that's the applicable federal rate, which lending is based on. So when your lender lends money, the Fed sets an AFR, that's the applicable federal rate. Now, if they want to lend and that AFR is set at 2%, and they want to earn 2%, how much do they have to charge on interest on a loan?
4%.
4%. Yep. So it's based off of the AFR, that applicable federal rate. And so when the rate bounces up and down and all the time, that's because all the heads of all these banks that are doing business in the United States, called the Fed, are making those rates fluctuate. Okay. Now there's a lot to it, of how they do this and what their job is and how they go about doing it. And it can be some tricky business if you try to understand it. It sounds kind of convoluted the way they go about it. And bottom line, what it comes down to, it's based on whatever they say, you know. That's why you see sometimes the president may be weighing in on it a little bit, or we have in the government, we have people who deal with the regulators, you know, they also try to negotiate with the Fed. I mean, we've heard arguments throughout the years, you know, that the president yells at the Fed, "Oh, you're raising the interest rates too quickly. You're gonna, you know, we're trying to do a recovery and you're raising the interest rates too quickly." They're like, "Ah, we don't care. No, we know what we're doing." So they raise the rates. And when they raise the rates, oh, it starts to stall the economy a little bit. And then they're like, "Yep, you're right. We raised it too quick." So then they lower it back down. Okay. This is what happens. It's a guessing game on what the rate should be. The Fed tries to charge as much interest as they can without it screwing up our economy. All right, so the government has influence, however, in the secondary market. We have Fannie Mae. Their stock symbol is FNMA. They used to be known as the Federal National Mortgage Association. Now they're just simply known as Fannie Mae. So this is their stock symbol. And if on exam, they just show you the stock symbol for Fannie Mae, you could get it right just by sounding it out. Sound it out. FNMA. FNMA. You see that? FNMA. Okay. Now, Fannie Mae is the largest purchaser of loans on the secondary market. It's operated under a shareholder-owned company under congressional charter. Yeah, Congress, congressional charter. We, the people, pretty much own Fannie Mae since all the bailouts. This is why you see towards the end of his presidency, President Obama made a lot of changes. He made a lot of changes to the FHA type loans, the things that are within his power. He raised the percentage of the MIP that is charged for the mortgage insurance. He raised the well, he lowered and raised the down payment requirement several times, but that was for the reelection for the down payment requirement. But he raised the MIP amount, the percentage that's charged for the mortgage insurance premium. And then he also canceled, it used to be that you can drop a mortgage insurance premium on an FHA loan if you've had the loan for at least 7 years, if you paid off 78% of the equity within 7 years. Now they totally dropped that. They said he changed the rules so that you can never drop the MIP coverage unless you put down at least 10% at the time that you got the loan. And once you reach 78% equity, but only after 11 years of having the loan. Now, why did he make all those changes? He made all these changes because he wants to make the FHA loan a good loan for you guys to get into the house, but he doesn't want you staying on the program. He doesn't want to make it to be a type of loan that's worth staying in for the long run, because a lot of those loans that defaulted were FHA loans. And what does the FHA do? Does the FHA lend money? I'll ask again. Does the FHA lend money?
No.
They guarantee it.
No, they insure loans. The VA guarantees. The FHA insures loans. So when all those loans, those FHA loans were defaulting, the government had to step in and insure those lenders against loss and make sure that they got paid out so that they didn't lose any money. Now, the FHA insurance fund went dry. They had to do the bailouts. Some of that bailout money went to replenish the FHA insurance fund to pay back those banks, because they insured them against loss if they gave those loans. So now he raised that MIP percentage so that when people get FHA loans now, they're paying more into that insurance fund to try to build itself up without bailout monies. And then he also lengthened the period of time required before anybody can actually cancel the insurance. However, most people who get FHA loans, why do they do it? Why do most people?
Down payment.
The low down payment, which is what?
3.5.
Ah. Now, what's the requirement for being able to drop the MIP insurance? You had to put at least 10% down.
Yeah.
So most people aren't doing that are on the FHA loan. So therefore, most people who get an FHA loan can never drop it now. Okay. So basically, he's saying that this is not a loan that you want to be in for a long time. Use the loan to get into the house. Then when you build up some equity, refinance into a conventional loan and get the hell off the FHA program, because we don't want those loans defaulting again en masse. Although he should have stated that a little bit clearer to people, that that's the intention, because a lot of people may get the loan, still get it and pay it, and they'll be paying the MIP for the life. Either way, they'll be paying money back into the insurance fund. Okay. Now, so government has that influence. They have Fannie Mae. Fannie Mae is the largest purchaser of loans in the secondary market. They purchase 1 out of every 10 loans that's out there. And when they change their lending criteria, your local lender often changes their criteria to match, because knowing that Fannie Mae will probably buy the loan. Now, conforming loan is a loan that meets Fannie Mae's lending guidelines. It conforms to Fannie Mae's lending guidelines. So what do you call a loan that does not meet Fannie Mae's lending guidelines?
The stepsister.
Non-conforming. If a loan that meets Fannie Mae's lending guidelines is called conforming, one that does not meet their lending guidelines is called a non-conforming loan. We'll be seeing that in the coming slide. Then we have Ginnie Mae, that's Fannie's ugly stepsister, right? Because she makes those riskier loans. Her stock symbol is GNMA. And you could sound that one out too, right? GNMA. You see that? GNMA? GNMA. And then lastly, we have Freddie Mac, which you're not going to sound that one out. That's formerly called the Federal Home Loan Mortgage Corporation, FHLMC. Okay, so those are the old names of these companies, and then they renamed them to Fannie, Freddie, Fannie, Ginnie, and Freddie. Which one of these are related? Which two are related?
Fannie Mae and Jenny Mae.
Fannie and Jenny.
Did my job then. Next.
The Freddie is a brother.
He's not related to them. He does the same thing, but he's not related. No relation. All right. So non-conforming loan. What's a non-conforming loan? One that does not meet Fannie Mae's lending guidelines. So it's a loan that Fannie Mae is not willing to buy. So who do we get loans from that are non-conforming to Fannie Mae's guidelines? Well, you'd have to go to a portfolio lender. Those are called conventional loans.
Portfolio lender.
Right?
Yeah.
And what do we call a loan larger than, you know how they have the lending guidelines? They'll only lend up to so much for 1, 2, 3, and 4 family house. What do we call the a loan that's larger than that amount? It's called jumbo. See down here? It's a jumbo loan. It's a non-conforming loan. It does not, it's a loan that's larger than Fannie Mae's lending guidelines. It's jumbo in size. It's big. The jumbo means big. So it's a jumbo or non-conforming loan. You would get those from portfolio lenders as well. Like if you want to, you got to get a loan to buy a mansion, you know? Who's going to lend you the money? You go to a portfolio lender. Okay. Page to page. Okay, so on page 258, we're under Fannie Mae, second paragraph, we're going to highlight loans that meet Fannie Mae's guidelines are called conforming loans. Second line, second paragraph under Fannie Mae, page 258. Then above Government National Mortgage Association, Ginnie Mae. Write Fannie's ugly stepsister above that. So you don't forget the relation. And when you're done with that, go all the way down to the bottom of the page where it says non-conforming loans. And the last 2 lines of the page, you're going to highlight loans higher than the secondary market limit are known as jumbo non-conforming loans. And the borrower who wants to place one would search for a local lending institution that is making portfolio loans. So then on that next page, 259, or yeah, 259. Regulation Z. You guys recall this? We went over this a long time ago. It's been a while since we mentioned it too. Regulation Z, anybody remember what that is? Part of the Truth in Lending Act, or implements the Truth in Lending Act that requires full disclosure when you talk about financing in an ad. If certain triggering terms are used. You recall what those triggering terms were? If you mention certain things in an advertisement, full disclosure is required of all the terms. Well, anyway, Regulation Z does not apply to business or commercial loans or cash purchases. Only applies to any kinds of financing to consumers.
That's when you say to those that qualify?
Yep, that's one of the disclosures that you need to make. But
Okay.
here are, Okay, so let's see, the triggering terms. I know I got a slide that's got everything written on it, but here's just some more of the stuff. So part of that Truth in Lending Act, there's a 3-day right of rescission that only applies for refinancing presently owned property, but not for purchase money mortgages. There's no right of rescission. Remember that?
Uh-huh.
Now, for advertising rules pertaining to Regulation Z, it only goes into play when certain triggering terms are used. And those triggering terms, here we go, requires full disclosure of loan terms below when certain triggering terms are used. What are those triggering terms? Well, if you mention the interest rate, a monthly payment.
No, I didn't even see them. I was like, done it.
If you mention the interest rate, a monthly payment, or a down payment amount in the ad, or the terms. The term is how many months or how many years. If any of those things are mentioned in an advertisement, then you have to disclose all the details. But first you have to say one of these following statements: to those who qualify or to a qualified buyer. And then you'd have to disclose the APR, the down payment amount, if required, and the term. So these are the rules for when full disclosure is required and what the triggering terms are. Here are the triggering terms. So in the book, under Regulation Z, highlight the first sentence, or at least the first line. The Truth in Lending Act, which is implemented by Regulation Z. The last line of the same paragraph, you're going to underline, does not apply to cash transactions or business commercial loans. The next paragraph, we're going to highlight Regulation Z requires that the borrower be fully informed of all the finance charges. Go down 3 lines and highlight the rules do not apply to home equity lines of credit, reverse mortgages, and land loans, mortgages secured by a dwelling not attached to the property, like mobile homes. So TRID rules require the delivery or mailing of early disclosures about the proposed loan within 3 business days of the completed loan application. Until the disclosure has been made, the lender cannot charge any fees except for the credit report. A loan application is considered complete when the borrower provides the address of the property, the loan amount requested, the income, estimated property value, and names of the borrowers and their social security numbers or aliens. Put a highlighted box around that whole paragraph. Okay. Anybody know what an APR is? Since it's one of the things that need to be disclosed. The APR is actually different from the interest rate. It includes all those one-time fees, the one-time costs associated with getting the loan, like an appraisal or a loan application fee that are not reoccurring fees that, but however are costs associated with getting the loan. if you were to factor those costs into the life of the loan and then break it down on an annual basis, the interest rate would actually tick up a little bit. It would be a little bit higher. That's why the APR is always a little bit higher than the interest rate. It's the actual cost or the effective cost of the loan. If you were to factor in all those one-time ancillary fees that are associated with getting the loan. So on page 260, under 3-day right of rescission, last line, we're going to highlight, or last sentence, highlight the right of rescission applies only to, there's a 3-day right of rescission that only applies to mortgages to refinance presently owned property, but not for purchase money mortgages. We've already been studying that on our rescission list, right? Then under advertising, we're going to highlight in the second paragraph, Regulation Z applies to all credit advertising. All credit advertising. It's not just for mortgage loans. You could go get a car on TV. They put the commercials. That's why they flash those, all those terms, and you got the speed talker talking on TV, because it applies to all consumer related loans or financing, not just for real estate. So Regulation Z applies to all credit advertising if any of the following triggering terms are used. Now, what I did is I put a highlight just down. I just highlighted like this, those 4 bullet points right here underneath that. I skipped the next 3 set of bullet points, and then I highlighted that sentence there with the next 3 bullet points, and I just connected them by an arrow. You see that? So I just skipped 1 set of bullet points and highlighted the next, and I connected them with an arrow. Because up here, it explains what are the triggering terms, and then down here, it gives you some examples of it. So that's all I'm doing is connecting them. Next, under penalties on the next page, 261, we're going to highlight the penalty for violating an administrative order enforcing Regulation Z is $10,000 per day that ad is in the public domain. And then also highlight the last line that says willful violation is a misdemeanor punishable by a fine of up to $5,000 or 1 year in prison or both. And here's one slide. I got everything on one slide that you could study from. Here's one slide that has everything for Regulation Z. You could study it all nice and neat. I got it buttoned up in this one slide. Is a good slide to study everything for Regulation Z. Okay. Okay, ECOA is the Equal Credit Opportunity Act. We don't need to highlight or anything there. It basically says anytime any creditor is offering credit to consumers, if they're ever denied credit, the law requires that that consumer be informed why they're denied credit, and they have to be provided with a free copy of their credit report. Now, we as real estate agents, we don't offer credit. We don't deny people because of credit either. Maybe the only time that we'd get close to that is when we're dealing with qualifying a renter. Sometimes we run their credit report. If you deny them the rental, you got to let them know why, if it's due to their credit report only. Therefore, I never deny people credit or deny people a rental because of their credit. Usually, if their credit's banged up, you could deny them because their debt to income ratio is messed up too. Okay. Or other factors that the landlord may have in there. You have the right to interview or the landlord does too, has the right to interview a tenant, but also check their, if they're on sex offender lists and all those other things too. So the landlord ultimately has the option of selecting who their tenant is, as long as they're not discriminating. All right, nope, don't turn anything yet. Okay, RESPA is the Real Estate Settlement Procedures Act. Yesterday we were learning about the LE and the CD and all that. And here in this chapter, I actually have a nice, neat slides that I should copy over to the other chapter because it puts everything together on one nice slide. Let me make a note of this slide number, by the way, for myself. Sorry about that. Slide number 24. Okay, so RESPA is the Real Estate Settlement Procedures Act. You need to know that for exams. And what is the purpose of the RESPA law? Or how about this? What is the purpose of the RESPA settlement statement? It used to be called the HUD-1 and now it's called the CD. What is the purpose of it? Well, if we look here, the closing disclosure, accounting of all final costs, but what is the purpose of it? Is there a better definition somewhere? Do I have one here?
Was to create and to ensure that the buyer and seller in residential real estate transaction, it is given here, right? Under the RESPA paragraph?
It is. Why don't you highlight it?
Yes.
The Federal Real Estate Settlement Procedures Act, RESPA, was created to ensure that the buyer and seller in residential real estate transactions involving new first mortgage loans, meaning not for refinancing, presently owned property, have knowledge of all their settlement costs. Which is what I actually have written here on the slide too. It is here. I just put it instead of a sentence, I got it in some bullet points here. So it's a federal law that ensures the buyer and seller in residential real estate transactions involving new first mortgage loans, not refinancing, have knowledge of all the settlement costs. This is what the purpose of the RESPA settlement statement is for. Okay. You need to know that for exams. First of all, what does RESPA stand for? RESPA. RESPA. Real Estate Settlement Procedures Act. To ensure that all the consumers are aware of all the settlement costs. That's why we give them accounting for at the closing table. So buyers and sellers are aware of where every penny goes to. Hopefully that makes it clear. Hopefully that spelled it out and made it perfectly clear, okay? So RESPA is the Real Estate Settlement Procedures Act, federal law to ensure that the buyers and sellers in residential real estate transactions involving new first mortgage loans, not for refinancing, have knowledge of all the settlement costs for every penny in the real estate transaction. You know what? I'm gonna take this and prevent this from being just a bulleted list. We'll just make it a sentence. There we go. Okay. Hopefully that clears it up a little bit, that slide. RESPA, the Real Estate Settlement Procedures Act, is a federal law to ensure that the buyer and seller in a residential real estate transactions involving new first mortgage loans, not refinancing, have knowledge of all settlement costs for every penny in the real estate transaction. It's illegal for anyone to get paid in a real estate transaction if it is not disclosed on the RESPA settlement statement, i.e. the CD, which is the closing disclosure, formerly called the HUD-1. Okay, and then we get the details of it down here. So before that happens, the LE, when somebody first applies for the loan, they get the LE. That's the loan estimate. It replaces the GFV, that's the old document, the good faith estimate. It must be given within 3 days of aliens, the completed loan application, with at least 7 days between the time the LE is issued and the closing occurs, right? Now the CD is the closing disclosure. This is accounting for all the final costs, or here I could say is the accounting is the closing disclosure. Replaces the HUD-1 RESPA settlement statement. Okay. And then lastly, I'm going to make another little statement down here that buyers should compare the LE to the final CD. And if the costs vary beyond certain limits, the lender is responsible for covering those costs. Okay. Nice and clear on that. It spells everything out in one place on one slide. I spell out the RESPA, the LE, the CD, and what you should do with them. Good? You could study this one slide.
Yes.
Yes.
You know what? We could add one more thing to this. On the LE, it's the estimated loan cost must be given within all this, okay? 7 days between time is closing. Certain changes may require reissuing the LE and trigger an additional 3-day waiting period. Okay. Come on. There we go. Save it. Oh, that's an awesome slide now to study from. Good for your notes. Snap a picture. Boom. Download the latest slideshow once I upload the newer replacement. This is a good slide to study from. You're welcome. We're moving on. TILA RESPA Integrated Disclosure TRID merged those old forms from the TILA RESPA Integrated Disclosure. Okay. lenders are liable if certain costs exceed tolerance limitations imposed by TRID. That's what I basically wrote here. Certain changes may require reissuing of the LE. And the lender would be required, here we go, buyers should compare the LE to the final CD, and if those costs vary beyond certain limits, as defined by TRID, the lender is responsible for covering those costs. Now, TRID, TILA RESPA integrated disclosure, TRID does not apply to home equity, lines of credit, mortgages secured by mobile dwellings, reverse mortgages, cash transactions, or loans for commercial purposes. And we got that right here at the bottom of the page. Just highlight TRID rules do not apply to the following and put a box around those bullet points. It's easier to remember when it doesn't need to be used than when it does, because TRID applies to all federally related mortgage loans used for residential purchases. But this list is shorter, remembering what it's not needed for, than the list that shows what it is needed for. All right, so the HUD one, the GFE and TIL disclosures can still be used, but they're not required to be, okay? The HUD one was replaced by the CD, but sometimes for, well, just for simplicity purposes, to keep track of all the numbers. You don't have to use it for commercial properties. You don't need to use it for refinancing. However, some kind of document would be helpful to keep track of all the funds. So a lot of times those closing agents would still use a HUD one document. Okay, this is just a recap of all these things for the LE and then the CD on the next page. Well, maybe not. For the LE, aliens, the triggering terms and all that. So page 262. I'm going to put that as cross-reference in this slide too. Now that slide is awesome. And we're at the end of the chapter. And we already have things highlighted on page 267. You guys have already the loan estimate, has something highlighted there, the last sentence under loan estimate, right? And next to loan estimate, you wrote replaces the GFE, the good faith estimate.
Yes.
And then under CD, the closing disclosure, you say replaces the HUD one you have written there.
Yes.
So then highlight the last sentence there. The CD must be delivered to the consumer no later than 3 business days before the consumer signs the loan. So that's at closing. All right. That's the end of chapter 15. Okay. Chapter 16. Here's a chapter where you got a lot of stuff on state exam. All right. Come on. You can do this. There we go. This chapter is on appraisals. Oh, wait. We got to back up. We have to do a key terms for the last one, don't we? You were eager to do it yesterday, not today?
Okay, we can try. Can check.
All right, so let's do the key terms to review for chapter 15. Agent who brings together a lender and a borrower for a fee.
Mortgage broker, 11.
11 is A, correct, mortgage broker. Bridge or swing loan for short-term financing before sale.
Term financing.
8 is B, interim financing. Cooperative organization for members who save and borrow.
Credit union.
3 is C, credit union. The FHLMC, the Federal Home Loan Mortgage Corporation, warehouses packages of mortgage. What's that? Can you sound out the letters on that one?
Freddie Mac.
Freddie Mac.
Freddie Mac, 5 is D. A privately owned corporation that sets standards and buys mortgages.
Fannie Mae.
4 is E, Fannie Mae. The Government National Mortgage Association pools mortgages for investors.
Ginnie Mae.
Ginnie Mae, 6 is F. Mortgage that provides possibility for further borrowing.
Open-end mortgage, 12.
12 is G, correct. A mortgage covering both real and personal property.
Package mortgage.
Package mortgage, 13 is H. An agent who makes real estate loans. An agent who makes real estate loans.
Mortgage banker.
10 is I, mortgage banker. They should clarify that a little bit more. A loan higher than those usually bought by the secondary market.
Jumbo loan.
Jumbo loan, 9 is J. 9 is J. Jumbo loan. Mortgage covering more than one parcel of real estate.
Blanket mortgage.
Blanket mortgage, it's a blankie, 1 is K. Additional financing for homeowners, usually a type of second mortgage.
Home equity.
Home equity loan, 7 is L. And straight loan for short building period.
Construction loan, yeah.
2 is M. Now, what is a straight loan?
Straight loan is usually, it's kind of a secondary loan, but it's directly provided, it's for the short term given on the higher interest rate.
No. It's an interest only loan.
Oh.
Short, a straight loan is an interest only loan.
Okay.
It's used for short term building periods for people who are fixing and flipping houses or builders. They gave you an example here, a construction loan. Well, it's interest only. You only have to pay back interest only on that loan. And it's for short period. When you're done with your construction, you sell the property and you get you pay back all the money for the loan in full then. You're not going to be paying the equity on the loan over the period. You're only paying interest. Okay. Key term to review 2. A percentage of income borrowers may spend on the housing expense. Percentage of income that the borrower can spend on housing expense. How do we figure that out?
Qualifying ratio.
4 is A, the qualifying ratio. Arrangement by which seller becomes the tenant.
Leaseback.
Sale leaseback, 7 is B. Larger loan that does not disturb the underlying mortgage.
What is that, the wraparound?
12 is C. Lending institution that makes mortgage loans to the public.
Primary mortgage market, number
2
2.
is D. Regulates consumer loans. What regulates consumer loans?
Number 10, Truth in Lending Act.
10 is E, the Truth in Lending Act. A loan in which the investor shares payments and profits.
Shared equity.
8 is F. Loan not intended for resale on the secondary market. What kind of loans are not planned to be resold on the secondary market?
Portfolio.
One is G. Word in an ad or words in an ad that require full disclosure of financing conditions.
Triggering term.
9 is H, triggering terms. Mortgage in which the lender sends regular checks building up debt.
Oh, that's the senior one.
It is.
Reverse.
First mortgage.
Reverse mortgage, 6 is I. Process of deciding whether to make specific loans.
Underwriting.
11 is J. Implements the Truth in Lending Act.
Regulation Z.
Regulation Z, 5 is K. Seller financing.
Purchase money mortgage.
3 is L, purchase money mortgage. Detailed loan cost. Loan estimate, 15 is M. Required items before the lender can proceed.
Aliens.
Aliens, 13 is N. And merges the TILA and RESPA disclosures.
Trid.
14 is O, TRID. The reason I drink. That's what that stands for. All right, chapter 16. Valuation of real estate. We're going to be learning a lot of theory from the appraiser because we do some of this stuff too, but we're going to learn how to value properties, the theory behind it, and then some of the terminology. And then we're going to learn about the 3 approaches to value and a lot of good stuff like that. A lot of questions on state exam from this chapter. So let's get into appraisals. At the end of this chapter, you're going to be able to describe the differences among various types of value, the theory of valuation, explaining the approaches, and discussing the profession of appraising, the different types of appraisal licenses. So, what is a market? What is a market or a marketplace? I'm going to go to the second page here. What's a market? It's a place where people come together to buy and sell goods, right? Real estate is an imperfect market because you can't take the people, you can't bring the products to the people. You have to take the people out to where the product is. You can't have a central marketplace where everybody can view all the homes. You got to take the people out to the product. So it's imperfect in that regard. So, there's 5 attributes to value, and that's where we're on at page 274 here. 1, it's finite in its supply, meaning that there's no new land being created. Whatever's here is here. It's physically immobile. You can't pick it up and put it in a better neighborhood. It's durable. Land will last forever, except for rare circumstances. You know, I mean, you could drop a bomb on it and it survives. If it's a nuclear bomb, you probably can't live on it though, right? So practically forever, all right? And 4, it has its own unique location and characteristics, right? Locations, views, and etc., right? And 5, it's useful to people. If it's not useful to people, these are the 5 attributes to land. Understandable, makes sense. So I put a highlight box around them on the top of the page. It's finite in its supply. Whatever here is here. We're not making any new land, so it's kind of limited, right? If there's a lot of land, what does that do to the value? If there's a lot of available land, what does that do to the value of the property?
Goes down.
Goes down. If it's in limited supply and it's in demand, it goes up. It's physically immobile. I can't take this beautiful property and pick it up and put it in a better neighborhood, right? It is what it is. It's where it is. It's durable. It'll last forever. What's that?
It's like supply and demand. Like if it's a lot.
Well, that's one of the things that we're going to be getting to here. Uh, that's exactly what I'm working up to. It's durable. It has its own unique location and characteristics. Because is that an important thing for value, for land to have value? Is that an important attribute to it?
Yes.
Location, 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 right?
Yes.
But would a gorgeous mountain view or a beach view, would that increase your value?
Yes. Yes. Location, location, location.
Location, 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 right? So, and it's useful to people. You know, people, it has to have a use, serve some sort of a purpose. If it's not useful to people, then they won't want it. The demand won't be there. Speaking of supply and demand. So what is supply? Well, supply is the amount of goods that are offered for sale at any given point in time. That's how much do we have of the goods that are available? If we're limited in supply and the people want it, we can ask more for it and they'll pay it, right? So if our supply is dwindling and the demand remains constant or increases, the prices go up, and vice versa. The reverse is possible. So demand is the number of people willing and able to accept the available goods at any given price during any given time period. So when supply increases, prices will drop. When demand increases, prices will rise. So
supply and demand.
Supply and demand, that's a theory. It's a theory of supply and demand, but the theory is proven true time and again. Just look at eBay. Tell me you never bought anything and you were like, man, I overpaid for that crap.
Yeah.
You get caught up in it sometimes, and people do when we call them bidding wars in real estate. Okay, so the business of value. What is value? Value equals 100%. The word value means 100%, but it's a monetary worth of goods, products, or services offered in a marketplace at any given time. You know what? That does not need to be a separate slide for each thing there. Hold on. What slide is it? Come on, man. Here we go. This could all be on one. And that don't need to be a bullet point, period. There we go. Value equals 100%. You know what? I'll keep that as a separate. Okay. So value is the monetary worth of goods, products, or services offered in a marketplace at any given time. Value is equal to 100%, because anytime we talk about value, we're talking about 100% of it. And when we're trying to determine the value of a property, what are we trying to determine? How much half of it is worth or how much the whole is worth?
It is worth.
Yeah, the whole thing. So value is equal to 100%. And it can be described as the present worth of future benefits. Well, that's one definition of it that you'd probably need to know on an exam sooner than later.
Damn, say that again. Oh, okay, I see it. Present worth of future benefits.
Yep. How much is it worth right now? How much is that property worth right now to you?
Okay.
Now you're basing that based off of your future benefits too. Look, what if it's a commercial property? Well, the definition of value would change a little bit if it's commercial value property. It would be described as the present worth of future rights to income. But wait, isn't future rights to income a benefit too? Yeah.
Yeah.
That's the present worth of future benefits. Now, value does not remain the same over time. It varies as the market changes at any given place in time. Real estate market fluctuates. Values go up and down for that same property. The value can go up and down over a period of time. But historically speaking, that value, that curve, since we like talking about like coronavirus and curves so much, that term irks the hell out of me. I don't know about you guys. When people talk about the curve. Got a bunch of idiots trying to act like medical experts. All right, so the curve of a real estate market, okay? So here, we got the same house. Here's the house. Boom, boom, boom. That's the house, not a rocket ship. Now, its value would fluctuate over time. You bought it for one price, it goes up, or it goes down. It goes up, and it comes down. But historically speaking, overall, where is it going? Now, we may have large fluctuations where it goes down, but it goes up again and it goes up, right? So, but overall, if you bought it at this price here, if you bought it at this price here, this is your starting point. Only here and here did it dip below what you purchased it for. That's the highest it's been, right? And here's the highest it's been again. So market values fluctuate. They go up and down. On this side of the line you're in the green. On this side of the line, you're in the red. That's a loss, right? But either way, historically, real estate markets fluctuate. There are up periods and down periods. Now, when do I buy?
Down period.
Yeah, but how do you know you're in a down period? That's the thing. You don't know if you're in the up slope or the down slope until you already buy. You got to get in the market before you could find out. Now, you could try looking at the curve over the prices over time, and you could take a look and see, well, what was it worth last month, 2 months, 3 months ago? And you could start to build that curve, that picture for yourself in that graph. And if you see that you're starting on a downward slope, as an investor, is it good to buy high or buy low?
Buy low.
Buy low, sell high, right?
Yes.
So if it's headed downward, that may actually be a good time to buy.
Mm-hmm.
Provided that you're not buying here at the beginning of that downward curve, because then you're going to lose a lot of money, or you're going to need to hold it for a long time before it comes back up to that same level, right? So a lot of times people come to us and they want to know, so what's going on with the real estate values? You think prices are going up or down? Look at this curve. Really? I wish I had that crystal ball that I could tell you that. That's what you should be telling them. Because if you say, oh, we're going up for sure. Well, you know what? I like to tell people, well, real estate is historically cyclical. Prices go up and down. Where are we in that curve? I don't know. And now, generally, if you hold the real estate for the long term, it will appreciate in value. It's a good long-term investment. In the short term, up, down, up, down, up, down, your gamble guess is just as good as mine. Now, what are you buying it? To fix it and flip it in the short term? Then you got to make that decision. Are you buying it to live in and for years and then sell it? Well, I can tell you it's probably a good investment for that. Right? That's the way you explain things to people. Be real with them, but be honest. And don't try to pretend that you have some kind of secret knowledge. Now, here's
If they're trying to flip due to the market, like based on the market, that's never a good idea.
Not a lot. I want to buy it this week and sell it in 2 weeks after I do some work. You may lose some money.
You may lose a lot of money.
You may. Okay. And that depends what kind of work you did to it, what the condition was to begin with. Did you get a good deal on it too? There's a lot of factors that play into it. But generally speaking, if you buy a house this week and you try to sell it next, you're probably going to lose money. Unlike the stock markets, like stocks and bonds, where you could buy in the morning and sell an hour later because the swoops go up and down really quick, right? The values of stocks. Well, it doesn't work that way in real estate.
Hell no.
So here's a good tip for you guys. I told you about this class before, and I think I emailed it to everybody too. This Ottawa class I told you to take to learn about how to value properties, it's coming up. It's coming up in a week or two. I sent the whole class an email on this, that you could just go to their website. They're going to be doing it, but it's not going to be in person. It's going to be online. Okay. But either way, this is an excellent class. I'm going to take it. Where you get all those graphs. Remember, I told you about the different charts like how do you find out how much a pool makes a house worth, or an extra parking space, or an extra bathroom or bedroom, you know, how to get the value on it, how to determine the value. Remember I showed you that guys that I showed you guys that paperwork? Here, let me pull it up again. From the Ottawa workshop. You want to look up the CMA workshop.
When is that coming up?
It's coming up in a week or two. I think it's like 70 or it's like $70 or $75 for the class.
Yeah, $70.
Yeah. It's a good class. I highly recommend it. I don't make money off that. I got nothing to do with that guy. But it's a good class. Last time I took it was 2015. I'm due. I want to get that latest information from them. Remember this are some of the note supplements that I got from them.
Mm-hmm.
Here's that guy that's the teacher. This is Jeffrey Ottawa, or Atao. I know I'm bastardizing his name. Sorry.
I'm sorry. I actually tried the cheaper way. I went on YouTube to try to see if he had any video.
Yeah, nobody records in those events, and he doesn't put them online. Plus, it doesn't matter. It varies. He does these every year.
Yeah.
And even he has a quarterly workshop. The CMA workshop is only done once a year though, because he really dives into how to price properties.
Mm.
And then what you could do is you could subscribe to his quarterly workshop that you could actually take the class quarterly, or they'll just email you the supplemental materials after you sign up to this class. And they give you updates on the pricing, on how it works. See, this goes over a lot. This is his presentation or his old presentation, and he's got to explain a lot. Okay, here's the good thing here. These kinds of notes that he includes in the class.
Mm-hmm.
You know, how much more or less does it make your house worth if for a home up to $250,000 if it's on a busy road? Well, it'll affect the price by 4%. Now, if the house is $250,000, that'll equate to $10,000 in difference of price. So, and he's got it for the different homes in different price ranges, for everything, for all the details and improvements, and if it's got solar panels and all that stuff. He covers all that stuff in these classes. It's a good class to take. You'll start off, instead of relying on your broker to teach you how to price properties, because that's not what this class is going to do. This class is going to teach you the basic theory of it, but how do you put a value to a bedroom or being on a private road or what have you? Well, you take a class like this, experience, or your broker teaching you, but does your broker know how to price homes good? Probably.
I actually want to thank you. I've noticed like a few things you did for us to to help us to to approve and actually do what we have to do as real estate agents. But I seriously thank you, because some of the brokers really don't take time out and actually do that. My mom's a real estate agent and she tells me all the time. So the fact that you're even giving us this guy in the CMA class and workshops, I
want you, listen, I want you, the turnover rate in real estate, that means the failure rate is high.
Mm-hmm.
You'll know in your first 6 months if you're going to make it in real estate or not. All right. I want you guys to at least get a head start here. Get a class. Don't rely on your broker to give you the training. Look, your broker may train you on this, but are they a good trainer? And do they even know how to price homes properly themselves? Or do they pick a number out of thin air? You know, how are they going to teach you how to do that? If the broker's pricing homes just on experience, well, how are they teaching you to do it? You know, plus experience isn't the most accurate way. That means they list the price here, and then what does it sell for here? So that means that their listings take longer to sell. It stays in the market, it gets stale, the homes sell for less. The better job you could do in pricing a home, the better chance of selling it. Now, even though you could go through a lot of work learning how to price homes properly, ultimately, who sets the price? Who sets the asking price?
The seller.
The seller does. So now, after you've done all this hard work to do the research, then you do the presentation to try to convince the owner of the property. And they still may not be working in reality. You know, so it's our job to try to convince them that, listen, you don't want to overprice the home, because if you overprice that property, any buyers that come in that are looking in a higher price range, they're like, wait a minute, this house isn't of this value.
Right.
They're crazy. They're overpriced. So then they walk out and they don't buy it. That house gets stale being on the market for a while. And then when the homeowner is willing to lower the price a little bit, by then people who are looking in that price range, they're looking to see how long has it been on the market. And then if you ever shop for a home and before you ever went to go see the house, you look to see how long it's on the market and it's been on the market for a long time, what's your first thought?
There's something wrong with it.
The price.
Now, I didn't say that, you did, right? So I'm not putting words in your mouth. I asked you, what's the first thought that's in your head? Something wrong with it. What's wrong with it? And that's the exact thought that most consumers have. So you got to convince that owner of the property, hey, listen, you got to take my advice on how I'm trying to help you. And if you don't want to trust my advice, listen, pay for an appraisal. Get a professional independent appraiser if you don't trust me. I'm trying to help you. And I was trained by appraisers here. Look, I'm not an appraiser, but you know, we go through the same theory. But I bet you if you get an appraiser that comes in here, you're not going to like his price any better because he's going to be more accurate than me. And I bet you your home's going to come in at a lower price. So you got to put this information across them. But yeah, it is valuable information because I want you guys to do good. Thank you for that compliment, by the way. I do offer you guys a lot of information and tips for how to advertise, market, price homes properly, because I want you guys to do good when you get out there. It's not just a matter of passing this exam, even though we're limited on the time here. That's why we kind of go over, because I spend the time to give you this extra stuff. But you're going to need it. And how are you going to know if nobody tells you about it? Most of your brokers may not even know about this class. Only good agents actually take classes like this. I worked in the industry for years and I never heard of this Ottawa guy. And somebody told me, oh yeah, those classes are great. Because I got an email. I said, did anybody ever hear this? Nobody ever heard of it. I came across one agent. She was a top producer. She was like, oh yeah, that's a great class. You got to take it, you know? And so you see there's select agents that actually take these classes that actually do well, if they actually apply the information they learn. All right, so let's go back to this. Let's go back to the slideshow here. Okay. How come we're not going back to the slideshow? Are you guys seeing the slideshow, or what are you seeing right now?
Yeah, the slideshow.
Okay. So here's that CMA workshop. That's a good thing to take, or you could take those seasonal workshops, which is basically a market forecast on from the appraisers telling you what's going to happen in the real estate market. Now, remember, I told you I never tell people that because I don't have that crystal ball. Now, they don't got a crystal ball either, but they do a lot of data aggregation from a lot of different databases and public resources and private resources. And then they aggregate that data and they break it down to forecast what's going to happen. And they do a pretty good job at it too. And listen, you don't got to take my word for it. I'm not trying to sell these guys on you, even though it sounds like I'm giving a hard sell, because I just think that they do a good job. If we go to that Ottawa website, did you guys take a look at their client list at all? Who they create these presentations for? Now, they created this custom thing for training agents, but let's look at some of their, oh, they used to have it listed as client lists. Case studies, testimonial. Oh, here we go, client list. Let's take a look at some of their clients that value the presentations. They pay them a lot of money to create presentations for them. Let's see, and consult with them. Look at some of these Fortune 500 companies that they consulted with. Financial institutions, developers, and some of these could be investment groups and other companies that look to them for advice as well. These are some big names that you're seeing up here. Governments. You're seeing governments, local towns. Oh look, wow, even my town was on there. Take their advice. Law firms, because they also act as legal experts. Healthcare, hospitals, when they want to acquire land and sell land or look for geographical areas, they get advice from them. All right, so anyway, enough time on that. Okay, so real estate is the value of the business, and how do you determine it? Take one of these classes. Situs. I pronounce it situs. I think the actual pronunciation is situs. It's Latin for people's preference for location. So what's one of the major factors in affecting value? Location, location, location. So once you seek out, if you're going to build a house, you want to seek out that perfect property that's central to the location, to where you want to be, that maybe has a nice view, and you're looking for other factors. But once you find that perfect piece of property that you want to build your house on, what do? You say, we're going to sit us right here. That's how the definition works for me to remember. That's how my mind works anyway. But the word is pronounced situs. I mispronounce words so I can remember what they mean. Situs works for me when I say we're going to sit us right here. Where am I going to sit myself? In a location that I like, right? And that's exactly the definition of situs or situs, which you will get on exam. All right. I have some other miscellaneous notes here about situs, about how when the country was forming, how the government was giving land to people. We had the Great Land Rush. Where the hell was that located? Oh, forgot what state that was in. But anyway, you had that Great Land Rush where people actually had races. The government actually had races. I'm going to pull it up real quick. Where they would give everybody a flag, and there were pieces of land, areas of land that were like 160 acres of land that were already set out, measured out. And it was a race. Whoever can get to that land, you race out, you find the pieces of land that were already mapped out, you get a flag with a number in it, you plant your flag in there, and you make your claim, and that land is yours. All right. So they had some races for that. So here's the Homestead Act. The Homestead Act is where people can just claim that land. They get 100 citizens, we get 160 acres of unoccupied land. Okay. This was signed into law by President Abraham Lincoln. It became law in 1862. That was the Homestead Act, so people can stake out their own piece of land and keep it for themselves. Okay, here's an actual photograph from the Great Race. And okay, it was in Oklahoma, the Land Rush. They actually made a movie about this that had this race in it. This was with Tom Cruise and Nicole Kidman, called the what the hell was it called? It was called Far and Away, where he was an Irish immigrant, or him and her, they were both Irish immigrants. That they were. She was a little bit from a well-to-do family, but she wanted to break away from them because they were too restrictive, and he was just a poor worker, Irish immigrants, they were looked on like dirt. Okay. They were treated like dirt. So he, him and her, they came out here, they actually became an odd couple, and then they got involved, and they fell in love, and then they actually seeked out their own land, and they actually got involved in this race over here. So I'm not going to ruin it for you, but it's an interesting little story of history there. A lot of the Irish people, Irishmen, certain foreigners were put in the same category as the blacks were back then, the slaves. They didn't like either one. So neither one were looked upon in a very good light by people back then. Or some people back then. So it's an interesting little bit of history. And we're back to here. Okay, so here I have that little homesteading scene from Far and Away. Is actually using that same picture. They actually did the race, so you could reenacted it. All right, so now value has 4 economic characteristics for real estate to have value. Now, value is described as the present worth of future benefits arising from the ownership of real property. And in order to have value, there's an acronym here, DUST. There has to be a demand for the property, a need or desire by someone who can afford to buy it or willing to buy it. Utility means that the property has to serve a human need or desire. Scarcity, it has to be limited in its supply, because if it's an abundant supply, the value goes down, right? If it's limited in its supply, the value goes up. And transferability. If the ownership of the property is not easily transferable, then the value is just not going to be there either. So let's go to the bottom of page 274 and highlight the definition for situs first. It's the very last paragraph from the page. We're going to highlight the first line. The location of a particular property and people's preference for location is situs or situs.
I like situs.
Yeah, me too. Me too.
Where you gonna sit on that?
I know it's improper, but I'm not proper. I'm not going to be politically correct. I'm going to do whatever helps me remember. Okay.
Yeah.
So situs or situs. We're going to that's right here, right? That works for me.
I like the little strategy terms. I like them.
The mortgagor is the borrower. Crap like that works, so I use it, How many feet in an acre?
To the left, to the left, to the right, to the right.
Left, to left, to the right.
Count to 6, starting with 3, to the left, to the left.
43, 560.
43, 560. There you go. It works.
Yeah, that's real clever.
It's stupid stuff, but it works. It's stupid the way I explain it, but it actually works. It may be silly.
Is it stupid or is it genius?
It works. It works. All right. So on page 275 at the top, that's where we have the DUST acronym and demand, utility, scarcity, and transferability. Now, it's not necessarily that we need to memorize these things here, but we need to understand them for exam. Because you could get a question on exam that's worded like this. Out of these 4 economic characteristics of value, DUST, which one of the economic characteristics of value apply to this situation? A developer just built a complex with 500 homes down the street. And you want to purchase a property if the city will give you a permit to put in a combination laundromat convenience store.
Utility.
Utility, serving a human need or desire. If you have that many homes in the area, you're going to need a laundromat and a convenience store, right?
Mm-hmm.
All right. So that's how it could be. That's how it could be worded. Okay. Or they could ask you a question: which one of these is or is not one of the economic characteristics of value? But I don't think they're going to go there. I think they'll ask it the way that I did. Then you don't have to memorize them all. You just need to know how to apply them. Ooh. Now, what is an appraisal? It's an unbiased estimate or opinion of value that's based on supportable evidence and approved methods that the appraiser was trained to value the property with. So if you got one appraiser and have another appraiser that comes in, they should be relatively close to each other on price. They're not going to necessarily be exactly the same, but they'll be in the same ballpark. Now, what is an appraiser? Appraising is a profession that requires licensing. So the appraiser is a licensed person who they're independent. They don't work for the bank and they don't work for you as the buyer. The bank just pulls them from a list and the buyer is the one that actually has to pay the appraiser. But that appraiser is giving their unbiased opinion of value because they don't have a stake in the game. They're getting paid either way. So it's a fee that's paid by the borrower, the lender selects them, and they provide that unbiased estimate of value. So market value, we learned about different kinds of value. We already learned previously in chapter 8 when we talked about taxes. We learned about a value that's used for taxation purposes. What would that be? The value that's used for taxation purposes? Assessed value. Remember, the assessed value is a value that the tax assessor applies to the property, and then they multiply that by the tax rate to determine what your taxes are going to be. So market value, what is that? It's a price that a ready, willing, and able buyer who is not forced to buy will pay a seller who is not forced to sell, provided that the property has a reasonable exposure to the market. And market value is the most probable price that the property will bring. Now, to determine market value, it's based on supportable evidence. We as real estate agents, as well as appraisers, will help a homeowner or buyer determine what the market value is based on supportable evidence. That supportable evidence would be something that we call comps or comparable properties. Comparable properties are properties that are similar in size, style, location, and amenity to the subject property we're trying to determine the value to. We compare them for their differences because no two homes are exactly alike, usually. That's rare to find when we're looking up comps. I shouldn't say no two homes are exactly alike, because I had situations before where one builder used the same blueprint to build the same house, 5 of them on the same block. And I had one of the guys wanted to list his home for sale. So I go to his house, and the house 2 doors down from him just sold just a couple of weeks ago. One of those exact same houses as his. So how much should his house sell for?
The same as the
It should be in that same price range right there, right? It should sell for the same. So I could look up other comps in the area that may show a little bit slightly different style of house, different year and age that to the houses. There's going to be differences that I'm going to have to make adjustments for. They could all be 3-bedroom, 2.5 bath, but they could have a lot of other differences. So I have to make adjustments to that price if I really want to narrow down the price range. But you know what? If you got a comp like that, the exact same house that was built in the same year just sold, that's the price. That's the price. Okay. Forget about the other comps. That's the price. Because if I look up comps, I look up multiple comps and make adjustments for the difference to try to make it exactly the same. We got an exact same house right here. It don't get better than that. You got lucky. So I got this guy the price. I figured out what the price is. Okay, so that house that just sold 2 doors down sold for $340,000. So I asked the guy, I told him, well, that's the price. That's what we need to list it for. So what do you want? What do you want to sell for? I want 380. Okay, all right. Hold on. I'm not going to blow up on the guy. Hold on a second. Have you done any improvements to the house since you bought it that I need to be aware of? No. Okay. Then if your house is exactly like that one, why is yours worth $40,000 more? That's what I want.
Now, would you have to go off of the price that it sold for or the appraisal price?
Well, what it sold for? Well, it's not going to sell for more than the appraisal price.
Oh, I'm saying like
generally speaking. But if it does, that's a comp. That's a legitimate sale price.
What if you got a seller that was, I guess extra motivated? The house came and appraised at $350 and he sold it for $300,000. Now, would that property that you're looking at with the same exact structure be worth $300,000 or is it $350?
No, it's whatever the going rate, what it's actually selling for. And look, you're not supposed to, when determining value of property, you're not supposed to take into consideration distressed properties. because distressed properties, they're not under normal circumstances. Look, if we finish reading this definition, it's the most probable price the property will bring. It's based on supportable evidence. Cash or its equivalent had to have been used to determine its value. And it's the buyer or seller has to be acting without undue pressure. Now, if the property you have to sell because you're getting foreclosed on or what have you, there's undue pressure involved. It's distressed because, oh, I'm getting divorced, I got to sell it. It's a distressed property. You can't use that as a comparable when determining values of a property. The real estate market values are dropping and I bought it for way more, so I got to drop the price. Short sales. I'm doing a short sale. Okay. You're not supposed to use short sale prices as comparables when determining a value of property. But let me ask you a question. What happens if the majority of the homes on the market are short sales?
Then your property fall into that category.
Guess what? Now that's the norm. Now we could use them. It depends on what's going on in the marketplace. And when the market was crashing, at the beginning, they were like, no, you can't use that. It's a distressed property. I'm like, look around you. They're all distressed. So they had to accept it. So it depends on what's going on in the marketplace. But these are all factors. This is part of the theory. But the theory is based on supportable evidence of the recently sold homes. I mean, we could show what's going on in the neighborhood. It's not like it's a secret how I'm coming up with the number. I could prove it, right? So I had this guy, he's neighbor sold for 340. He wants 380 because that's what he wants. Does a buyer care about how much money that the seller wants to get when they're making their offer price?
No.
No. They care about whatever the current market value is, and then they're going to try to get a little off of that because they want to get a good deal, right? But at the best, what are you going to get? Whatever the market value is, whatever the going rate is. Because if you don't pay it, someone else will.
Yeah. Okay, I see how it makes sense. It's like the stock market. Once the person pays that price for the share, then that's the price of the share.
Yep. Hey, if you don't get it, somebody else will. But is somebody else going to be like, oh, well, I'll pay 40,000 extra for it? Why? Why? You got to justify it some way. So I asked the guy, I was like, listen, I'm trying to work with you here. I said, but you got to show me, there's got to be something to justify that difference in value. Because would you agree that most people don't have the cash to buy a home outright? Most people they buy a house with a mortgage loan. So they're going to be, anybody who's getting a mortgage loan is going to be dependent on an appraiser appraising the home's value. And they're going to use that as a comp. Comps don't get better than that. They're going to focus on that house 2 doors down from you because that is the house that's exactly like yours. That's what they're going to base the value on. I'm telling you right now, your house is not going to appraise for 380. That's what I want. I'm like, okay, you got to help me help you. How would I convince an appraiser to appraise the house for 40 grand more? You know what the guy told me?
What?
That's not my problem. That's yours.
Oh, okay. I'm not eliminating the whole problem.
Well, listen, I'm not blowing up. I'm not going to blow up on people. Sometimes people are rude, whatever you. I told the guy, listen, but I'm going to be straight up with you. I'm going to say, listen, my job is to work in reality. You want me to work in fantasy land here and come up with a number based that cannot be supported by any evidence. An appraiser works based on supportable evidence. You got to help me help you to try to sell your home. And he's like, well, that's your job. I'm like, yeah, but my job is to deal in facts and supportable evidence. And there are no facts here that you're helping me with. You got to give me something. And the guy's like, oh, okay, well, the property is 8 years old. When I bought the property, 8 years ago, or 8 or 9 years ago, I forget which one it was. Let's just stay with 8. I bought the property 8 years ago. I didn't like that builder's carpet, so I replaced the carpet. Like, okay, keep in mind, most of the house was hardwood floors. There was only carpet runners and in the bedrooms. Okay. Plus, the carpet is 8 years old now. Right. All right. And then I didn't like the sinks and the toilets that he used. Plus they had little nicks in them. So I replaced them and there was 3 bathrooms. So he's like, I replaced the sink and the toilet in all the bathrooms. Is that going to increase the value of the home? Let me ask you a question. When you buy a house, do you expect it to have a sink and a toilet in the bathroom?
Yes.
So because he replaced the sink and the toilet, does it make the house worth more?
No.
No. You expect it to have a sink and a toilet. Now, look, even if he upgraded it to put a super nice sink and toilet in there, that may make it more desirable, but it's not going to add a whole lot to the value. Let's just go with it and say maybe it does. Maybe he put in a heated toilet seat that's gold plated. I don't know. I'm, trying to go with it here. Am I still getting a $40,000 difference in value here? No.
No.
So sometimes this is what you got to deal with when dealing with clients. Now, I could tell this guy was going to be a difficult person. Normally, I'd be like, okay, we'll take it for a higher price, and then we'll just, I'll just start knocking you down on the price later when we see that it's not selling and we're not getting any showings or what have you. I'll be like, see, and then try to get you to come down. And even if you don't, well, I'm going to get buyers off of you that came in to see your house and they're like, I ain't buying this shit, it's overpriced. And then I'll show them something else. Okay. But if you got a difficult client like that, that's not, this guy, I could tell he would be one of those people that wanted to, me to do an open house every other day for him and to market it in places like the New York Times and places that we don't normally advertise our regular homes in. I could tell that he was going to be a major pain in the ass. So you guys remember what my metric is on how to determine if something is worth it or not?
Is the juice worth the squeeze?
There you go. Is the juice worth the squeeze? And I looked at this guy and I was like, the juice ain't worth the squeeze on this guy. He's going to be a major pain in the ass and it's just not going to be worth it for me. So at one point during the conversation where I keep repeating myself and he's agreeing with me now but he's like, oh, how much do you want? 380. Okay. At one point I just got up. I gave him my business card. I shook his hand. I said, you know what? It's a pleasure meeting you. And he was kind of shocked about this, because I stood up and I shook his hand. I gave him my business card. I said, it's a pleasure. It was a pleasure meeting you. But I could see you're not ready to sell yet. When you're ready to sell your home, I'd love the opportunity to sell it for you. But I mean, I'm not in the business of just taking listings for the sake of collecting them. If I don't think I could sell your home, I'm not going to take the listing. So once you feel like you're ready to actually sell, here, I'd feel free to give me a call. I would love to talk to you. We could sit down. We could go over this again. Okay. Until then, have a nice day.
For real? You could do that?
Yeah. I just walked out on the guy. I basically tell him, screw you, buddy. But I did it in a polite way and I didn't turn him down. So he could call me again, if he wanted to. But I kept a close eye on the property. He did list it with another agency. Remember I told you how much he wanted for the house?
380.
Okay. Now we didn't even get into the conversation of my commissions. We were just talking about the value of the house. He wanted 380 in his pocket. So when the agent listed the property, they had to add their commission on top of that. They listed the property for more than $400,000.
Wow. That's something.
Woo, I got out of that one. Man, imagine if I get him to finally agree on a price and then we got to add the factor in the commission into it. Oof.
Did they sell?
No, didn't sell. The listing agent, she got a 1-year listing on it. It expired a year later. He never budged in the price. Then he relisted the property with another agency for 3 months. Now he's taking 3-month listings. It was at the same price, didn't sell. He relisted it again for another 3 months with a different agency, but this time for a little bit, lowered the price just a little bit, didn't sell. Listed it again. I think he listed it 2 more times. It was about 2 years before he finally sold the property. Okay, now look, time is money too. And especially depending on which direction the market is going in, right? Time is money. Now, how much could I have sold it for?
350.
We know I could have sold it for 340 because that's what the neighbor's house sold for. So let's just go with that 340. All right. Back then, strike while the iron's hot. He wanted so much. Where did it get them?
Where?
How much do you think it sold for?
320.
280.
Oh.
2 years later.
After 2 years, wow.
After 2 years, the market was declining. And now as he finally started lowering his price, what we call it is chasing the market.
Oh.
Okay. He started chasing the market. The market value is down here. He lowers his price here. Hold on. I don't know if you can see my fingers that well. Let me show you on the board. So
The market was going down. He was trying to.
yeah, he started what we call this chasing the market. So what happened was his price was up here and the market price was over here at the beginning, right? Now, market prices start dropping. He stayed up there for a while, but then when he started dropping, the market's already down here. So when he dropped his price to here, well, the market's already down here. He's still got that big gap. And when he decides to lower the price again over here, by then the market was down here. He's chasing the market. The only way for him to catch up would be to make a drastic drop to beat the market. And then to get interest in the from the public. That's the only way you're gonna sell the home, and that's eventually what he had to do. He was chasing the market. He found himself in that unfortunate situation because he was greedy, wanting too much at the beginning. Listen, whatever the market value is, you got to go with it.
What do you mean interest from the public?
Sorry?
What did you mean interest from the public?
Well, the buyers. There weren't that many buyers out there when property values started dropping like crazy. Okay, now you got limited buyers to choose from. Now, if the buyers got a lot of inventory out there to select from and they see your house is way overpriced, what do you think they're going to choose? Well, not yours. Right? So, but there's another factor. You could take these classes and learn how to price homes properly. And sometimes you still find yourself, it's like banging your head against the wall when dealing with some of these homeowners, if they're not dealing in reality. So we have to stay calm, try not to get frustrated, even though sometimes you're going to be like cursing this person out in your head, you know, try not to let it come out of here. Okay. You don't want to burn any bridges because sometimes they may come back to you later to try to sell, you know, and you don't want to get a bad reputation or have people talking crap about you, you know, try to legitimately help them. If the person is a total jerk and they're not dealing in reality, do what I did, shake your hand. Thank you for the opportunity. You know, I see you're not ready. When you're ready, you know, he may have taken that as a dig. Well, it was meant to be a little bit of a dig at him, but also to slap him into reality a little bit. You know, that I don't want your listing because you're just not realistic. Now,
I have a question about that.
Yeah.
Now, instead of saying, I don't want to work with you again politely, like, can you just refer them to another realtor instead? Can you just like give it to somebody else?
To do what? To take an overpriced listing?
Yeah.
As a reference.
That wouldn't be nice.
Are you going to make money off of that?
No.
Well, really, no, but I just don't want to deal with the person.
So then why? Yeah, but you know what? If I'm not going to make money off of it too, why am I going to waste time taking it as a referral to send it to someone else when I know it ain't going to sell? It sold 2 years later. How many different agencies did it go through though?
And what did it sell for? That's the important part.
Yeah.
It sold for 280. He could
Yeah.
have sold it with me for 340.
And he'd been good.
Yeah.
2 years later. 2 years later, he's wishing, oh, I wish I listed with that guy. I kept an eye on it, but I didn't reach out to him again. He had my card. He could reach out to me. I wasn't going to be reaching out to that one. There's plenty of other listings out there I could get. I got better people I could waste my time with or not waste my time with, right? Time is money, guys. You got to value it. There's a lot of people that will work with you to want to look for homes, but are they dealing in reality? First of all, can they afford to buy a home? Before you go running people around, pre-qualify them. You don't want to go showing people homes left and right. You're showing them homes for months. You finally find them a home that they want to put an offer on. And then you go to get a pre-qualification from them and their mortgage rep is like, dude, the guy's got a 490 credit score. You know what you're buying with that, right?
Yeah.
Nothing. You ain't buying nothing with a 490 credit score. 620. Anything below 620 is considered subprime. You're going to have a hard time getting a loan. So if I took that time at the beginning to pre-qualify them, then before you ever take people out, and make sure that they're aware, listen, you need money also. How much money do you have? You're going to need money for down payment. If it's an FHA loan, a minimum of how much?
3.5.
3.5% down payment is going to be required. And then traditionally, how much is closing cost? 2 to 3% of the purchase price. Okay. Traditionally, it could be a little bit more, it could be a little bit less. But if you don't got 6% or 6.5% of the purchase price, you're probably not going to buy. Now, there's ways I could still get you the home if we could find a seller that's willing to give a seller's concession to pay your closing costs for you. Then we could still buy you a home with 3.5%, but you're going to need some money. You're going to need some skin in the game as well. You got to do your legwork before you start doing your legwork running them around. You hear me? Saving you time, saving you money, saving you frustration. And then what did I tell you about them? Are you going to be driving them around in your car?
Nope.
No.
Have them follow you. Because listen, I'd like to be chauffeured around all day. That's nice. Right? Getting chauffeured around all day.
Yeah.
I've got to make a decision. Well, maybe we could do it again tomorrow. All right. But when you're the one that's driving around using your gas, frustrated driving through traffic, trying to find parking spots, you're going to make a decision a little bit more. You're going to be like, oh, I don't want to do this shit forever. All right. So moving along. So that's market value. Market value also assumes that it's an arm's length transaction. Another term to know, arm's length transaction. What is an arm's length transaction? It's a transaction between people. Actually, instead of me trying to do this from the top of my head, I got a good definition written here. It's a transaction between parties who are relatively strangers to one another, meaning that they're not close. Each is trying to do the best for themselves. So an example of what is not considered an arm's length transaction would be a brother who sells a home to his sister, provided there's no family drama and they love each other, okay? No comments from Peanut Gallery in this one, okay? So this cannot be used as a comparable property, because what are the odds that the brother gave the sister a break on the price? They're pretty good, right? So that home really did not sell for market value. Market value assumes an arm's length transaction where the seller's trying to get the most money they can for the house, the buyer's trying to get it for the least, and wherever it sells, you know, then you would have your comparables that you could use. But you cannot use a property as a comparable if it was not an arm's length transaction. Now, appraisers do a little bit more research into arm's length transactions than we as real estate agents do. But either way, the appraiser is ultimately the one that only matters anyway, because they're the one that's going to be getting the determining the value for the loan. All right. So arm's length transaction, a term you need to know as well. So under market value, second line at the end of the line, we're going to highlight an appraisal is an estimate or opinion of value based on supportable evidence and approved methods. And an appraiser is an unbiased person, is an independent person trained to provide an unbiased estimate of value. Y'all got that?
Yep.
Okay. The next paragraph, we're going to highlight the 3 lines there, almost 3 lines. It says the market value of real estate has been defined as the price that a ready, willing, and able buyer who is not forced to buy will pay a seller who is not forced to sell after the property has had reasonable exposure to the market. Now, also included in this definition is everything in that bulleted list, but we don't need to study it all, but it is also including the things in this bulleted list, which is market price is the most probable price to value. Oh, it's all the stuff I have here, okay, that we already went over. Underneath that list, highlight arm's length transaction is one between relative strangers, each of whom are trying to do the best for themselves. Okay. And then next we got market value. In order to determine market value, the buyer and the seller are well informed about the property's assets, its defects, and its potential. Because how can you properly price a property if you're not aware about what's wrong with it or what its potential is? So, real estate and the value of business. Cost. Here, this is a nice little guide I put together here for you. Cost relates to the past. The word price relates to the present. And value relates to the future. So, the price of a property, market price, we're going to highlight. On the other hand, is what a property actually sells for. It's the selling price. See, we try to determine market value, how much it's going to sell for, based on supportable evidence. Market price, in a perfect world, market value and market price are one and the same. Here, this is a good slide to study that. I got the differences between market value, market price, and cost. So market value is an estimate based on analysis of comparable sales based on solid data and evidence. It's going to be the current value. Well, the current value is based on the projected sale price. Which, hold on, sorry. Okay. Now the market price, it's the selling price. In a perfect world, market value and market price are one and the same. Market value is an estimate of the price based on homes that have recently sold that are similar in size, style, location, and amenity to the subject property. Subject property is the property in question that we're trying to determine the value for. The market price is what the property actually sells for. It's the selling price. Cost is the total fee to construct any improvements. So cost usually has little to do with value unless it's current, okay? Sometimes sellers tell us, well, you know how much it cost me to do that upgrade? You know how much it cost me to do that improvement? When did you do it? How long ago was that? Because that value, the value of that improvement is older now. And look, even when you first do an improvement, what says that you're going to get 100% back of the value of the money that you put into it to do the improvement? Do you know that most improvements do not pay 100% back? That's only when you're watching HGTV and they're projecting what the value of the price is afterwards. Do they actually tell you what it actually sold for? Only on the flipping, on the ones where they actually show you the sale, which is most of the shows are like the zombie homes or things like that. Those are the only ones where you're really going to see that. But then again, what are they starting out with? Right? So cost has little to do with the current value. Cost relates to the past value. Buyers don't care what improvement costs were. They care about what the current value is. And not all improvements will pay for themselves. Which improvements will pay back the most?
Kitchens and bathrooms?
New roof.
Kitchens, I would say that the improvements that pay back the most are are probably kitchens. Second to that would be bedrooms. Bedrooms and bathrooms, probably about a tie, but you're not going to get 100% back on either one of them.
What about
When I say bedrooms, I'm talking about square footage, because appraisers don't count number of bedrooms. They look at square footage. You know why? I'm going to draw you a picture and tell you why. I'm going to give you a perfect example. I sold this house in Somerset. And now this house in Somerset, okay, I'm going to try to simplify this a little bit. They did a lot of improvements. They had bigger rooms. They actually put an addition on the house to make it bigger. So they got bedroom here. Now this bedroom actually had a walk-in closet. It actually even had like a changing room in between. It was really, really fancy. Had a bathroom inside of it, whatever. But let's just look at the bedrooms. Let's just forget about all these details. You got one bedroom here. Got another bedroom here. Yeah, let's just say this house has 4 bedrooms. Okay. And then you got this house that's the same exact square footage. Okay. And this house has 1, 2, 3, 4, 5, 6 bedrooms. This house has 6. This house has 4. Is that house worth more because it has 6 bedrooms?
I don't think so.
Yeah.
It's the same square footage. All they did is they take 1 bedroom and they cut it in half and made two more bedrooms out of it. Oh, actually, it had 5 bedrooms, not 6. Sorry. Here, let's say they do it again. Now you got 6 bedrooms. Is that house worth more because it got 6 bedrooms versus the other one that's got 4?
No.
Well, this one's got 4 big bedrooms and this one's got 2 big bedrooms and 4 tiny ones.
That 6 looks smaller.
It's the same square footage. This is why appraisers don't care about bedrooms. They make notations of bedrooms on their appraisal reports. However, they only write down, they care about the usable square footage. That's why on appraisal reports, they focus on price per square foot, not for per bedroom, even though they notate a bedroom. You know what makes it a bedroom? It has to have a closet in it too. So when you cut this bedroom in half, you may not have a closet there too. So it may not even be able to be counted as a closet. You know what I've seen some people do though, in order to get it to be counted as a closet? They went to IKEA and they got themselves one of these portable closets and they leaned it up against the wall. Is that a closet?
No.
No, it's not part of the real estate. What if they screw it to the wall?
No.
Yes. Yes. It's now a closet. It is. It is. But either way, did the square footage on the house change?
No.
No. So this is why appraisers don't really care. They'll just make a notation. Okay, well, now it's a bedroom because it's got a closet that's bolted to the wall. So it's now a part of the real estate. It's not just furniture. Okay. However, the square footage of this area is the same as the square footage of this area. So this one's not worth more than this one, even though it's got 6 bedrooms, right? I've seen some people do some funky stuff where they take the living room. We don't need a living room. Let's turn it into 2 more bedrooms.
That's like tangible property, right? Or
yeah, but okay, so it's got 2 more bedrooms. Is it worth more?
No.
Well, no, you got no living room. Where are you going to hang out with the family? Right? All right. I just show you some ideas. Some of the things that people do. You're going to walk into some houses. You're going to be like, who made this effed up design? What the hell? Yeah. Just bite your lip. All right. Basic principles of value. Okay. So let's highlight under market value versus cost. in the second line, just highlight often cost does not equal the market value. All right, turn the page. Basic principles of value. It's highest and best use. What is a highest and best use? Another term to know and add to your definition list. A highest and best use is the most valuable or the most profitable use that a property can be adapted to, or that will be in demand in the reasonably near future. That's the highest and best use. So let's highlight that first sentence under highest and best use. Now, substitution is a theory that appraisers use that says the value set by the cost of purchasing a similar substitute property. The theory says that no one will pay more when the same can be had for less. So if you have two homes with the same location and attributes, the less expensive one would sell first. Let's highlight in the book, the principle of substitution states that the maximum value of a property tends to be set by the cost of purchasing another equally desirable substitute property. And then let's go down to supply and demand and highlight this principle states that the value of a property increases if the supply for such property decreases and the demand for it either increases or remains constant and vice versa, which means the opposite's true. And now that we got that highlighted, we're going to go back to substitution here on the next slide, where I'm going to show you a visualization of substitution. This is substitution. If we have three homes that were exactly the same in every way, shape, and form, which one would you buy? They're exactly the same, size, style, location, and amenity. The one for 300, 305, or 310? The cheaper one, right? Number one. All right, now somebody beat you to it. Now which one would you buy?
Number two.
Number two, because it's the cheapest out of the, but that's substitution right there. The cost that somebody bought another property. So what is it? The value set by the cost of purchasing a similar substitute property. So somebody, not that you bought it, somebody else did, and they drove up your price. Now somebody beat you to this one. Now which one would you buy?
Three.
But I bet you're going to pay a lot more than 310 for it, because now we have a situation here of supply and demand.
There's none left.
Obviously the demand is there, and this is the last house, and there's more people that want it. We got a bidding war, my friends. This is how they start. So the supply and demand, the value of the property increases if the supply decreases and the demand increases or remains constant, and vice versa. Okay. Now we're just going to go, we're going to start blasting through some of these. They're just explanations. There's not going to be anything to highlight here. Conformity, but you do need to understand these terms. Conformity. What does it mean when something is conforming? It's the same, right? It's not different. Now, usually if a property is conforming to the neighborhood, that means that it's the same relative size or style. It's not, you don't have a commercial property sitting in the middle of a residential neighborhood. That would be a non-conforming property to the neighborhood. Generally, properties that have, you have a single family house next to a multifamily, next to a commercial storefront, next to something else. Generally, those types of neighborhoods, the property values don't maintain very well. They're not conforming. This is why usually when you go to suburbia, homes tend to be valued more in suburban neighborhoods because they're conforming. You got homes that are all approximately, give or take a little bit, they're approximately the same size, but they're usually the same architectural style even in neighborhoods. When you see that, when they're not changing too much, because still, even if you have neighborhoods where you have different architectural styles next to each other, they may not maintain the value as well. But if you got all homes that they kind of similarly look the same, they're approximately all the same size, the whole neighborhood tends to maintain its value better. That's what we call a conforming neighborhood, okay? Non-conforming structures don't maintain their value as well. It's not conforming to the neighborhood. Here's another example of conformity. I'm going to give you another extreme example. This is a situation I had too with a listing one time. I had a builder, this guy who always worked for a builder. He worked in construction, and he figured, you know what? I'm going to go out into the business and start my own construction business. So he built a new home. Now he selected a nice location in a neighborhood that where the homes ranged about $300,000. It was about a $300,000 neighborhood. And he built a $675,000. Well, actually, no, it was started out, I think, a $725,000 home in a $300,000 neighborhood. It never pays to have the most expensive or the best house on the block. You'll probably never get your money back. The guy made his first home that he built, made a major mistake. And his excuse for it was, yeah, but this house is right on the lake. The next block over or 2 blocks down is the neighborhood where there's all those $700,000+ homes. He's like, so I built one of them $700,000+ homes over here because it's by a lake, though. It's more desirable because it's by a lake. I'm like, yeah, but you're in the $300,000 neighborhood range. All your neighbors are 300,000. You got the best house on the block. It never pays to have the best house on the block. Somebody with that kind of money wants to live in that kind of neighborhood. You're going to buy a $700,000 home. You want to be in a $700,000 neighborhood. You don't want to be in a $300,000 neighborhood with a $700,000 home. Neighbors are going to hate you, right?
Look at your situs.
Well, he picked it because of situs. You know what? Situs is your preference for location, but he should have built the $300,000 home in that neighborhood. Maybe he could have gotten a little bit more for it. Not in the $700,000 range. As a matter of fact, that property had so many issues. It was in Old Bridge. It was a house at the end of a block. It was a cul-de-sac. Well, not even a cul-de-sac. It was a dead-end street, and he bought this last lot that a lot of the neighbors in the neighborhood thought it was a city-owned property, a city-owned lot. They didn't know it was private ownership. And they used to always cut across it to get to the little peninsula, and they'd go fishing on the lake. And some people drove across it with their ATVs to go riding out in the woods. And basically they used it as a cut across property, as a shortcut. And now you got this guy who's putting up a fence, building a home, a giant home at that. It was on the news. The neighborhood was opposing. They didn't want a house built there. They lost because it's private property. The guy owned it. He could build a house on it. He got the permits for it. But then the neighborhood now hated him for it. So what did they do? Well, when he wasn't building, the kids were vandalizing. They broke every window in the house several times. They hung out in the house. They broke into it. They stole tools. They took a sledgehammer to a several $1,000 very expensive hot tub jacuzzi that was in the house. They stole a $5,000 fireplace from the wall. They started a little bonfire in the middle of the living room on the sheetrock floor because it wasn't done yet. It was still under construction. The guy keeps making insurance claims to fix the house. They keep breaking it, you know. Eventually, he had somebody starting to sleep in the house to make sure that didn't happen. He fixed the house up. He was way past his timeline with the lender that he told that he'd have the house sold by already. He wasn't even done building it yet. Now comes the time that when he puts it on the market, every month that he has it up for sale, the lender is fining him $3,500 a month because he's over the time where he should have already had it sold and paid back. Eventually, he has to start lowering the price aggressively. And he lowers it to the point of $650, I think was his lowest that he had it at. And after that, too long went by, the bank foreclosed on him. So that builder's very first property put him out of business because he made a bad choice. And then it ended up selling from foreclosure?
AT&T asked me to call.
What did it sell for? I think it was about 425 it sold for. 420, 425, somewhere like that. You don't build a $700,000 home in a $300,000 neighborhood. Value ain't going to be there. Now, regression, the theory of regression. When all the homes in the neighborhood start getting boarded up because they're foreclosed on, is that going to affect your property that's not boarded up?
Yes.
Absolutely. It drags down the value, right? Now, the same way, if all the homes around you in your neighborhood are getting fixed up, everybody's building them up, doing improvements, putting additions on them, turning them into McMansions, but you haven't, is that going to affect the value of your home?
No.
Yes.
It will, because all ships rise with the rising waters. So if your neighborhood, everybody around you is building it up, building them into into McMansions, they're tearing down houses and putting up McMansions all around you, your property value is benefiting from progress around that's going on around you, which we call progression. Everybody's building up in the neighborhood. You could see this in North Edison. There were all used to be ranch style homes, like old farmers shacks. You know, you still got a couple people out there that are holdouts like that. They started building $1 million homes in the neighborhood all around them. And you get the one old timer sitting there in a rocking chair, real estate agents, developers, investors coming up to him, giving business cards. They're saying, you know, your home is worth more. He's like, I know. He's just sitting there. I know. And in the meantime, his roof looks like it's caving in and house is falling apart, but he's in the middle of $1 million neighborhood now. He's like, I know my home's worth more. I know what it's worth. When I'm ready, I'll sell it. You know, he's just waiting for the values to keep going up. And he's not going to do a damn thing to it. And he'll get a lot more money for his house. All right. So that's progression. Anticipation. Hey, did you guys hear what they're building down the street from my school over here?
What's that?
What's that?
That's anticipation, my friend.
Oh,
Gotcha. All right. Anticipation is in anticipation of something being built or something happening that's going to increase the value of the neighborhood, perhaps. It could affect the values of what's going on around you, positively or negatively. All right. What did I write here? Yeah, it's a little bit of gambling. Look, I'm going to give you an example of anticipation. I live in Linden. A couple of years back, several years back already, a developer went to go get all the approvals from the city of Linden. They were actually going to build a NASCAR racetrack in Linden. Now, you don't need to be a NASCAR race fan to know that they got a lot of fans. And anywhere in the United States where there's a NASCAR racetrack, the town that it's in and all the towns around it in the immediate vicinity get a huge economic boom to them. Because whenever a race is going to happen, hotels are booked a year in advance before the race. The restaurants are packed with business. It's a huge economic boom to the neighborhoods. So what do you think it's going to do to the property value, the land value in the area around it?
Increasing.
It's going to increase. Yeah, I know some people can be like, yeah, but what about all the noise? Yeah, so what? Restaurants don't care about that, right? It'll increase the value of the properties in the area. So when this was announced that this was going to happen and they got all their approvals, people started rushing out when they found out where it was going to be built. They started buying land they were going to build it in a marshland, kind of like a wetland. It was a flood zone, basically, where they would have to build it up. So people started buying the wetlands. Nobody wants to buy in a flood zone, but people started tumbling over each other, fighting to buy the basically worthless land that's now going to have some value to it in anticipation of that NASCAR racetrack getting built. The only problem is the developer got all the approvals for everything, but he couldn't get NASCAR to sanction one single race per year. So if you have a racetrack but no NASCAR races at it. It's not a NASCAR racetrack. It's just a racetrack. So he scrapped the project. So in anticipation, though, of all those homes, of that being built, did it raise the values of the properties in the area? It did. It did. So anticipation could affect the value is a theory, and it's true. I even got in on it. I didn't buy any real estate. I bought intellectual property. I deal with domain names. I found out what they were going to name the racetrack, and guess who's the proud owner of libertyspeedway.com? That's what they were going to call it. So I bought the domain name, which then I would have sold to them for a lot of money in anticipation. So here's some of the basic principles of value. Okay, increasing and diminishing returns. What is that? Your kitchen. You want to do a home improvement on the kitchen? Let's just say you're starting off with a kitchen like this. It's bad condition. It needs repair. And you do an improvement. You're going to get all your money back on that improvement up to a certain point. But once you start going extreme with your kitchen makeovers over that point, your return starts diminishing. You'll never get it back. So you could do an improvement in that kitchen up to a certain point. You're going to get all your money back. But then when you start going extreme, like I give the example, not everyone needs that 100-bottle wine cooler in the kitchen. It adds perhaps to its desirability, but it's not going to add any more to the value. So that's increasing and diminishing returns. How extreme you go and how that money is being applied. There will be a point that you could put money into a house, but there will be a point where your return, your profit starts diminishing because you're putting too much into it. Contribution, how the money is being used. I could give one person $25,000 and another one $25,000. I say, go do improvements to your houses. Could each one affect the value of their homes differently with the same amount of contribution? Yeah, it depends on what the improvements are that they made. Not everybody's into shag carpets. You guys still here with me?
Yeah.
All right.
We're here.
Oh, you
Sometimes I feel like I talk to myself. It gets lonely over here in this end of the microphone. All right. Competition. Well, competition could affect value, right? Too much competition could be a negative thing. Not enough competition, that could be negative too. You got to find that happy medium. Look, anytime they put up a McDonald's in the neighborhood, what are they going to build next door? Within a matter of time, there's going to be some kind of competition.
Wendy's.
They're going to put in a Wendy's or a Burger King or a Five Guys or whatever, you know, Smash Burger, whatever. Something's going to go in, right? That's when they see that there's the demand there because there's not enough business, but the demand is there. Well, competition is good for the value because people come in, they're willing to pay more for the property there to get in that neighborhood. But there's something also known as ruinous competition. Too much competition could start ruining the value. Now you got more people fighting for the same business. The value is not really going to pay back for you. All right. These are all things that an appraiser has to take into consideration. Also change. Nothing remains constant. Things change. Whether it's the local market conditions, the local job market. Look, if the major industry in town, the factory that in town that supplied most of the jobs shuts down, is that going to affect the home values in the area?
Yes.
Yeah, it will. Because if the jobs shut down and there's no more jobs in the area, we have ghost towns in the United States, towns that are no longer in existence because all the industry moved out. Or towns that were just ruined or turned into slums. Look at Michigan, look at Detroit. When all the all the plants moved south to Mexico, what did it do? A lot of job market, people just abandoned homes. Those abandoned homes got taken over by drug dealers and, you know, people just to hang out. Now they become slums, you know. Well, look, we're starting to get industry starting to move back over there now. And what's happening now? Those neighborhoods are becoming more desirable again. They're starting to get built up slowly. The local politics could affect a town, right? If you got politicians that keep spending money like it's going out of style and the taxes keep going up and up and up, or their policies are not good for the neighborhood, you know, they're not doing a good job with law enforcement or what have you. The schools are declining. Could all those factors affect the values?
Yes.
You shouldn't even think about it, especially when I said schools. Schools are probably the #1 factor there. Schools, or here's another factor that definitely affects value. If you're close to the Midtown train, if you got a train directly to Manhattan, values are definitely going to go up along those train lines. Take a look at any of the properties in Union, in Summit, Chatham, you know, any little values because you got that train line there. Okay. Contamination on the land, that could affect the value. Industry, weather patterns, changing of weather patterns, something that previously was not a flood zone. If it's remapped and it's now considered a flood zone, could that affect the value of the property?
Yes.
Yep.
Good wish, yeah.
Hey, now you got to get flood insurance, and flood insurance costs money too. All right, so let's talk about the 3 approaches to value that an appraiser would use, and we do as well. But actually, we don't use them all. But you need to memorize the 3 approaches to value that are here. Okay. Sales comparison approach, the cost approach, and the income approach. And now we're going to go over each one. And these slides explain it pretty good. The sales comparison approach is most often used by real estate licensees. You guys should probably just use this slide to study from for each of the 3 approaches. It's most often used by real estate licensees. Licensees. So it's best use for residential property valuation. It compares the subject property to similar comparable properties that we call comps, similar in size, style, amenity, and location to the subject property that have recently sold. Recently, we're talking 3 to 6 months. You start looking a year back or more, now you have to start making adjustments for market change. So location, when we talk about location, we're talking about in the immediate vicinity, not on the other side of town, because different neighborhoods have different desirability and values to them as well. But let's just say that we have 2 properties. Go to the whiteboard here. Let's just say that here's the city line, and we're trying to determine the value for this house here. You look up comps in this neighborhood around it. Now, you may see comparable properties over here that are, you know what? I would take this property as a comp right here over this one, because this one's in a different town. Different town has a different tax base, different police, different fire, different public utilities, different school systems, different taxing bodies.
No.
So you got to really, when you're valuing properties, you got to take all that into consideration. You can't just go like this and look at all the properties around it. You got to keep it you got to keep it on that side. You got to keep it in the same town. Can't use comps from a neighboring town. They got to be in the same town, all right? Location, relatively same. Physical features should be similar. If they're not, then you make adjustments for their differences. And taking that CMA workshop could help you do that, to learn how to make those adjustments. You know, if one house has 3 bedrooms and one house has 4, well, how much is an extra bedroom worth? Well, classes like that would teach you how to do it, or experience. But you don't just pull a number out of thin air. Terms and conditions for the property sale could make a difference. If the subject property is missing features, okay. Now, how do you make adjustments for the differences? Okay, forget about how do we determine the value of the differences. We need to know when to make the adjustments. And there is an acronym here: CBS, comp, better, subtract, or was it comp, poorer, add? That's CPA, comp, poorer, add, or CBS, whatever. That, you know, that gets difficult. I'm going to show you an easy way to know when to add or subtract from a comparable property's value. Here, let's do this. On the bottom of page 277, I want you guys to highlight the 3 approaches to value. And then we're going to highlight the sales comparison approach, the cost approach, and the income approach. Then we're going to turn the page. And the sales comparison approach, this explains that you're going to make all those adjustments based on the differences of the property. And there's a chart here on page 279. Okay. I got a similar chart here up on the slideshow in front of you that I created. You got to know when to add and when to subtract from comparable value. So first of all, you're going to have the subject property, and you're going to know what the features are in that subject property. You have to have a minimum of 3 comparable properties to compare it to. And they'll give you the price range. So if we don't do any adjustments, we could see right off the bat, the price range is $300, $315, and $320 for these recent sold. So the price range is between $300 and $320. But we could narrow it down further. They're all same style house. But look, they don't all have the same number of bedrooms or baths. So we're going to have to apply a value to those differences. But the thing is, you got to need to know when to add or subtract from a comparable's value. You're going to need to know that for exam. So here, let me explain it to you guys. Are you ready? You paying attention?
Yeah.
Yes.
We have an example here. The subject property has 4 bedrooms. Comparable one has 3, and the other 2 have 4 bedrooms as well. So we're going to have to determine how much the value of a bedroom is. In this case, we determined it's $5,000. So if it has if one bedroom is $5,000 difference in price, are we going to add or subtract from the comparable one's value?
We're going to add.
Now, why are we adding?
It has 1 more bedroom.
Okay, so we're going to try to pretend that if comparable, we know that comparable property 1 sold for $300,000. If the only difference in the house was the bedroom, then this house, if a bedroom goes for $5,000, if it had 4 bedrooms, making it exactly the same as this one, it would have sold for $305, if that's the only difference. See, we're going to make adjustments for all the differences and then add or subtract them. But what you need to know is when to add and when to subtract from a comparable property. Here, I made this little thing here for you guys. You ready?
Yeah.
So I made this little thing that I'm going to show you here. I got the subject property. That's the property that's up for sale that we're trying to determine the value for, and a comparable property. Here's a good guide that you could remember. Forget about looking at charts or words. And I do it, you could do it with your hands too. If a subject property has a feature that a comparable property is missing, do we add or subtract to the comparables property to bring it up to the same level as the subject property?
Subtract.
Subtract.
If I subtract, it brings it down here.
Hmm.
Let me word that again. This is the goal, to put them at the same level, to make them exactly the same. But if a comparable property is missing a feature that the subject property has, are we going to add to or subtract to the comparable property's value to bring it to the same level as the subject property?
We're gonna add.
Boom, we're going to add.
Add.
It brings it up to the same level. Now, what if that comparable property had 5 bedrooms? It's a better feature, or it's in better condition, or it has a feature the subject property doesn't have. What are we going to do to bring it to the same level as the subject property?
Subtract.
A minor.
Subtract from the comparables
Subtract.
value. Boom. That made it a lot easier, doesn't it? So
Mhm.
instead of reading these things, all you got to do is this. Here's the subject property, here's the comparable property. If the subject property has a feature that the comparable property is missing, are we going to add to the comparable property's value or subtract?
Add.
We're going to add to bring it up to the same level, because our idea here is to try to make these comparable properties exactly the same as the subject property. We're playing pretend a little bit. Okay, and we're going to determine, like with the bedroom, once again, if the comparable property only has 3 bedrooms, but the subject property has 4, we would determine what the value of the fourth bedroom would be, an extra bedroom would be, and we add it to the comparable to bring it up to the same level, if that was the only difference. So what we have to do is we have to do that for each of the differences, and then we do the accounting, the adding and the subtracting. In this example, look at the column 3, the comparable property 3. It has 2 garage parking spaces. The subject property only has 1. We would have to determine how much an extra garage space is worth. In this case, we determined it's $10,000. So if it were exactly as the subject property, are we adding to or subtracting from the comparables property value to bring it to the same level? Well, hold on. Let's start off like this. If we're starting off at equal, let's see. The subject property has a 1-car garage. The comparable property has 2. So what do we got to do to bring it to the same level as the subject property? Determine the value of the difference and then make the adjustment. Are we going to add or subtract?
Subtract.
Bringing it down to the same level. Does that make it pretty easy?
Yeah.
Okay. Because, I mean, for me, learning new acronyms, it's just something else to learn, and it's confusing, especially CPA, comp poorer add, CBS, comp better subtract, you know. Ugh. And it still boggles my mind. For me, I'm a visual person. Visual learning cues work good for me. Subject property, comparable property. Subject property has a feature that the comparable property is missing. Here's the comparable property, it's missing. Well, we would have to determine the value of that feature and add it in. If it has a feature the subject property does not, we would subtract. You could do it with your hands when you're taking the exam. I'm just using this visual cue here for you, okay? Let me see if we have a question for that. Because you guys could get a question on an exam, and it'll be just like a long-winded question. They'll say, you're selling a property, the subject property at 123 Main Street has 3 bedrooms, 2 baths, and 1 garage space. and the comparable property has this, this, and this, and there's the value for this for a bedroom, this for a garage, this for whatever. So your guys are going to take your scrap paper and just draw columns like you're seeing here. And you're going to make these adjustments, but you need to know when to add and when to subtract from the comparables value to then give the price range of what the home should sell for. Okay. Do you know when to add and subtract from a comparable value?
Yeah.
Yes.
Yeah. You just gotta keep them level. The goal is to keep them level, to keep them the same. Comparables in bad condition, worse condition than the subject property. Determine how much that difference in value is for the condition, and then are we going to add or subtract?
And
We're going to add to bring it back to the same level. Okay, boom, that's it. Okay, that's what you need to know for exams. Right now, don't worry about how we determine the value of a half bath, full bath, and all that. You're going to take that Ottawa class, or your broker is going to train you for that. Right now, I just want baby steps. You got to pass the exam first. Let's first teach you when to add, when to subtract. And you're going to do this little trick, okay? All right. So here's a little picture I drew. How the homeowner sees the value of their home versus the realtor versus the appraiser. And I already told you it's often an uphill battle. I give you the example of that guy with that 380,000 he wanted and in his pocket. All right. And sometimes they may be unreasonable with their asking price. So that homeowner saw his house like this, like a castle, right? And this is the way I saw it. Forget about the appraiser. We didn't even get to that area. But often this is a good realistic picture of how the three parties that are involved in this transaction will view this property. Homeowner thinks they got the castle. They think their home is worth $1 million. The realtor's like, no, 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 you're down here, dude. And then the appraiser's like, no, 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 you're down here, dude. Trying to bring you down to reality of what the realistics are. Because most realtors, they don't do a good job of this part, making the adjustments. A lot of times they just try to eyeball it and do a guesstimate and skip all this work. That's why they get shocked when an appraiser brings in the value even less. So the cost approach to value. The cost approach is based on the theory of substitution. The cost approach is also referred to as the appraisal by summation. Okay, you need to know this for exam. This is the second approach to value. The cost approach, also known as an appraisal by summation. It's used to determine the value of special purpose and unique one-of-a-kind public properties that may not have comparables or generate income in the normal fashion, like schools, churches, libraries, City Hall, if City Hall went up for sale, or a custom unique home. So this approach is most often used by appraisers, not by salespersons, simply because we don't have the knowledge required to do it. But nonetheless, it is a question that is often on exams, okay? The question that you see mostly on exams, you need to know when to apply the cost approach to value. It's used on special purpose buildings. What is the cost approach also known as?
Appraisal by summation.
The appraisal by summation, because they're going to be doing some summing up of the numbers, adding and subtracting. So here's what an appraiser does. First, they estimate the value of the land. So look, if there's a church that goes up for sale in your neighborhood, how would you value the property of a church, the value of a church? There aren't many comparables that have recent sales in your neighborhood of churches, I'm sure, right? Can you guys agree on that?
Mm-hmm.
So how would you determine the value? Well, first you'd have to look at the property, the land that it's sitting on. How much would it cost to acquire that land in this neighborhood if it were put to its highest and best use? Then you would have to estimate the current cost to construct all the improvements, whether it is, putting everything from putting the pipes to the house, the sewer pipes, the water mains, constructing the building itself. And then after you determined all that, now you have to estimate depreciation of the improvement, not the land, because land does not depreciate. So you have to deduct accrued depreciation for various reasons from the estimated cost of the new building, not the land, because land does not depreciate. And then you add the value of the land back into the depreciated building value. These are the 5 steps that the appraiser would do. We don't do this because, do you know how to value the cost of reconstructing a building? All right, so this is a little bit beyond our scope, but nonetheless, we get an exam question on this. We even get a math question on this. Now, one thing I explained here is we have to estimate the cost to construct. Well, an appraiser, there are 2 approaches of estimating the value of how to price the construction of that building. Are we trying to make an exact duplicate of the building that's there? That would be reproduction cost. Or are we just going to replace it with something else that's functional that serves the same purpose, another building that serves the same purpose? That would be replacement cost. So here we go. I got another slide here on that. The cost approach to build the structure can use one of these approaches. Reproduction, well, here's another way to remember this. Well, reproduction is making an exact duplicate. Replacement is just replacing it with something else that works that's not necessarily an exact duplicate. Once again, in my politically incorrect ways of remembering things and not trying to offend anybody, this is the way I do it. Ladies, why do you have children? To make little exact duplicates, little mini me's of yourself in your own image, right?
Mhm.
I know it's a little bit of a joke. Take it with a grain of salt. I'm not meaning to offend anybody, okay? If you're offended by it, lighten up, all right? It's not meant to be offensive. Now, if you don't have a child to make a duplicate of yourself, is there still a way that you can have a child that's not necessarily an exact duplicate and you'll still have a child? Sure, you could adopt. You'll get the same exact result. You will have a child that will love you. That child just won't be an exact duplicate of you.
Okay.
All right. Can you guys see what I'm trying to do? So you could either have an exact duplicate is reproduction. And what do you call it when you have a baby? You're reproducing. Here's a way to remember that. Or you could adopt. You're going to have a child. The end result is the same. You have a child, but that child's not necessarily an exact duplicate of you. Okay. If you can't remember the words themselves, try to remember the story, and hopefully that'll help you remember the difference between reproduction and replacement costs.
Got it down packed now.
All right. So look, when you have an insurance on your house and say that you have a fire in your kitchen, but you had a custom kitchen with all high-end stuff. Is the insurance company going to replace it the exact way that it was before?
No.
No.
It depends.
It depends on the insurance company.
It depends on the type of policy you had.
The policy.
There's actually 2 different insurance policies you could get: replacement cost and reproduction cost. If you get a reproduction cost, they'll replace it the exact way that it was before with the same custom cabinetry and appliances. But if you just you opted for the cheaper policy, which only which was the replacement cost policy, they'll replace it with cabinetry. That's not necessarily custom. It could just be some cabinetry that you'll standard Home Depot off the shelf cabinets that you could put your dishes in, right? And you're not going to get any custom or fancy granite or other countertops. They'll just give you some linoleum countertops that'll still serve the same purpose. You could prepare your food on it, right? they'll get you a GE white product that we refer to white products as products that are standard products. Okay, they're nothing custom about them. They're called white products. So they'll just replace it with a white product stove or refrigerator. It's a standard thing, you know, GE appliance, standard GE appliance off the shelf, white product. Okay, you're not going to get a custom Viking stove or refrigerator, you know. For that, you would need to have the reproduction to make you exactly the way that it was before. So that's the thing that the when doing the cost approach, the appraiser got to determine which approach am I going to use. Now, how do they determine that? Well, on page 281, there's a whole write-up of that. I'm not going to go over it with you because we don't need to know all that. But if you're curious about it, you could read that on the page 281 about how do they about determining which approach to use. So what I'm going to do is I'm just going to make a little note here about the determination of that. Let's see. Appraisers determining which approach to use. See page 281. Why is that all underlined? Set to underline. All right. All right. So what to highlight here in the book? Okay, so on page 279, highlight the cost approach. The cost approach is the most helpful in the appraisal of special purpose buildings such as schools, churches, and other public buildings or unique buildings. Then in the next paragraph, the bottom line, we're going to highlight the cost approach is sometimes called the appraisal by summation. The cost approach consists of 5 steps, and then it goes over what those 5 steps are. Then on page 280, 2 paragraphs down, we're going to highlight everything from where it says reproduction cost in bold to the end of the paragraph, which goes over reproduction and replacement costs, what the differences are there. Now, I did tell you part of that process was they also have to estimate depreciation. What is depreciation? Depreciation is a loss of value due to any cause or condition. There you go. It's a loss of value due to any cause or condition to an improvement, because as a general rule of thumb, land does not depreciate. So there's different types of depreciation, and you need to know them for exam. Well, first of all, physical deterioration, you don't need to study that. The wood rots. Is this curable? Can it be fixed? The building's falling apart because it's rotting. Can you fix that?
Yeah.
Yes, that's physical deterioration. Yeah, it can be cured. It can be fixed. Now, the next 2 you need to study because these will be on exam. Functional obsolescence. Stop. Let's not even read the definition. Don't even read the definition. Close your eyes, guys. Listen to the words. Functional obsolescence. What does it mean if something is functional?
Working.
It's working. There's nothing wrong with it. If it's obsolete, what does that mean? It's outdated.
It's outdated, yeah.
Right? So it's functional, but it's outdated by today's standards. So if something is functionally obsolete, can it be cured?
Yes.
Yeah. Boom.
Yeah.
See, We don't even know, we didn't even read the definition. And just by looking at the word, we figured out what it means. Because you do need to know what it means. So let's read the definition that I put here. Functional obsolescence means there's nothing wrong with the property other than that its features are considered to be outdated or undesirable by today's standards. It's functional, but obsolete. It is curable. You could do updates or additions. Let me give you an example of functional obsolescence. 5-bedroom, 1-bathroom house.
5-bedroom, 1-bathroom house.
Yes. That's functionally obsolete by today's standards.
Functional obsolete.
These days, most people, they get a 2-bedroom condo and they want a 2.5 bath.
Yeah.
5-bedroom, 1-bathroom house is functionally obsolete by today's standards. Look, there was a point in time you'd be lucky that you had indoor plumbing, you know, but by today's standards, 5-bedroom, 1-bathroom house, it's like, can that be cured? Sure, you could add another bathroom. Look, there may be nothing wrong. That bathroom is functional. There could be nothing wrong with it. It's actually a big bathroom and it's beautiful. It's a big, beautiful bathroom that's brand new, that was just remodeled. But it's still 1 bathroom. So it's functionally obsolete in that regard. It can be cured. You could add another bath. Now, external obsolescence. If something's external, what does that mean?
Inside.
External. Something
External.
which is
It's outside.
Outside. Okay. Now, when we say outside, we're not talking about outside the house. We're talking about outside the property. So external obsolescence are factors that are not on the subject property that are considered undesirable. So this could be many things. External obsolescence also goes by the name of locational or economic obsolescence. Is the local economy off of your property? The local economy, the businesses, everything that goes on in the area, is that off your property?
Yeah, it's all.
Yeah.
Yes.
Can the local economy affect the value of your property?
Yes.
Depends
Yeah,
on
it can.
where the property is.
So do you have control over the local economy?
No.
No.
No. So this type of obsolescence is almost always incurable. There are factors not on the subject property. So it goes by economic obsolescence, but also sometimes locational obsolescence, but it's all external, something that's not on your property. Locational obsolescence, let me see. The city decides that they're gonna build an incinerator down the street from your house for incinerating garbage. Is that gonna be desirable to most home buyers?
No. They
No.
smell terrible.
Is that beyond your control though?
No.
Yeah. Yeah. You'll have a little bit of a say, but not much. If the city decides they want to build it, you can't stop it. Right? So external obsolescence are often incurable. See, so this type of obsolescence is almost always incurable. So this slide is good at explaining the two, functional and external obsolescence, but I just showed you how you could figure it out yourself. You don't even need to study a slide. If you just close your eyes and picture these words, external obsolescence. External means it's outside the property. Obsolete means it's undesirable by today's standards or outdated, right? Functional obsolescence, it's functional. There's nothing wrong with it, but it's outdated. It's curable. So let's highlight those things now on page 281. We're going to highlight depreciation. Under depreciation, refers to a loss of value due to any cause or condition that adversely affects the improvement to real estate. And then underline, as a general rule, land does not depreciate. Then we're going to highlight in the numbered list And then in a numbered list, we're going to highlight physical deterioration. And just below it, we're going to highlight curable. Then under functional obsolescence, we're going to highlight functional obsolescence refers to physical or design features that are no longer considered desirable by property buyers. And for the most part, it's curable. So highlight curable. And then under external obsolescence, we're going to highlight the first two lines. External obsolescence, also known as economic or locational obsolescence, is caused by factors not on the subject property. So this type of obsolescence is almost always incurable. And then we go to the income approach to value. It's based on the present worth of future rights to income on the property, used for valuation of any property that generates income. Apartment buildings, office buildings, shopping centers, multifamily homes, etc. Using cap rates or something called GRM, which is gross rent multiplier. And cap rate is the capitalization rate. The income approach to value uses one of the following two methods. Cap rates, which are also known as capitalization rates. It's a measurement that measures or determines the rate of return on an investor's money. It's a measurement that determines the rate of return on an investor's money. They call that capitalization, or for short, cap rates. You need to know this. You need to know it for exams. You need to know it for real life. And we are going to go over math on how to calculate it. We're not going to do the math in this chapter until all the terms are done, though. And then we'll circle back and do all the math. So we use the T formula to calculate this. I'm going to show you what that T formula is and how to use it. And you need to have the gross operating income figure before expenses. You're going to need any two of the following three numbers in order to calculate it. GOI, the gross operating income before expenses. And the GOE, which stands for gross operating expenses, not counting the mortgage, the financing costs, because that would vary from one owner to the next. And then you have the NOI, the net operating income. Is how you calculate it is you take the gross operating income, you subtract the gross operating expenses, and you're left with the net operating income. Here, so the word gross is not confusing you. Just remember, you take the income, subtract the expenses, you're left with the net. They just use the terminology gross operating in front of it. Okay? You know what the net is, right? You guys ever have a job before in your life where you got a paycheck?
Yeah.
You wish you got paid
Yeah.
gross. Instead, you got the net after they subtracted everything, right?
Yeah.
So there you go. You guys should understand that terminology when you reflect in that manner. And then we have the gross rent multiplier. It's another way of determining value for income producing properties. So the GRM is the gross rent multiplier. It compares a property by comparing two or more similar income generating properties. You cannot compare a 4-unit building to a 5-unit building or a 3-unit building to a 4-unit building. You have to compare similar properties, 3-unit to a 3-unit, 4-unit to a 4-unit, so on and so forth. Now, a multiplier, when you're for the non-math people, a multiplier is an insignificant number. There's no such thing as a good multiplier or a bad multiplier. It's just a number. It's a neutral number that's used to compare two things. Now, I'm going to show you how to come up with the multiplier, how we create this number. Okay, that's what the math is about. How to figure out the multiplier and then how to use it to compare two properties. And we're going to do that using something that I dubbed the reverse T formula. So the information needed to calculate the reverse T formula is the gross monthly income, the value of the property, and the GRM. You would need two of these three numbers to figure out whichever the missing one is. Now, similar to the GRM is the gross income multiplier. We're not going to do any math on this, but it's exactly the same thing as the GRM, but it also adds in not just the gross monthly income from the rent, but it also considers income from other sources like sales concessions, etc., that are not coming from the real estate. We're not going to use this one, and you're probably not going to get this one on exam either. You're going to need to know the gross rent multiplier and the cap rates. All right, now when calculating cap rates though, this is how you figure out the net operating income. But you're going to need two of any of the three numbers: the annual net operating income, the value of the property, and the cap rate, in order to calculate what the cap rate is. All right. On page 282 at the top of the page, highlight income approach or income capitalization approach to value is based on the present worth of future rights to income. Go down to the fourth bullet point. All these bullet points are basically telling you all the steps on how to calculate it. I'm going to show you how to calculate it. Don't worry about that. Let's go down to the fourth bullet point. And on the second line, you're going to highlight estimating the rate of return and investor demands for the investment of capital. Go to the end of that line and continue and highlight rate of return is called the capitalization or cap rate. Now in the margin on the page next to that, I'm going to have you write the T formula. You're going to write use T formula to calculate and put the capital letter T with quotes around it. Say use T formula to calculate, and then here is the T formula right here. You're going to make a T. You see the division signs like that and multiplication signs. And then on one side, you're going to write the large number or property value goes on one side, the percent or cap rate on the other, and the small number, which is the annual net operating income, goes on the other side, on the top. Let me know when you're done doing that. Okay. So after you're done writing that T formula down there in the margin, also write this little instruction for you. Here's a little acronym I made up, TGIF. It means that the top number goes in the calculator first, or As long as you remember, you divide down and multiply across. But when you divide down to find out the missing number, like if you want to figure out what the cap rate is on a property, you need to have the annual net operating income and the value of the property. So which number do you put in the calculator first? The one on top. Small number goes in the calculator first, then you hit the divide button, put in the other number, and it'll tell you the cap rate. If you want to find out the value of the property, you could take that annual NOI divided by the cap rate, and it'll tell you the value of the property. Or you could take the value of the property times the cap rate to give you the missing number up top. And we're going to actually do a couple of math problems with this. Now, this T formula can be used for calculating cap rates. It could also be used for figuring out your commission and other items too. So we're going to do a couple of math problems with this. I'll show you how to use the T formula. But before we do that, on the next page, 283, it says gross rent or income multiplier. Highlight gross rent multiplier, GRM, relates to the sales price of a property to its rental income. And right next to the use reverse T formula, and then somewhere in that big open space on the upper part of the page there, right, this is the reverse T formula. The large number, which is the property value, goes up top. The gross monthly income on one side, and the GRM on the other, which is not a percentage rate. The GRM is a whole number. It's not like a cap rate, which is a percentage. A multiplier is a whole number. It's not a percentage or a rate. And let me know when you're done typing that in.
Okay.
All right. So what are the three approaches to value? We have the sales comparison approach, the cost approach, and the income approach. Which approach to value would you use to determine the value of a single family home?
CMA?
Comparative.
Well, CMA is how we determine the value using the sales comparison approach. An appraiser would use an appraisal, not a CMA. But that's comparative, that's using the comparative approach, how we do it. Okay, so for a single family house, which approach? You do the sales comparative or sales comparison approach. What about for a the sales comparison approach? What about for a what about for a strip mall?
The income approach.
An income approach to value. What about for a church?
The cost approach.
Cost approach. What about a four-family house?
Income.
Income approach?
No.
No? Which approach?
No.
Income approach.
Well, look, why not either one? Look, there's something called reconciliation. You could actually use either one. Look, a four-family house generates income, but you may have comparables that you could compare it to as well. So use both approaches to value and then determine which is the best one to use. The best use would be the more profitable one. So the term reconciliation is a term you need to know for exam. It's when you apply more than one of the three approaches to value to the same property. And you basically use all the approaches to value, and then you determine which one that you're going to use, which would be the more profitable one or more valuable one. So on the next page, 284, we're going to highlight that reconciliation. If more than three approaches to value are applied to the same property, everybody got that?
Yes.
We're gonna come back to this stuff for the math here in a moment. One thing we got to remember is that an appraisal is done by an unbiased, neutral person, right? That's licensed to do appraisals. We got to remember that a CMA can never be called an appraisal, so don't ever take that shortcut. These are reasons why people get appraisals for estate purposes. This whole list is can be found on the top of page 285. When someone dies, we get an estate. We get appraisals for estate purposes. We get appraisals for divorce proceedings to determine what the assets are before we divide them up, right? For financing, when trying to get a loan to buy real estate, or for refinancing, we get appraisals. For taxation reasons, to figure out what the assessed value is. That's the ad valorem. Ad valorem is according to value in Latin, right?
Mm-hmm.
Relocation purposes, when we have corporate relocation companies that help relocate employees, sometimes they'll buy the property, then need to get an appraisal to find out what it's worth. Condemnation, when the state takes away your property due to eminent domain, right? Condemnation's that court process to take that property. But we need to get it, we need to figure out what the value is so that they could be justly compensated. For insurance reasons, or for damage loss for tax deductions, or for feasibility studies. We do, government would do that. All right. They call it a uniform residential appraisal report, the appraisal that actually gets done. You could see a blank one on page 287. Looks a lot like our CMA that we were doing, wasn't it?
Mm-hmm.
7, right?
It looks almost identical.
Yeah.
All right. Now this slide I have up here, we got to go back one page to page 285. On the bottom of page 285, the next to last bullet point, I want you guys to highlight Uniform Standard of Professional Appraisal Practice, USPAP, USPAP. Highlight that. Everybody got it?
Where is it?
Yeah.
The
Where
bottom
is it
of page
again? I'm sorry.
285, the next to last bullet point at the very bottom of the page. Not the last bullet point, the next to last bullet point.
Okay.
On the second line, it says Uniform Standards of Professional Appraisal Practice, USPAP, USPAP. Just highlight that. I'm going to explain it in a moment. Everybody get it?
Yeah.
Yeah.
Okay, now. Okay, turn 2 pages to page 288. So that was on page 285 and then on page 288. Here, let me just write this here. All right, so on page 288, on the third paragraph, The second line, highlight member of the Appraisal Institute. MAI. Member, actually before that, the end of the first line of that third paragraph, MAI, member of the Appraisal Institute.
I'm sorry.
Page 288, third
Yes.
paragraph,
Paragraph.
end of the first line where it says MAI, member of the Appraisal Institute. You see that?
Yes. Okay.
Okay, highlight that. On exam, on state exam, not our exam, state exam, you're going to get one or the other of these or both. You need to know what they are. So if we look at the slideshow that I have up here in front of you, MAI is the member of the Appraisal Institute, and USPAP is Uniform Standard of Professional Appraisal Practice. Let me explain them to you. Now, from the way it's been explained to me, I don't know how they are phrased in a question on state exam, but I have been told that as long as you know it has something to do with appraisers, you'll get it right. But let me explain it to you so that you understand what they are. So that you could relate. You guys are trying to get your real estate license, right? When you get your real estate license, you guys are then going to be joining NAR, National Association of Realtors, right? Now, what NAR is to us, our private trade association, MAI is for appraisers. They become members of the Appraisal Institute. Ah, makes sense, right? Now, when you become a member of NAR, National Association of Realtors, within like 30 or 60 days, you're going to have to take the Realtors Code of Ethics training class. Now, what the Realtors Code of Ethics is to us, USPAP is to appraisers. That's their Uniform Standard of Professional Appraisal Practice. It's a 15-hour national course that all the appraisers are required to complete. Okay? Not difficult. That's it. Not a big deal. MAI, USPAP has something to do with appraisers. MAI is what NAR is to us. USPAP is what our Realtor Code of Ethics is to us. They got the Uniform Standard of Professional Appraisal Practice. Okay. Now, the different appraiser license types. I think this is the last thing of this chapter pretty much. There's 4 types of appraisal licenses. In New Jersey, you got to start off, if you want to be an appraiser, you have to start off as an apprentice trainee. In order to become an apprentice trainee, you have to complete a 90-hour class and pass a state exam in just the kind of stuff that we studied in this chapter. And a lot of math. And now you become an apprentice trainee. You cannot do appraisals. You're just the gopher. You're probably actually doing appraisals, a lot of the paperwork, and then handing it over to an appraiser who's taking the credit for it. You're running around putting your time in, doing the legwork and the hard work. All right. The next step is you could become a licensed residential appraiser from there. Now, in order to become a licensed residential appraiser, you're going to have to take an additional 150-hour class and pass another exam and have 2,000 hours of experience over a period of not less than 12 months in order to become a licensed residential appraiser. Okay. Now check this out. A licensed residential appraiser still can't do appraisals on their own. Well, they can, but they have to work under a certified residential appraiser or a certified general appraiser. So what's required to become a certified residential appraiser? In the book, like 3 paragraphs, the last 3 paragraphs of the book, on page 288, the applicant for certification as a residential appraiser must have an associate's degree. They want you to have a college degree now. In what? It don't matter. Isn't that the stupid requirement? You got to have a college degree. This is an added, this is a recent adding in order to become an appraiser. Previously, it wasn't like that. After we had this whole mortgage meltdown crash and all that, politicians were blaming everybody else for the problem. It's the realtors, it's the attorneys, it's the banks. Who else can we blame? Oh, it was the appraisers because they're valuing the properties. Yeah, but they're using supported evidence as stipulated on a report. Well, anyway, some politician used it as a talking point. I pushed for putting in a more stringent education requirement for appraisers to make sure that this does not happen again. Sounds like a good talking point, but it's really bullshit. Because when you boil it down, you could have a degree in liberal arts. How is that going to make you a better appraiser? It ain't.
That's funny.
You see how politics is such a stupid, dirty game? They play games like that, and really does the things that they do. Is this helping anything? Is this going to make appraisals prevent anything from them doing wrong work or something? No. As a matter of fact, it's going to have a negative effect. You know what the negative effect is? Less people are going to want to become appraisers. It's going to become more expensive then to get an appraisal, and it's going to take longer to get one. Appraisers are current licensed appraisers are counting on that. Look, it says the applicant as a certified residential appraiser must have an associate's degree or higher. Applicants without a degree can substitute 21 semester credits in English, economics, mathematics, business, and law courses. Those people will be better suited. The student must also complete 200 hours in approved appraisal courses, another 200, and have 2,500 hours of experience in a period of not less than 2 years. All right. And now you can work on your own. But check this out. Look at the slideshow. A certified residential appraiser can only appraise residential property and properties under $1 million. Now, they can appraise commercial property, but only under the supervision of a certified general appraiser who can appraise anything. Remember, I told you, anytime you hear the word general, it's a wider scope. They could do more, right? And that's played true throughout this whole class so far. So a certified general appraiser, there's no monetary caps on the value of residential properties that they could appraise, and they could appraise land and commercial property. So what's required to become a certified general appraiser for those interested? In order to become a certified general appraiser, the student must have a bachelor's degree or higher. An applicant without a degree can substitute 30 semester credits in courses mentioned above and 2 elective courses in accounting, geography, AG economics, business management, or real estate. In addition to another 300 hours of class of approved appraisal courses are required, and an apprenticeship of 3,000 additional hours of experience over a period of 2.5 years or more, with at least half of that, 1,500 hours of that, have to be in appraising non-residential properties. Highlight, huh?
Hope they're getting paid a lot.
Well, I'll answer that in 1 second. Highlight, unlike a residential appraiser, a certified general appraiser has no monetary caps on the properties they can appraise. And you could write at the end of that line, and can appraise commercial property. And it goes on that they need to have criminal background checks and stuff like that on them too. Okay, I have a link here for anybody who wants to get information about becoming an appraiser. Because their licenses are maintained or managed by the New Jersey Department of Consumer Affairs in Newark. All right. You said you hope they're getting appraised a lot. Anybody here buy a house recently?
Yeah.
In the last couple of years?
Yeah, I did.
How much did you pay for your appraisal? Because you had to pay separately for that.
Yeah, I did. Oh shit, how much was it?
I don't remember.
It was between $400 to $600.
About to say, I think it was like $500.
Yeah, it was between $400 to $600. And if you're just the appraiser and you're working for another company, well, you don't get to keep all that. You only get a portion of it.
Wow.
Plus, you have to have all these tools. You have to have access to the MLSs, tax records. They have different software that's very expensive to do to help them do the math and to aggregate the information from different sources and to do their their public records research, making sure that there's no make sure that they're arm's length transactions and stuff. There's a lot of other work that they're doing on it too. So appraisers have to hustle if they want to make money. That's why if you ever see an appraiser that goes to the property, they come there and they're there with a clipboard, taking their notes, they snap in pictures, and then they're running on from one room to the next. You're trying to have a conversation with them and it seems like they're being rude because they're like taking notes, looking around, and then they're off to the next room. You know, why are they doing that? Well, because they got to do this is just their legwork and they're doing the notes and then they got to run off and hit up as many properties as they can. Then later on, they go to their office, then they do all the research, write up the reports, and then submit it. So they got to do a lot of appraisals if they want to make some serious money. They're always hustling.
Mhm.
But yeah, they can make good money if they hustle. We're done with this. Let's do the key terms to review. I know it's after 4:30. Let's do the key terms to review though. We'll be done for the day. And then we'll continue on Monday and we will do the math for chapter 16 then. Okay. So analysis of income, including rental and other factors.
Gross income multiplier?
10 is A, the gross income multiplier, correct. Analysis of rental income used roughly in the sales comparison approach.
Gross rent multiplier.
Yeah.
Wait, which one did I read? Analysis of income used for sales comparison. Yeah, 11 is B. The gross rent multiplier. I had them mixed up. I was looking at the wrong one. 11 is B. Use of land that yields the most money.
Highest and best use?
Yes, 12 is C. Appraisal technique that analyzes the cost to build.
Cost approach?
Yes, 6 is D, cost approach. Analysis of value of property using return on investment.
Income approach.
13 is E, the income approach. Extra that contributes to the owner's satisfaction, like clean air, views, and so on.
Amenity.
Functional.
It's an amenity. One is F. One is F. It's an amenity. Loss of value due to any cause or condition.
Depreciation.
It is. 7 is G. Loss of value due to factors beyond the property's boundaries.
External obsolescence.
8 is H, external obsolescence. Loss of value due to worn or outdated features. Outmoded, they worded it.
Is
The functional.
Yes.
Functional obsolescence. 9 is I. A process of estimating value.
Appraisal.
2 is J, appraisal. Rate of return demanded by investors in a particular area.
Capitalization rate.
4 is K, cap rates, correct. Similar nearby property recently sold.
Comparables.
Yep, we call it a comp or comparable. 5 is L. An independent person trained to provide an unbiased estimate of value.
Appraiser.
They are an appraiser. 3 is M. All right, let's do key terms 2.
Oh, okay.
Analysis of values received by different appraisal approaches.
Sales comparison approach.
By using different appraisal approaches.
Reconciliation. Reconciliation.
Oh yeah, reconciliation, yes. 4 is
Oh,
A.
yeah. I didn't see that.
4 is A, reconciliation. Cost to rebuild exactly using materials like the original.
Reproduction.
Reproduction, 6 is B. You get a little chuckle out of the story if you remember the story. Yeah. Cost to rebuild using today's materials and techniques.
Replacement cost.
Replacement.
5 is C, correct. What the property actually sells for.
Market price.
Market price,
price.
because market price is the selling price, right? 1 is D. Location and buyer's willingness to pay more for certain locations. Situs or situs. 8 is E, correct. Loss of value due to wear and tear.
Physical deterioration.
3 is F, physical deterioration, correct. Not parcel of real estate being appraised.
Subject property.
9 is G, correct. Present worth of future benefits.
Value.
Value.
11 is H, value, correct. A price that would be paid by an informed buyer.
Is that a market value?
Market
It
value.
is. 2 is I. Don't we help buyers as well as sellers determine the market value? So we're informing them based on our research, right? So they become informed buyers. Okay, principle that no one would pay more if the same can be had for less.
Substitution.
Yep. 10 is J, substitution. And an appraisal technique that analyzes the sales price of comparable properties.
Sales comparison approach.
Sales comparison approach.
7 is K, correct. Yes. All right, so let's see. We have, let me just stop the recording for now.